Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with the revision. Right guys, so let us start on with revision of accounting standard to valuation of inventory. In the first part, we'll cover up the concepts of the standard in a very quick fashion, and then we'll discuss some very important practical questions so that you know how to answer them and present them in the exams. So let's start with the revision. Accounting standard to valuation of inventories. In the most simple sense, inventory would mean the stock of goods in which the enterprise deals in. So based on the nature of the business of the enterprise, it could be a manufacturing organization, it could be a trading organization, it could also be a service oriented organization. So if it's a manufacturing organization, it would buy raw material and convert it into finished goods. So the inventory of a manufacturing organization would comprise of the stock of raw material, the work in progress, the finished goods, some packing material and stores and spares as well. But if we are talking about a trading organization would purchase goods and sell those goods in the same condition. So the inventory of a trading organization would be comprising of finished goods or traded goods. In case of a service oriented organization, based on the nature of service, it could either have no inventory or it could have some inventory of, let's say, consumables or some inventory of finished goods which it would sell during the course of rendering of these services. So let us have a look at the definition of inventory. Inventory has been defined by accounting standard 2 as inventories are asset held for sale in the ordinary course of business. So here we are referring to finished goods because finished goods are held for sale in the ordinary course of business. In the process of production for such sale, we are referring to work in progress. So it's in the intermediary state. It has moved on from the raw material state, but it has not reached till the finished goods state. This is basically the conversion process or the conversion state where the raw material is being converted or transformed into the finished goods in form of materials and supplies to be consumed in the production process. So here we are referring to raw material, packing material and stores and spares which will be used in the production process. Now we look at certain inclusions and certain exclusions from inventory. It says inventories includes material, maintenance supplies, consumable, loose tool awaiting use in the production process. So these items will be used in the production process, whereas inventory do not include, so these do not form part of inventories, those spare parts, service equipment and standby equipment which meet the definition of accounting standard 10, which is PP. So basically this standard says that it is held for use. See, we saw that in the definition of inventory it says held for sale. Accounting standard 10 says it is held for use and it will be used for a period of more than 12 months. So if your spare part, service equipment or standby equipment is of a nature which meets the definition of AS 10, means it is held for use in the business and it will be used for a period of more than 12 months, then it will not form part of inventory but it will qualify as PP as per accounting standard 10. Now we look at the measurement rule, right? It says that inventory should be valued at lower of cost and net realizable value. Basically this concept is on the basis of prudence or maybe we can say conservatism, right? It says that when you are valuing the inventory, you should look at the cost of the inventory, you should look at the net realizable value of the inventory, and whichever is lower you should value your inventory on that basis. So let's say if the cost is 100 and the net realizable value is, let's say, 150, right? Net realizable value you can assume is a selling price. So if the cost is lower, then the net realizable value will value at cost because we will not recognize a profit, we will not inflate the value of our inventory. But let's say if the cost is 100 but the net realizable value of the inventory is 80, means we purchase it for 100 but now we are going to sell it for 80. So there is a probable loss which we could face, right, of rupees 20. So it says now value your inventory as 80 and recognize a loss which you would let's say incur in the future, right? So therefore the valuation norm, inventory should be measured at lower of cost and net realizable value based on the concept of conservatism. Now we look at the various components of cost. The cost would comprise of three components: the cost of purchase, the conversion cost and other costs. If we talk about cost of purchase, in case of a manufacturing organization, cost of purchase would have cost of purchasing raw materials, but in case of a traded organization, it would be cost of purchasing the finished goods which is going to sell. The conversion cost will basically come into picture only in case of manufacturing organization which buys raw material and then converts it into the finished goods. So let us look at each of these components. First of all, cost of purchase. So cost of purchase is very simple. We'll have the purchase price of the raw material, the finished goods as the case may be, which is quantity into rate. If there is any trade discount or rebate, we will deduct from there. If there are any non-refundable duties and taxes. So look at GST. GST is the sales tax currently which is levied in India. GST is a refundable tax. You will not add GST here, but if there is a tax of a nature of which you do not get an input credit, you will have to add it here. Add directly attributable expenses. These directly attributable expenses are those expenses which are necessary to bring the goods from the supplier's premise to our premises. These are to be included in the purchase cost. So these are basically freight, carriage inward, transit insurance, etc. and we get our cost of purchase. Then we look at the conversion cost. Conversion cost is basically the cost incurred in converting the raw material into finished goods. So these are of two category: costs which are directly related to per unit of production and systematic allocation of indirect production overhead. Let us look at them. Let's take an example. We are into manufacturing of shirts. So basically the amount which we pay, let's say, to the labor for cutting the fabric, then stitching the fabric, ironing the fabric, right? That can be attributable to the per unit of production. For example, to cut a particular fabric for making a shirt, we pay them 30 rupees. To stitch that cut fabric and make it into a shirt, we pay 50 rupees. To iron a particular shirt, let's say, we pay 5 rupees. So these are directly related to per unit of production, means these are directly related to per shirt. Then we have certain expenses which are related to the production activity but which cannot be directly attributable to per unit of production. For example, let's say rent of the factory premises. Can we say how much rent are we paying per unit of shirt? No. Rent is paid on an overall basis. Similarly, electricity, similarly depreciation, similarly let's say salaries of various employees, maintenance staff, etc. which are there. These are expenses relating to the manufacturing but they cannot be directly attributed to a particular unit of production. Therefore, we have to allocate it to the cost of the finished goods, right, on some reasonable basis. Therefore, it's a systematic allocation of indirect production overheads. These indirect production overheads can be categorized into two categories: variable production overheads and fixed production overhead. What are fixed production overhead? These overheads are of a nature the amount of which remains constant irrespective of the level of activity. Let's take an example. Let's say factory rent. If I manufacture 0 units, still I have to pay the same amount of rent to the landlord. If I manufacture 500 units, I have to pay the same amount of rent. If I manufacture 5,000 units, still I have to pay the same amount of rent. So these expenses are such which will remain constant, which will remain same irrespective of the level of production. Whereas variable overhead is something which directly varies with the units of production. For example, let's say the electricity charges. If the factory operates for 8 hours, the charge will be different. If the factory operates for 12 hours, the rate will be different. If the factory operates 24 hours, the amount of electricity bill will be different. So these vary with the volume of production. Now, while calculating the per unit rate, right, of fixed variable overhead, fixed production overhead and variable production overhead, what is the denominator that we need to take for calculating the rate? Because we know that the rate is calculated as amount by unit of production. So the allocation of fixed production overhead should be based on the normal production capacity of the production facility, whereas in case of variable production overhead, right, the rate should be calculated based on the actual production. Let us have a look with the help of an example. First, we'll talk about allocation rule for fixed production overhead, right? So it says when the actual production is approximately equal to the normal capacity. What is normal capacity? Normal capacity is the average production which the manufacturing facility has achieved over a period of time. That is treated as the normal capacity. So it says that the actual production which you have done during the year is approximately equal to your normal capacity. Then for the calculating the rate, you need to take normal capacity as the denominator. But if your actual production is less than your normal capacity, still you will not take the lower number, but you will take the normal capacity as the denominator for calculating the fixed overhead rate. But if your actual production is more than the normal capacity of the factory, then you need to use the actual actual production that you have achieved during the year for calculating the fixed overhead rate. Let us take an example. Let's say if your total production overhead is 20 lakh, fixed production overhead is 30% and variable production overhead is 70%. So 30% of 20 lakh, 6 lakh is fixed production overhead and 14 lakh is basically a variable production overhead. Your normal production capacity is 10,000 units. So over a long period of time, on an average during a year, you produce 10,000 units. Now there are three cases which we have taken up, right? Please follow this example very carefully. First, if your actual production is 9,980 units, so it's basically approximately equal to your normal capacity. Whereas in the second case, your actual production is 8,000 units, so your actual production is less than your normal capacity, right? And basically in case of your actual production is 12,000, then you would say that your actual production is more than your normal production capacity. So in case it's approximately equal, and in case if it is less, you take normal capacity as your denominator, and in case actual production is more than your normal capacity, then you take the actual production as your denominator. So let us calculate the rate. So fixed production overhead, we have calculated 6 lakh as fixed production overhead divided by 10 lakh, which is my normal capacity. We have 60 per unit. In the second case also 6 lakhs is the fixed production overhead. We'll take the normal capacity as the denominator, 60 is per unit rate. But in the third case, 6 lakh is the fixed production overhead and 12,000 is the actual production, which is more than my normal capacity. In this case, our fixed production overhead rate is 50. Basically, the logic is that if there is inefficiency, you do not reduce the denominator and increase the per unit rate. But if there is efficiency, you are operating at more than your normal capacity, you should get the benefit, right? And your cost of production should be less. Then in case of variable overheads, if the rate is the method of calculating the rate is very simple. You need to take the actual production. So 14 lakh is your overhead, 9980 in the first case, 8,000 in the second case, and 12,000 in the third case. So what you need to remember, variable overheads, it is to be calculated on the basis of actual production. In case of fixed production overhead, if it approximates or if it is less, you take normal capacity, but the actual production is more than your normal capacity, then you will take your actual production overhead to enjoy the benefits of the efficiency. Now we'll talk about joint product and byproduct. See, this is a scenario where in a particular production process, right, there are two or more than two outputs which you achieve. For example, let's say we grind wheat to let's say convert it into atta or flour. So if we put the wheat into the grinding machine, there are two types of powders which will come out. One which will be atta and other powder will be maida, which will automatically come out in the production process. Now these can either be treated as joint product or these can be treated as byproduct. So what is important, that there is a single production process, you put in certain inputs and you get two or more than two outputs in that production process. Then these two or more than two outputs can either be treated as joint products or they are to be treated as byproduct. When do you call them as joint products? When the value of these two or more than two products is more or less similar, right? Then you call them as joint product. But in the production process, let's say you get two products, the value of one product is very, very insignificant as compared to the value of the other product. Then in that case, the product which is insignificant will be treated as byproduct and the product with significant value will be treated as the main product. Now the problem is that there is one input, but there are two or more than two output. So how do we allocate this cost of one input over the production of two or more than two output? That is what we are going to learn here. So joint product and byproduct production process may result in more than one product being produced simultaneously. These product can either be treated as joint product or there could be a scenario of a main product and a byproduct. Both products are of more or less similar value, right? When both the products are more or less significant or similar value, we will say that these products are joint products. But if, let's say, the byproduct, they are immaterial as compared to the main product. So the product which is immaterial will be treated as byproduct and the other product which has a significant value will be treated as main product. Now let's talk about the valuation rule. In case of joint product, allocation based on relative sales value of each product. But in case of byproduct, you will value the byproduct as its net realizable value, means you will assume the cost of the byproduct to be its net realizable value, because that value in itself is very insignificant. And what will you do? From the total cost incurred in the production process, you will reduce the NRV of the byproduct, you will get the cost of the main product. Let us have a look at it with the help of an example. First, we'll take an example of a joint product. Let's say our total production overhead is 20 lakhs. By incurring this production overhead, we get two products, joint product A and joint product B. The production of A is 10,000 units and production of B is 12,000 units. The selling price per unit of A is 500 and the selling price per unit of B is 460. So here we have sales value of product A as 50 lakh and sales value of product B as 55 lakh 20,000. So comparatively they are more or less significant or similar value. So how do you allocate this 20 lakh of joint cost which has been incurred in producing these two products over product A and product B? You need to do it on the basis of ratio of their relative sales value. So basically you need to apportion this 20 lakh in the ratio of 50 lakh is to 55.20 lakh. So cost of joint product A is 20 lakh, which is the production overhead, divided by 50 lakh plus 55.2 lakh into 50 lakh, we'll get the joint product cost of joint product A. Similarly for B, 20 lakh divided by 50 plus 55.2 into 55.2, we'll get the cost of joint product B. So this is how the allocation of the cost has to be done. It has to be done in the ratio of the sales value of the joint product. Now we'll talk about byproduct. That's a similar. We have a total production overhead of 20 lakh. Here we have a production of steel, which is the main product, and in the production process certain oils have been generated, which is the byproduct, right? We have produced 500 liters of oil and the NRV per liter is 20. So the value of byproduct will become 20 liters into 20 per liter, 10,000. How we'll calculate the cost of the main product, which is steel? Total production overhead is 20 lakh, whereas the NRV of byproduct is only 10,000. The cost of the main product will be calculated as 20 lakh minus 10,000, which is 19 lakh 90,000. Now we'll move on to the next category. We covered the cost of purchase, we covered the conversion cost. Now we'll talk about other costs. These other costs are basically those costs which are incurred in bringing the inventory to its present location and condition. For example, we got an order from a customer and we need to design the product first and then manufacture that product. The cost which we incurred in designing that product will also form part of the cost of the inventory. Now we'll talk about certain exclusion. Interest and borrowing cost will not be considered as part of inventory unless our inventory is a qualifying asset as per accounting standard 16. That means the inventory takes a substantial period of time to get ready for its intended sale. Exchange difference fluctuation will never be included in the cost of the inventory. You need to remember these specific exclusion. These are very important, right? These type of costs will never be included in the cost of inventory. Abnormal wastages of material, labor and other production overhead. Please remember, abnormal wastage is never part of your cost of inventory, but normal wastage is part of the cost of your inventory. We'll have a look at it with the help of a practical example. Storage cost will never form part of the cost of inventory unless storage is incidental. For example, let's say when you are brewing a wine, right? So you need to store it at certain stages, right? In that case, maybe the storage cost will become part of the inventory, but generally storage cost will not be part of your inventory. Administrative overhead, which do not have anything to do with bringing the inventory to its present location and condition, will not be considered, and selling and distribution cost will not never be considered as part of inventory. Now we'll talk about cost formula, right? While you're doing the valuation, right? For calculating the cost of the inventory, in certain circumstances, we need to use certain cost formulas. Now, which cost formula to use will depend upon the nature of the inventory. If we talk about the nature of the inventory, inventory can be categorized into two categories. One which is not ordinarily interchangeable, other which is ordinarily interchangeable. Let us have a look at an example. For not ordinarily interchangeable, it says that the nature of the inventory is such that if you mix the item of inventory with other similar items, each item will not lose its identity. You will be able to identify specific cost of each item of the inventory. Let's take an example. Let's say we deal in mobile phones. We purchase 500 Samsung A7 mobile phones, right? These mobile phones are purchased at different prices and these are stacked in our warehouse. So now since these are purchased in various prices, we need to identify the cost of each mobile phone. Can we do that? Answer is yes, right? Because each mobile phone will have a separate and a different IME number, and with the help of this IME number, we'll be able to assign the cost to this particular phone. But if we talk about ordinarily interchangeable, these are such inventories which is mixed with other similar item, the inventory will lose its identity, will not be able to assign specific cost of this identity. Right, inventory. We'll take an example. Let's say we are into selling of sugar. There's this drum. We purchase certain quantity of sugar at 50 per kg and we put it in the drum. Then we purchase at 51 per kg, we put it into this drum. Then we purchase at 52 per kg and we put it into the drum. And then we keep on selling the sugar from this drum. At the end, some quantity of sugar is left. Will we be able to tell how much of quantity is of 51, how much is of 50 and how much is of 52? The answer is no, because once they are mixed, we are not able to identify the specific cost. So in this case, we need to use certain cost formula to calculate the cost of the inventory. So let us have a look. If it is not ordinarily interchangeable, there is no problem in identifying the cost of specific inventory. So the cost formula to be used is basically specific identification of cost method, because we know specifically what is the cost of each item. But if it is ordinarily interchangeable, let's say we purchase, let's say 100 kg, 200 kg, 300 kg. Total 600 kg we purchase, 400 kg sold, 200 kg is my closing stock. Can I tell that this 200 kg how much is of 50, 51 and 52? Answer is no. So here we need to use certain cost formula to calculate the cost of the inventory. So here the accounting standard 2 says that either you can use the weighted average method or you can use the FIFO method for calculating the cost of such inventory. It also says that other techniques like standard cost and retail method may be used for convenience, but these have to be used only when the answer calculated, that the value calculated by using this method is approximately equal to the actual cost of the inventory. Then we'll talk about net realizable value. We're done with the cost Excel. Now net realizable value would generally mean the estimated selling price of that inventory less certain expenses which are necessarily incurred in selling those inventory. So we know generally inventory can be categorized into 3 categories, which is raw material, work in progress and finished goods. So we'll understand how do we calculate the net realizable value of each of these category of inventory. So net realizable computation based on type of inventory. So if we talk about finished goods, net realizable value is estimated selling price minus cost necessary to make the sale. Matlab these are those expenses which are necessary to be incurred if you want to make a sale. For example, we have a CNF agent, we have a commission agent. All our inventories are sold through this commission agent. So whenever we make a sale, we need to pay a commission to this person. Maybe we have a contract with customers that it is our responsibility to deliver the goods to the customer. So if we are making the sale, we will have to incur the transportation cost. So these type of expenses which are necessary while you are making the sale will be reduced from the estimated selling price to arrive at the net realizable value. Then in case of work in progress, we calculate the NRV. The first question which comes in our mind is, okay, sir, we do not sell our work in progress, then why do we need to calculate the NRV and do a comparison with cost and NRV? See, although we don't sell our work in progress, but still what happens is that this work in progress will be converted into the finished goods, and if the total cost of finished goods is greater than the net realizable value, there's a foreseeable loss which we are sitting on. That is why we need to calculate NRV of work in progress as well. So how do we calculate? We'll have the estimated selling price, from which we will reduce the estimated cost of completing that inventory, because still it is an unfinished form, less cost necessary to make the sale. This will be the NRV. We will compare it with the cost, whichever will be lower will be the value of work in progress. Now we'll talk about net realizable value of material and supply. So basically we are talking about raw material. Again the same question, that raw material will be used in making finished goods. We are not going to sell the raw material as such in the market. Why do we need to calculate the NRV? The answer remain the same, because you will convert the raw material into finished goods and that finished goods will be sold in the market. If after converting, right, the cost and the NRV of the finished goods is lower, then there's a probable loss which you will incur. So there might be a scenario that you might not even make the finished goods, you might sell the raw material as such to minimize your losses, right? So for various reasons it is important to calculate the NRV of raw material as well. Now how do we calculate this? Right, what we need to do, we need to first check that of the raw material, the finished goods that we will make, right, at what value these finished goods will be sold. If these finished goods will be sold in profit, then we are not supposed to do anything else. The raw material will be valued at cost, because we know that the raw material will be converted into finished goods and the finished goods will be sold at profit. But if when we make the finished goods will be sold at a loss, means the cost of production of the finished goods will be greater as compared to the net realizable value of the finished goods, and also there's a decline in the market price of the material, the raw material prices are declining, then in that case we need to write down the raw material to its NRV. And what is the NRV of raw material? The replacement cost of the raw material, means at what value is raw material available when we are doing the valuation of these raw material will be treated as the replacement cost. We'll do it with the help of a practical example as well in a bit. Comparison of cost and NRV should be done on an item by item basis. For example, we have item A, we have item B, and we have item C. The cost of item A is 100, this is 150, and this is, let's say, 200. This total works out to 450. Then here the NRV is 80, the NRV is, let's say, 180, and the NRV is, let's say, 260. Here the total comes out to, let's say this is 1422 to 520. You will not calculate on the basis of 450 and 520, right? You will do it on the basis of item by item basis. Here it will be 80, here it will be 150, and here it will be 200. So this basically works out to 430, which will be your value of inventory. So you need to compare each item individually while calculating the value of inventory. Then NRV of goods held for specific purpose. This is very interesting. Normally what we do is that we do a comparison of cost and net realizable value. But if there is certain inventory which is there in our stock, of which we have a firm sale contract, means we have already entered into a non-cancelable contract, in that case so much of the portion of inventory, the NRV will be the contract price at which we have contracted to sell those inventory in the subsequent financial year. Let's take an example. NRV of goods held for specific purpose, NRV of quantity of inventory held for firm sale or service contract. What is firm sale or service contract? It's a definite contract which is a non-cancelable contract which will be executed in future. Is based on the contract price. Let us have a look at the example. Let's say quantity of closing stock at the year end is 5,000 units. Units under firm sale contract is 1,500. So out of 5,000 units, we have already made a contract for selling these 1,500 units in future, and remaining 3,500 units are not covered by any firm sale contract. The cost per unit is 200, the NRV is 180. We can see that the NRV is lower, but the contract price of firm sale contract is 240, means these 1,500 units we have contracted to sell, and it's non-cancelable contract at 240. So valuation of stock under firm sale contract, we'll be calculating it at lower of cost, or the contract price, cost is 200, contract price is 240, so 1,500 into 200. For remaining stock, we will compare 200 and 180, so 180 is lower, so 3,500 into 180, 6,30,000 is the invent. Total value will be basically 3,000 plus 6,30,000 will be the total value of my inventory. Now we'll talk about the disclosure requirement. We need to talk about the accounting policy followed for valuation of inventory, which would basically be the cost or NRV, whichever is lower. We'll say what is the cost formula that we have adopted, whether we have done on specific identification of cost basis, whether we have done it on the basis of let's say FIFO, whether we have done it on the basis of weighted average, and we'll talk about total carrying amount of the inventory, means total value of the inventory. Total carrying amount would mean total value of the inventory, and classification of inventory into raw material, work in progress, as the case may be. So by this we are done with the revision of the content portion. Now we'll start on with the practical exercise. Now we'll look at two examples, one on calculating the NRV of raw material, other on calculating of normal loss, and then we'll move on to the practical exercise. So let's start on with the example. Example on NRV of raw material. Follow this very closely. Let's say the cost of the raw material is 800. the current replacement cost of this raw material is 750. So there is a decline in price of the raw material. We purchased it for 800 and now it is selling in the market for 750. The estimated selling price of the finished goods in the first case is 1250 and in the second case it is 1000. So we have taken two scenario, case A and case B. The estimated conversion cost means the cost incurred in converting the raw material into the finished goods is 300. We need to calculate the NRV of raw material. We need to calculate how the raw material will be valued, whether it will be valued at cost or whether it will be valued at NRV, which is the replacement cost. So first we look at the solution. So it says total cost of the finished goods. See, the cost of the raw material is 800 and conversion cost is 300. So the total cost of producing the finished goods is 1100. In the first case, the NRV is 1250, which is more than the cost. So we have said that while we are calculating the NRV of raw material, if the finished goods is to be sold at a profit, we don't need to do any adjustment and the raw material is to be valued at its cost. But in the second case, the cost of the finished goods is 1100 and the NRV is 1000. So here there is a probable loss, right? Once we convert the raw material into finished goods and we sell it in the market, there is a probable loss we will incur. So in this case, we need to value the inventory at its NRV, which is its replacement cost, which is 750. So let us look at both the cases. Case A, we say that the selling price is 1250 whereas the cost is 1100. There's a profit of 150 that we will be earning. Since finished goods will be sold at a profit, no adjustment is required. Raw material will be valued at cost of rupees 800. In the second case, the selling price is 1000 and the cost is 1100. So there's a foreseeable loss which we may incur of 100. Since finished goods will be sold at a loss, raw material is valued at its NRV, which is its replacement cost, which is to be valued at 750. Now we move on to the second example, which is an example on normal loss. See, we had seen that in case of specific exclusions, we have discussed that the cost of the inventory will not include abnormal wasted material, labor and overhead. So we need to exclude the abnormal wastages and charge it off to the PL. It should not form part of the cost of the inventory. But in case there is a normal loss is something which is unavoidable, right? Which will be incurred, right, without any fault, right? It is basically because of the inherent nature of the goods is such that these losses will be incurred. For example, if you are transporting some liquid or petrol, etc., from one place to another, right? If there will be some evaporation, there will be some leakages, etc., because that is inherent to the nature of that particular item of inventory. So let's have a look. In the production process, normal wastage of input is 5%. So 5% to the extent of 5% we'll consider as normal, and normally this is unavoidable nature. 5,000 metric ton of input were put in the process, resulting into a wastage of 300 metric ton. So on the basis of normal wastage, if we say 5,000 metric ton into 5%, the normal wastage would have been 250 metric ton, but the actual wastage is basically 300 metric ton. So we have abnormal wastage of 50 metric ton, which is the difference between 300 and 250. Cost per metric ton is rupees 100. The entire quantity of waste is on stock at the year end, so we need to value the inventory and the value of abnormal loss. So we say that the total wastage is 300 metric ton less normal wastage, which is 5,000 into 5% of normal percentage, which is 250, and our abnormal wastage works out to 50 metric ton. Now let us have a look at the value. See, we'll have a closing stock of 4,700 metric ton. How? 5,000 unit was in input, 300 unit is loss, and then 4,700 unit is in closing stock. How we will do the valuation? Let us have a look. The value of inventory will be cost divided by total quantity minus normal loss quantity into the closing stock quantity. So 5,000 is the quantity which was purchased at 100 per metric ton, divided by 5,000 into 5,000 minus 250, which is my normal loss quantity, right, into the quantity of closing stock. We'll get the value of the closing stock. Value of inventory, this will basically be the value of abnormal loss. Total cost divided by total quantity minus normal cost quantity into abnormal loss quantity, which is 50. So 5,000 into 100 divided by 5,000 minus 250, which is my normal loss quantity, into 50, which is my abnormal loss quantity, right, and we'll get the value of abnormal loss, right? So this is how we'll make a calculation when we need to calculate the value of inventory and the abnormal loss in case there is a normal and an abnormal loss which is simultaneously there, right? Always remember that while you are calculating the per unit rate of inventory from the total quantity, you will always have to reduce the normal loss quantity. Then we'll move on to the practical exercise. Let us start on with practical exercise. Sum number 1. Sum number 1 is absolutely similar to the example on normal loss which we have done. So we'll quickly go through it. It says Capital Cables Limited has a normal wastage percentage of 4% in the production process. During the year 13-14, the company used 12,000 metric tons of raw material costing 150 per metric ton. At the end of the year, 630 metric ton of wastage was in stock. The accountant wants to know how this wastage is to be treated in the books of account. Explain in context of AS to the treatment of abnormal loss, and basically it will be normal loss, and also find out the amount of abnormal loss if any. So in any AS based question, we already know that it has to be divided into three paragraphs. First paragraph we'll have to state the requirement of the particular standard. Second paragraph will be our analysis of the case which has been provided toward, and the third paragraph there should be a conclusion as to what is the treatment according to the standard and based on the facts of the case. So we'll say, as per accounting standard 2, valuation of inventory, abnormal amount of wasted material, labor, production overhead excluded from the cost of the inventories, and such cost is recognized as an expense in the period in which they are incurred. Normal losses will be included in determining the value of the inventory. So let's have a look at the computation. We have been told that the total wastage is 630 metric ton, whereas the normal wastage is 4%. So 12,000 of input into 4%, which becomes 480. So 150 metric ton is our abnormal wastage. So we'll calculate the abnormal wastage, total quantity into rate per unit divided by total quantity minus the normal loss quantity into the abnormal loss quantity. We'll get the value of abnormal loss. Value of closing stock, again same, total quantity into the per unit rate. This is my total quantity minus the normal loss quantity into this is my closing stock. We'll get the value of closing stock as well, right? We'll move on to the second question. It says the closing stock, the closing inventory at cost of company amounted to 2,84,700. So this is our total inventory cost at the year end. The following items were included in the cost in the total. So these items are included in this 284,700. 400 coats which had a cost of rupees 80 each, and normally they were being sold at 150 each. Owing to some defect in manufacturing, they were all sold after the balance sheet date at 50% of the normal selling price. So 50% of the normal selling price would mean rupees 75, because normal selling price is 150 and the cost per unit is 80. So we can call this as the NRV, because after the year end this has been sold at 75. Selling expenses amounted to 5% of the proceeds, of 75 into 5% will be the selling expenses per unit. So how do we deal with it? It's very evident that the cost is 80 whereas the NRV is 75 minus 5% of expenses. So we'll say cost or NRV, whichever is lower, and it will be valued as NRV. 800 skirts which had a cost of 20 each, right? These two were found defective. Remedial work in April cost 5 per skirt, and selling expenses for the batch totaled 800. They were sold at rupees 28. So the NRV of this item is basically 28, but there are certain expenses which are incurred. So here we need to see the total value of inventory according to AS. To in this case again we will say that inventory is which are damaged or which are partially or obsolete, right? And there is a decline in the selling price, we need to make an adjustment. The estimate of net realizable value are based on most reliable evidences which are available at the balance sheet date, though the subsequent selling price is the most reliable evidence of the NRV. Fluctuation in price or cost directly relating to the event occurring after the balance sheet date, to the extent such event confirm the condition existing at the balance sheet date, needs to be worked upon, because the inventory was defective, etc. So subsequently when it is sold, it provides a further evidence. Now let us have a look at the computation. Computation based on accounting standard 2, right? The total cost of the inventory is 2,84,700, which includes the cost of the above coat and skirts. So we'll say total cost is so much, decline in value of 400 coats. See, the cost of the coats is 400 into 80, whereas the NRV is 400 into 150 का 50% which is 75 and minus this is the selling expenses of 5% or 75, so this works out to 28,500. So this will be the value of the inventory. Currently it is included at 32,000, but we need to bring it down to 28,500, so we need to reduce 3,500 from this to bring it down. But in case of skirts, right, see the cost of the 800 skirt is 800 skirts into 20 per unit, 16,000. If we talk about the NRV, the estimated selling price is 28, so 800 into 28 is the estimated selling price. There are certain costs which are necessary to make the sale. First, we need to make certain repair work to the skirts, and we need to incur certain selling expenses. So cost of repairs is 5 per unit and the selling expenses is 800. So the NRV works out to 17,600. Cost is 16,000 whereas NRV is 17,600. So it should be valued at cost and it is included in the cost, so we don't need to make any adjustment, right? Since the net realizable value is greater than cost, no adjustment is required in case of skirts. So whatever adjustment was required in case of coat, we did the adjustment because it was included at cost. We need to include it at NRV, so we reduce the difference between cost and NRV to arrive at the NRV. Let's move at the next question. The raw material inventory of a company includes certain material which is purchased at rupees 100 per kg. The price of material is on a decline and the replacement cost of inventory is 75 per kg. So we purchase it at 100, but currently the replacement cost, if we buy the same raw material right now, it will cost us 75. It is possible to convert the material into finished goods by incurring a conversion cost of 125. So basically the cost of raw material is 100, the conversion cost is 125. So 225 will be the total cost of my finished goods. Decide whether to make the product or not to make the product if the selling price is 175 in case 1 and 225 in case 2. See, it's very clear. The total cost of finished goods will be 225. And if it will be sold at 175, there is no point in making this. Why? Because by making this, we will incur a loss of 50 rupees, which is the difference between 225 and 175. But if we don't make it and we sell the raw material as such in the market, right? We purchase it for 100, we can sell it off at 75. Na? So there will be a loss of 25. So what is better? To incur a loss of 50 after making the finished goods, or to sell the raw material as such in the market, right? And incur a loss of 25. Obviously we'll have to minimize our losses, so we'll not make the product. In the second case, it says that you can sell it at 225. So in this case, there will be no loss because our cost of production will be 225 and we'll be selling it at 225, so there will be no loss. But if we sell the raw material as such, we will incur a loss of 25 because we have purchased it at 100 and we'll be able to sell it at 75. So in the second case, it is better to make the product and incur no profit, no loss. So let us have a look at it. It says as per AS2, materials and other supplies held for use in production of inventory are not written down below cost if the finished product in which they will be incorporated is expected to be sold at or above cost. So if you are able to sell your finished goods at profit or maybe at cost, then you don't need to make any adjustment to the value of raw material. But if the finished goods is going to sell at a loss, then you need to value your raw material at NRV, which is the replacement cost. However, where there is a decline in the price of material and it is estimated that the cost of the finished product will exceed the net realizable value, material are written down to its net realizable value and the replacement cost of the material is considered as the best measure of the net realizable value. So here the cost of raw material is 100, the conversion cost is 125, the total cost will work out to 225. In the first case, if the estimated selling price is 175, there will be a loss of 50. Right, by making the product. In such case, the product should not be made and the raw material should be valued at 75, which is the replacement cost. In the second case, the estimated selling price is 225. There will be no profit or loss. The product should be made. The raw material should be valued at 100 because there is no foreseeable loss which the enterprise will incur. Then, question number 4, Mr. Mehul gives the following information relating to items forming part of inventory on 31st March 15. His factory produces product X using raw material A. So this finished goods is basically product X and his raw material is basically A. 600 units of raw material A purchased at 120, the replacement cost of raw material A at the year end is 90. So here there is a decline in the cost of the raw material. We purchased the raw material at 120, but the replacement cost of the raw material is 90. So we need to look at how we need to value it. It cannot be only based on 120 and 90. We need to see that the finished goods, whether it will be sold at a profit or loss. If the finished goods can be sold at a profit, we will value it at 120. If the finished goods can be sold, it will be sold at a loss, then we will value this raw material at 90. 500 units of partly finished goods, which is work in progress, in the process of producing X, and the cost incurred till date is 260. So this is the cost of my work in progress. These units can be completed in the next year by incurring an additional cost of 60. So this is basically cost necessary to complete, since it is unfinished. Further 60 will be incurred to complete the product. 1500 units of finished goods X is there in the stock. Total cost incurred in producing it is 320 and the expected selling price is 300. So obviously this finished goods need to be valued at 300, because we will compare cost and net realizable value. Cost is 320, net realizable value is 300. So obviously it should be valued at 300. Right? Determine how each of the item of inventory will be valued, and also calculate the total value of inventory as on 31st March 15. So basically what we need to see is, first, when you are doing the calculation for raw material, the cost of our raw material is 120, right? And once we try to complete this raw material, see what will be the total conversion cost. 260 is something which is already incurred, and 60 will be incurred in future. So 260 plus 60 is total conversion cost. So how much will it cost? It will be basically 440 will be the cost of finished goods, whereas the selling price of the finished goods is only 300, which is the NRV. So obviously here there will be a loss. We need to value raw material at 90. If we talk about the work in progress, the selling price, right, the NRV is, or the estimated selling price is told to us is 300, and we will incur additional expenses to complete of 60. So basically 240 becomes the NRV of WIP, whereas the cost which we have incurred till date is 260. So here the NRV is lower, so it again has to be valued at its NRV. And then finished goods we have already talked about. So here first in the paragraph we will talk about the valuation norm of how the NRV will be calculated for basically the finished goods, the raw material and the work in progress. Now we'll do the analysis of the case. 600 unit of raw material will be written down to its replacement cost of 90 per unit as the net realizable value of finished product in which the raw material will be incorporated is below its cost. Then for 500 units of partly finished goods, we know the estimated selling price is 300, estimated cost to complete is 60. We don't have detail of selling expenses, otherwise the selling expenses would have been deducted. So NRV is 240, whereas the cost is 260, so it has to be valued at its net realizable value, which is 240. Then for 1500 units of finished product, obviously 300 is lower than 320, of course it has to be valued at 300. So raw material 600 unit at 90, which is the NRV. Partly finished goods 500 unit is 240, which is the NRV. 1500 units of finished goods at 300, which is the NRV, which this will be the total cost of my inventory. Let's move on to question number 5. A Limited is engaged in manufacturing chemical Y from raw material X. So this is my finished goods, this is my raw material, right? The company provides you with the following information for the year ended 31st March 17. Raw material X, the cost price is so much, unloading charges, freight is so much, so this will be considered as directly attributable expenses, and the total cost here would be calculated as 440,380 plus 20 plus 40, whereas the replacement cost is only 300, so there is a decline in the price of the raw material. Chemical Y, material consumed is 440, which is the total cost of the material. Direct labor is 120, variable expenses is 80, so these are the conversion costs. Additional information is the total fixed overhead for the year is 4 lakh and the normal capacity is 20. So we know that we calculate the fixed overhead based on the normal capacity. They haven't given us the information of actual production during the year. So 4 lakh divided by 20,000, right? This will give us basically 20 per unit. So here our fixed overhead rate becomes 20 per unit. So total cost of finished goods is basically 740 works out to be the total cost of the finished goods, right? Then we'll say, we'll see that the closing balance of raw material X is 1000 units, finished goods is 2400 units. You are required to calculate the total value of closing stock of raw material and the finished goods according to AS2 when the net realizable value of chemical Y, which is the finished goods, is 800 and is 600. So see, in the first case, I am seeing that the total cost of production is 740 and the net realizable value is 800. So the finished goods will be sold at a profit. So in case of raw material also, raw material will be valued at cost and the finished goods will also be valued at cost. But in the second case, the total cost of production of the finished goods is 740, but the NRV is 600. So in this case, the raw material will be valued at its replacement cost and the finished goods will be valued at its NRV, which is rupees 600. So let us look at the drafting. So here again you read this text, it basically talks about what is NRV and how the NRV is calculated, etc. Let us come to the computation. Calculation of cost per unit. 380 is the purchase price, 20 is the unloading, 40 is the freight, 440 is the total cost of my raw material. Then cost of finished goods, material consumed is 440, direct labor 120, variable overheads is 80 and fixed overhead is 20. So this works out to 660. I think I made a mistake while adding it here. It should not be 740. It should be 660. This is basically, this works out to 0, 8 plus 2, 10, 12, 16, 16, 1. This is 660. So still in the second case, the NRV is 600 and this is 660. So the things remain the same. So 660. So in the first case, if the net realizable value is 800, the finished goods is selling at profit. So in this case, NRV of chemical Y is 800, which is greater than the cost of 660. Hence, both raw material and finished goods should be valued at cost. In the second case, so this is the total value of 1000 into 440, which is the cost, and 2400 units into 660, which is the cost. This is the total value of the inventory. In this case, the NRV is 600, whereas the cost per unit is 660. Therefore, raw material should be valued at replacement cost and finished goods should be valued at net realizable value. So replacement cost of raw material has been given as 300 and the NRV of finished goods is given as 600. This should be treated as the value of inventory, right? So by this, we are done with the practical exercise of accounting standard 2 as well. Please go through each and every practical question in detail, right? I have tried to cover the major variety and hopefully that this will help you greatly in doing your preparation. Right guys, let us start on with revision of accounting standard 3, cash flow statement. Cash flow statement is part of our financial statement. This standard is mandatory for level 1 enterprise and this standard is also mandatory for all companies because as per the definition of financial statement in the Companies Act 2013, it says that a cash flow statement is a component of the financial statement. So all the companies need to present the cash flow statement. But some companies have been given exemption from preparation of cash flow statement, such as a startup private limited company, a small company, 1% company and dormant company have been exempted from the requirement of making a cash flow statement. Now let us understand what do we mean by a cash flow statement. In the most simple sense, cash flow statement is a summarized cash book. It is the summary of our cash book grouped into 3 major categories, which is operating activity, investing activity and financing activity, in which we present the inflow and outflow of cash and cash equivalent divided into these 3 activities. Why do the user of the financial statement need to have a look at a cash flow statement? Because the user of the financial statement should get the information of on what all activities the enterprise has implemented its cash resources and what all activities the enterprise has earned its cash resources, right? So cash flow statement, it is mandatory for level 1 enterprise. It is also mandatory for all companies, because the definition of financial statement under 2 subclause 40 says that the financial statement should include cash flow statement. What is a cash flow statement? It is a summarized cash book. It summarizes the inflow of cash and cash equivalents, right? It summarizes the inflow and outflow of cash and cash equivalent during the period, right? And it is grouped into the 3 activities which we spoke about. Now, since it presents the inflow and outflow of cash and cash equivalent divided into these 3 activities, let us understand what do we mean by cash and what do we mean by cash equivalent. Cash has been defined as cash on hand, which is normally the liquid cash resource which you have, and the demand deposit. Demand deposit would mean that the current account, right, the current account in which the business is holding its money. So cash would mean cash in hand and cash at bank. Cash equivalent, let us have a look at the definition and then I'll explain what does cash equivalent mean. Cash equivalent have been defined as they are short term, highly liquid investments, readily convertible into known amount of cash and which is subject to insignificant change in value. So these are certain investments which the enterprise has made, and the nature of these investments is such that these are short term. Short term means that the investment tenure is less than 3 months. These are highly liquid, right? So whenever you want, you can dispose of these investments and convert it into cash. They are readily convertible into known amount of cash. So you exactly know at each point of time that what is the amount that you will realize when you convert this investment into cash, and these are subject to insignificant risk of change in value. There is no risk of change in value. So normally marketable securities, fixed deposits, etc., which are of a tenure of less than 3 months will be considered as cash equivalent. See, when we talk about liquidity, the one of the most liquid form of investments is investments in equity shares, but it does not fall into this category because it is not convertible into known amount of cash. When I actually execute the transaction, I will get to know what value I will receive, and also equity shares are subject to a significant risk of change in value, so they will not be classified under this category. Fixed deposits, marketable securities having maturity of less than 3 months will be considered as cash equivalent. So necessarily these cash equivalents are investments, but which partakes the nature given in this definition. Now we'll talk about presentation of cash flow statement. That the cash flow statement presents the inflow and outflow of cash and cash equivalents, and these inflow and outflow are categorized into 3 categories, which is my operating activity, investing activity, and financing activity. What are operating activity? These are the principal revenue generating activities of the enterprise and other residue activities which cannot be categorized into investing or financing activities. So normally the main normal activity in which the business deals into, right, those activities will be the operating activity. Means cash flows from sale of goods, from realization from debtors, then from purchase of goods, payment to creditor, meeting the normal operating expenses of the enterprise would fall into the operating activity. Then we talk about the investing activity. Investing activity normally deals with acquisition and disposal of long-term assets and, let's say, investments which are not classified as cash equivalent, because cash equivalents are also investment but of a maturity of 3 months and meets the definition, right? Other than these investments, right, these will be covered under the investing activity. So acquisition and disposal of long term assets, which is my PPE, and other investments not classified or which do not fall into the category of cash equivalent. So when we talk about this purchase and sale of fixed assets, purchase and sale of investments, right, would normally, and then return from these investments like interest, dividends, etc., that we receive, right, will fall under this category. Then financing activity would mean how the enterprise has financed itself, right? So it brings about change, right? It brings about change in the size and the composition of owners' capital, including preference shares in case of a company and borrowings the enterprise. So it talks about how the enterprise have been financed. It brings about a change in the size. When we say size, we are talking about the amount. When we say composition, it talks about the mix of equity, preference, and the borrowings, right? So loan taken, equity shares issued, preference shares issued, debentures issued, redemption of preference share, redemption of debentures, buyback of equity shares, change in overdraft facilities, interest paid, dividend distribution, tax paid, etc., will fall into these categories. So we have an illustrative list of example under each of these categories. Operating activities: received from sale of goods or services, collection from debtors, receipt of commission, royalties, payment for purchases, payment to creditors, payment of operating expenses would normally fall under the operating activities. When we talk about investing activities: purchase of fixed assets, investment, sale of fixed assets, investment, loan and advances given, receipt of repayment of loan and advances which we have given, and interest and dividend which we receive on our investment would fall into this category. Then financing activity: proceeds from issue of shares including the securities premium amount, proceeds from issue of debentures including securities premium amount, loan taken. Then redemption of preference share, redemption of debenture including the premium which we pay on redemption, buyback of equity shares, repayment of loans which we have taken, change in your OD balances, repayment of interest and dividend distribution tax payment would fall under this category. So we divide the inflows and outflow into these major categories and we present it in our cash flow statement. When we talk about taxes, taxes are normally shown under the operating activities unless it can be directly attributed that a tax is relating to an investing and financing activity. The best example is dividend distribution tax, because we can directly attribute dividend distribution tax to the amount of dividend the enterprise is paying to its shareholders. The disclosures need to be made on gross basis, so you will not net off activities. For example, interest received and interest paid. Interest received is on investing activities, whereas interest paid is on financing activity, so you cannot show the net amount. For example, loan taken and loan repaid. Maybe I have taken 100 crores of loan, I have repaid 30 crores of loan. So I cannot show net 70. I have to show separately that I have received 100 crore, I have repaid 30 crore. You should not net off activities. Another example would be I have purchased fixed assets worth 100 crore and I have sold fixed assets worth 5 crore. I cannot show 95 as a net amount. I have to show how much of assets I have purchased and what is the outflow, and how much of assets I have sold and what is the inflow. So all the inflows and outflows have to be done on a gross basis. Now we'll talk about interest and dividend. Please remember, the interest and dividend which we receive is on our investments. It will fall under the investing activity. Interest and dividend which we pay is on the loan or the shares which we have issued, so it will fall under the financing activity. Interest and dividend received is investing activity, interest and dividend paid is on financing activity. But the major business, if our major business is of a financing nature, then the investments and then the investments which we do will become our operating activity. So in case of a financing company, interest and dividend received will become its operating activity because it's part of its operation. But interest and dividend paid will still remain its financing activity, because interest and dividend will be paid on the borrowings, on the shares, etc., right, which is part of the financing of the company. Non-cash transaction relating to investing and financing activity will have no place in my cash flow statement because there is no movement in cash. Example could be that asset acquired by issue of equity shares, right? So for example, there are cases where we issue equity shares and we get asset entries, asset to equity share. There is no movement of cash and cash equivalent, so these will not form part of my cash flow statement. How do we deal with extraordinary item? If the extraordinary item relates to operating activity, it will shown under operating activity. It is related to financing, it will shown under financing. If it relate to investing, it will be shown under investing activity, but a separate disclosure of extraordinary item have to be made under the respective category. There are two formats or the method in which we prepare the cash flow statement. One is the direct method, another is the indirect method. Under the direct method, we show the gross inflows and gross outflows of cash under each of the operating, investing and financing activity. But under the indirect method, right, the operating activity will be different. In the operating activity, we start with net profit before tax, and then we do adjustments for non-cash item, non-operating item, taxes, etc., and arrive at the cash from operations. And then the investing and financing activity will be same both under the direct method and the indirect method. So which method an enterprise will use? There is a choice between a direct method and indirect method, but for companies which are listed on a recognized stock exchange, SEBI says that a listed company has to present its cash flow statement under the indirect method. So a listed company does not have a choice, it has to follow indirect method. Other than that, there is a choice, you can make it by following the direct method or you can make it by following indirect method as well. Right, by this we are done with our revision of cash flow statement. So let us start on with revision of accounting standard 1, disclosures of accounting policy. This revision will be covered in two parts. The first part we'll very quickly cover the concepts covered in the accounting standard, and the second part we'll cover some very important practical questions related to the accounting standard, because from the core exam perspective it is extremely important that you know how to draft your answer and how to present it well so that you score full marks. So now let us start AS1, disclosures of accounting policy. This standard basically requires a reporting enterprise to make a disclosure of all the accounting policies which it has followed in the preparation and presentation of the financial statement, because it is believed that plain by reading the numbers on the financial statement you do not develop a very deep understanding of the financial statement. The basis on which these numbers are derived and put in the financial statement are extremely important to form a meaningful understanding of the financial statement, and the basis on which these numbers are derived are the accounting policies followed by the enterprise in preparation of the financial statement. For example, if the enterprise want to deal with inventory, it will look at accounting standard 2. While dealing with investments, it will look at accounting standard 13. While dealing with PP, it will look at requirement of accounting standard 10. So these standards would give the way in which the items have to be dealt with, and in turn these will be known as the accounting policies. So why do you need to make disclosure of accounting policy? For meaningful understanding of the financial statement, and once you have a meaningful understanding of the financial statement, it will become easy to compare the financial statement of various enterprise. So let us look at how the accounting policy have been defined in the standard. In the most simple sense, accounting policies would mean certain set of rules, guiding principles or conventions which the enterprise has followed and adopted in the preparation and presentation of the financial statement. So accounting policy refers to specific accounting principles and the methods adopted for applying those principles, right, by the management or the enterprise in the preparation and presentation of the financial statement. So I have already said that the various accounting policies will be derived from the various accounting standards which have been issued by the ICAI. So is there a single list, right, which the management will look at and will adopt? No, because various enterprise deal in complex and diverse scenario, right? Each enterprise will have a different line of business. They have a different compliance structure, regulatory structure, the method in which they operate will be different. So since they operate in complex and diverse economic environment, there cannot be a single list of accounting policy which could be adopted. So how do the enterprise adopt the accounting policy? It requires judgment on the part of the management. Basically, all the accounting standard will give accounting policy choices, and based on the facts and circumstances in which the enterprise is operating, the management will have to use its judgment and select an appropriate accounting policy which will reflect their operations in the best possible way. For example, accounting standard 2, it gives an option that either you can choose a FIFO method for valuation of inventory or you can follow weighted average method. So now the management will have to determine that what is the consumption pattern of their inventory, and based on the consumption pattern of their inventory, they will have to make an appropriate accounting policy. Now, why do we disclose accounting policy? Already covered better understanding of the financial statement and meaningful comparison. Now we'll talk about fundamental accounting assumptions. See, there are certain rules or conventions which are assumed to be followed and adopted by the enterprise in the preparation and presentation of the financial statement. So anybody who is reading the financial statement will assume that these fundamental accounting assumptions have been followed while preparation of these financial statements. So these fundamental accounting assumptions underlie the preparation and presentation of the financial statement. If you are following this is mandatory, you need to follow it. So if you are following these fundamental accounting assumption, you don't need to give a specific disclosure of the fact that you have followed these principles. But if you have not followed these fundamental accounting assumptions in preparation and presentation of your financial statement, then you need to make a specific disclosures that we have departed, we have not followed these fundamental accounting assumptions. What are these fundamental accounting assumptions? We normally call it as GCA. GCA. We normally call it as GCA, going concern, consistency and accrual. Let us deal with each one of them. First, going concern. It says that normally an enterprise is viewed as a going concern that is continuing in operations in the foreseeable future. It neither has the necessity nor the intention to materially curtail the scale of its operation. So whenever somebody is reading a financial statement, he or she will assume that this enterprise will continue in the foreseeable future. It neither has the necessity nor it has the intention to close down its business. Second, consistency. This principle states that you should consistently adopt and follow the accounting policies which you have followed in the prior year. So somebody who is reading the financial statement will assume the fact that those accounting policies which have been followed in the prior period are the accounting policies which have been used in the current period for preparation and presentation of the financial statement. So you should not change your accounting policies off and on. You should be consistently applying those policies over a period of time. Then accrual. See, there are two bases on which accounting is done: cash basis and accrual basis, right? So the fundamental accounting assumption is accrual basis. It says that any financial statement which has been made and presented, we'll assume that these have been prepared on the basis of accrual basis of accounting. What does these accrual basis of accounting say? That it says that the income and the expenses for the current period should be recorded in the current period, irrespective of the fact whether cash has been received or have been paid for the expenses or not. It identifies the period concept. All the income and all the expense for the period should be recorded in the period itself. Now see, we have already said that there is no single list of accounting policy, and the management of the enterprise is responsible to use its judgment and select the accounting policies. So what should be the thought process in the mind of the management, right? What should be the consideration while selecting these accounting policies? It says that whatever accounting policy you choose, you should keep in mind that when you follow those accounting policies, right, and make your financial statement, those financial statements should project a true and fair view of the state of affairs as presented by the balance sheet and of the profitability of the company as presented by the statement of profit and loss. So there are three major considerations, right, which needs to be kept in mind while you are selecting the accounting policy. These three considerations are prudence, substance over form, and materiality. The concept of prudence is that you should not anticipate profit. You should recognize profit only when you are virtually certain that the profit will be realized. But in case there is a possible or a probable loss which you are going to face, you should make a provision for it in the books of accounts. So you know this is on the premises of the principle of conservatism. Then substance over form. It says that whenever you're doing your accounting activity, whenever you're recording a transaction or an event in the books of accounts, you should look at the substance of the transaction and event rather than merely looking at its legal form. The best example of this is under accounting standard 19 when we do finance lease, right? So it is known as a finance lease. It is known as a lease arrangement from its legal form. But while we do the accounting for leases which are in the nature of finance lease, we take it as a loan arrangement and we deal it in the books of accounts as a loan arrangement. So you should look at the substance of the transaction and not merely at the legal form of the transaction if you want to give a true and fair view of the affairs of the organization. And then we'll talk about the concept of materiality. The standard says that all material items should be disclosed. So we ask, what are material items? Basically, material items are those items which have the capacity to influence the decision of the users of the financial statement. So if there's an item which has the capacity to influence the decision of the user of the financial statement, such item should be disclosed. For your benefit, I'll make a simple example so that you actually perceive the concept of materiality. Let's say there is an organization which says that it has a sale of 1000 crore, it has an expenses of, let's say, 200 crore, and there is a profitability, right? There's a profit of 800 crore. So we'll have a very positive outlook towards this company, that it's a highly profitable company. It has a margin of 80%, superb company. But as we know, we are chartered accountants, right? We say that in God we believe and rest we audit. So we drilled down and we understood that the sales of the company is only 100 and there is a sale of PPE, let's say there are certain land, building, plant and machinery which it has sold for 900 crores, and therefore the total sale is showing as 1000 crore, expense of 200 crore and profit of 800 crore. Looking at something like this, our perception towards the company will change, because we'll say that sale is 100 and expense is 200. So basically this company is a loss-making company. The 800 crore of profit is largely due to sale of PPE, which is not the normal course of business of the enterprise. So if you hide this particular item, right, the perception of the company will change. So all material items should be disclosed. Now we'll talk about disclosure of accounting policy. We have already understood that for proper understanding of financial statement, all significant accounting policies should be disclosed. Where should you disclose it? Obviously it is for the understanding of the financial statement, so you should disclose it as part of the financial statement. Where should you disclose it? Should you be scattered all over the financial statement? No. Normally our financial statement will have a balance sheet, will have a profit and loss statement, will have a cash flow statement, and there will be notes to accounts. And if you look at any financial statement in the notes to accounts, right, in the very first section it talks about significant accounting policies, and all the significant accounting policies followed by the enterprise are listed at one place, right, so that the user of the financial statement does not have to flip through the financial statement several number of times. It will get it in one place. So disclosure should be made in one place in the financial statement. Now we'll talk about change in accounting policy. See, a fundamental accounting assumption of consistency says that the accounting policies adopted should be consistent from one period to other. But when we look at accounting standard 5, it will give us an option that there are certain circumstances under which accounting policies could be changed. There are three scenarios in which accounting policy can be changed. One, when it is required by a statute, it is requirement of the law, right? Then you have to change your accounting policy. If there is a revision in the accounting standard, or the accounting standard comes up with new or revised requirement, you will have to change your accounting policy. The third option has been given to the management. If the management believe that the change will result in more appropriate presentation of the financial statement, then management is free to change its accounting policy. So if you are changing your accounting policy because of either of these reasons, what should you do? It says, if a change in accounting policy has material effect in the current year, right? You're changing your accounting policy. Because of this change in accounting policy, there's a material effect in the current year. What should you do? The amount by which the financial statement are affected should be disclosed, and if the amount is not ascertainable, you have made a change in accounting policy, but you're not able to identify by what amount your financial statement have been impacted, either wholly or in part, such fact should be disclosed that we have made a change, but we are not able to ascertain the financial impact of such change on the financial statement. Another thing, if this change in accounting policy, you made a change in the current year, but this change in accounting policy does not have a material effect in the current year, but if it can be reasonably expected to have material effect in the later period, in that case also you need to disclose the fact of the change in the year in which the change has been made, even if there is no material effect in the current period, but it is reasonably expected that there will be impact in the later period. Further, it says that if you are making a disclosure of accounting policy, or if you are disclosing a change therein, it cannot remedy a wrong or an inappropriate treatment in your financial statement. For example, we all know that AS2 gives us an option of FIFO, or it gives us an option of weighted average. What your enterprise did, it valued its inventory on LIFO, and it said that we are making a disclosure of the fact. Still, even if you are disclosing that you are making your valuation of inventory on LIFO method, still it is a non-compliance of accounting standard 2. So by this we are done with the content portion of accounting standard 1. Now let us move on to the practical exercise on accounting standard 1. See, generally there are two type of questions which will be asked. One, where they are making a change in the accounting policy and they will ask you to make a suitable note or draft a suitable note which will form part of the financial statement. Other type of question is they will put a scenario in front of you that there are certain changes has been made. You need to identify whether that change qualifies as a change in accounting policy or not. So let us have a look at the first question. It says, in the books of Prashant Limited, closing inventory as on 31st March 15 amounted to 1,63,000 and it has been valued on the basis of FIFO method. The company decides to change from FIFO to weighted average. So till now the company was following FIFO method. Now the company wants to change to weighted average, right? For ascertaining the cost of inventory from the financial year 14-15. So we have the number for 14-15. For the current year end, they want to change its method of valuing inventory from FIFO to weighted average. On the basis of weighted average method, the closing inventory as of 31st March 15 amounts to 1,47,000. So if we are following, let's say FIFO, it is 163k, and if we are following weighted average, it becomes 147k. Realizable value of the inventory on this date is 195. So there is no problem because inventory is valued at cost or net realizable value, whichever is lower, right? So cost is lower than NRV, so we don't need to look at NRV. We will choose between, we'll have to value it at cost. Discuss disclosure requirement of change in accounting policy as per accounting standard 1. First, before we draft the answer for this, you should always understand that such questions, right, on accounting standards should be answered in three portions. First, you should write the relevant text from the accounting standard, that what is the requirement of the accounting standard. The second portion of the answer will be evaluation of the case which has been given to you. You will evaluate that case based on the requirement of the accounting standard which you have stated in the paragraph 1. And then finally the last paragraph will be the conclusion paragraph, where you will basically have to state your opinion, or maybe in this case you will have to draft your note, right, based on the fact that you have to make a separate conclusion. So three paras or three parts in which it should be divided. First, the requirement of the accounting standard, then the evaluation of the case which has been given in the question, and finally the conclusion portion. So see, in this case, there is a change in the accounting policy because earlier it was following FIFO, now it is following weighted average. So if there is a change and if that has a material effect in the current period, right, and here in this case we also know the difference in the amount because the value as per weighted average, right, comes to 163. And the value as per the value as per FIFO is 163 and as per weighted average is 147. So there's a difference of 16k. And if we believe that this 16k is material, then we need to make a disclosure that we have changed our accounting policy in the current year and our financial statement have been affected by around 16k because of such change. So now we'll see how the answer has to be stated. First paragraph will definitely be quoting the text from the accounting standard. So it says, as per accounting standard 1, disclosures of accounting policy, any change in the accounting policy which has a material effect should be disclosed in the financial statement. The amount by which any item in the financial statement has been affected should be disclosed. Where the amount is not ascertainable wholly or in part, that fact should be disclosed. Then we say this is our evaluation of the case. This is the second portion. This is the first portion. In the current case, Measures Prashant Limited has changed its accounting policy of valuing inventory from FIFO method to weighted average method. So normally this portion you will get from your question itself. You can copy paste from there. Prashant Limited should disclose the change in the accounting policy by way of a note as under. So we'll draft a note and we'll say that how the change should be disclosed in the financial statement. So I'll read it through. The company values its inventory at cost or net realizable value, whichever is lower. In the current year, the company has changed the method of valuing inventory from first in first out to the weighted average method. As the management believes this reflects the consumption pattern of inventory in better way, because there are three circumstances in which you could change in statute, change in accounting standard, or on the basis of management. So there is no change in statute or accounting standard. So this is on the basis of management will, that it believes that if the inventory is valued on via weighted average, it will disclose the consumption pattern of the inventory in much better way. As a consequence of such change, the value of inventory as per weighted average method is 147 as against 163 had the inventory been valued in FIFO method. So if the value of inventory falls, the profit will also fall. Right, so as a result of such change, profit for the current period is lower by 16,000. Right, so this is how you need to present it now. Let's look at question number 2. This is question number 2. It says ABC Limited was making provision for non-moving inventory. What is non-moving inventory? Certain inventory which is there in your stock, certain goods which are there in your stock, but they have not moved, they have not been consumed, or they have not been sold off from a substantial period of time. So you have purchased it, but it has not gone out, you have not been able to sell it. So that is why we call it as non-moving item. ABC Limited was making provision for non-moving inventories based on issues for last 12 months up to 31st March 16. So what does it mean issued for last 12 months? It says that if a particular item of inventory hasn't been issued or hasn't been moved or hasn't been sold for a consistent period of 12 months, then we'll classify that inventory as non-moving and we will make a provision on that. The company wants to provide during the year ending 31st March 17 based on technical evaluation. So first method is period based method. If a particular inventory has not moved for a period of more than 12 months, we will say that it is non-moving and we'll make a provision on that inventory as appropriate. Now the management believes that a period basis provisioning policy is not correct. We should evaluate on a technical basis, right? We should look at an item basis and we should say that on the basis of this technical evaluation, should it be classified as non-moving or not. It says total value of inventory is 100 lakhs. Provision required, if you followed the earlier method of 12 months, you would have to make a provision of 3.5 lakh. Provision based on technical evaluation, if you are following the new method of calculating the provision, then your provision will be 2.5 lakhs. So how do you deal with this? See, first of all, we need to evaluate whether there is a change in accounting policy or not. Based on the facts of the case, see, the accounting policy is that the management makes a provision for non-moving or slow-moving item. That is your accounting policy. Now, how do you calculate the amount of provision is basically the method which you are using to calculate the amount of provision, and that cannot be stated as your accounting policy. So in this case, there is no change in accounting policy. Your policy is that you have to provide for non-moving item. You have to make provisions for the non-moving item. The way in which you make the provision could be changed because you will look at the most appropriate method of calculating the amount of provision. So in this answer, we will state that the decision of the management of making provision for non-moving item on the basis of technical evaluation instead of the earlier practice of provision based on 12-month issues does not amount to change in accounting policy. This is just a change in the method in which you are calculating the amount. This is not the change in accounting policy, because your policy is to make provision. The accounting policy of the company may require provision for non-moving items of inventory should be made. The method used to arrive at the amount of provision can be changed based on the facts and circumstance of the case. If the company, based on materiality, believes that the disclosure of change in the process or the method of determining the amount to be made, the following note can be presented in the financial statement. So it says generally you need to disclose if there is a change in accounting policy. But still, if you believe that the amount of change is material enough that you need to update the users of the financial statement of such an amount, you can make a disclosure. We can say in the current year the company has changed the method of determining the provision for non-moving inventory from the earlier method of making the provision on 12 months of issues to provision based on technical evaluation. As a consequence of such change, the amount of provision is lower by 1 lakh, because had you followed the earlier method, you would have made a provision of 3.5 lakh. If you have changed your method, the provision comes to 2.5 lakh, and therefore, right, the provision is lower by 1 lakh. So by this, we are done with the revision of the concepts of the accounting standard 1, as well as we are done with the practical exercise as well. Right guys, so let us start on with revision of accounting standard 10, property, plant and equipment. As usual, first we'll cover up the content portion of the standard, and then we'll discuss certain very important practical questions in relation to AS 10. See, we will first understand the historical background. Earlier AS 10 was known as fixed asset, and there was another accounting standard 6, which dealt with depreciation charge. But then subsequently accounting standard 10 was revised. It was renamed as property, plant and equipment in line with Ind AS and IFRS nomenclature, and accounting standard 6 was superseded and depreciation portion was merged into accounting standard 10. So as of today we don't have accounting standard 6, and accounting standard 10 has been renamed as property, plant and equipment. But in substance, property, plant and equipment would largely mean our tangible fixed assets. By tangible fixed assets we know that it's land, building, plant, machinery, vehicles, computer systems, office equipments and etc. Right? So now we'll start on this standard. Will give us guidance in relation to 3 aspects. First, recognition of the asset, that is initial recognition of our PP, or that to say our fixed assets. Then it will talk about carrying amount of the fixed asset, that is at what value will you carry this fixed asset at each balance sheet date after initial recognition. And then it will also provide us guidance in relation to computation and accounting for the depreciation charge. First, let us understand the definition of PPE. PPE has been defined as tangible item that are held for use in the production or supply of goods and services. It is held for rental to others and for administrative purpose. So let us look at this. The main purpose of holding a PPE is that we will use that PPE directly in our production of goods or in rendering of service or in supply of goods or services. You may also hold PPE for the purpose of giving them on rentals. For example, I have a fleet of cars and I rent this fleet of car to people, right, and I earn rental income out of it. They will be classified under the definition of PPE. And for administrative purpose, that means that in a business, right, there would be some assets like plant and machinery which are directly deployed in manufacture of goods, but there would be other assets as well, maybe assets in our accounting office, in our marketing office, etc. These assets are also contributing towards the business in an administrative aspect, and these will also be considered under the definition of property, plant and equipment. Even assets which are held for safety reasons would also be considered under the definition of PPE under accounting standard 10. And the second aspect of the definition says that these items, these tangible items, these PPE are expected to be used for a period of more than 12 months from the date of acquisition, right? So you are using it for a period of more than 12 months. Then we'll talk about the recognition aspect of it, that when will you record the PPE in the books of accounts, right? The PPE has to be recorded at cost, right? So it says that the cost of an item of PPE is to be recognized as an asset if and only if these two conditions are met. The first condition is that it is probable that the future economic benefits associated with that item will flow to the enterprise. And the second thing is that the cost of the item can be measured reliably. So it says that the expenditure which you are incurring in PPE, you are expecting that the enterprise will get benefit out of that expenditure in future, and the cost of the item of PPE can be measured reliably. Normally there is no problem in let's say identifying the cost of an item of PP. And when we talk about the cost of an item of PP, right, there are two levels at which the costs are incurred. One, when you are making the PP or when you are acquiring the PP, that means the cost incurred till the time you make the initial recognition or first time you record that PP in the books of accounts. And then there are certain costs which will be incurred after your PP has been capitalized in the books of accounts, that will be known as subsequent cost. Like, we need to understand how to deal with this subsequent cost. Some subsequent costs are of the nature which are for the maintenance of the asset and have to be charged on to the statement of profit and loss. Some subsequent costs which will be incurred on PP, right, may be such that it may lead to future economic benefits, and they will have to be capitalized with the cost of the or the carrying value of the asset. So it says subsequent costs relating to day-to-day servicing, which is normally known as repair and maintenance, have to be charged to the statement of profit and loss. Then there might be certain items of PPE which requires replacement at regular intervals. I'll give you an example. Let's say in an airline, right, an aeroplane normally constitutes of three major components. One is the body of the airplane, which is known as the airframe, right? Then there is the engine of the airplane, and then there is the interior, the seating arrangement, etc., which is that these are the three major components, right? The outer frame and the engine have a longer useful life, but the interior of the airplane, which is the seats, aisles, etc., right, would require replacement after regular intervals because of excessive usage, right? So in that case, if you are replacing it, right, that replacement will be capitalized to the cost of the item of PP. So it is replacement at regular interval. Cost of replacement is recognized in the carrying amount of the PP. That means you will capitalize that cost. If that cost meets the recognition criteria, means by that replacement you will get future economic benefits, and that cost can be identified reliably. Then we talk about major inspection. There are certain type of assets which will require major inspection at certain regular intervals. The standard says that this major inspection should be treated as a replacement, and the cost of this major inspection should be capitalized to the item of the fixed asset if it meets the recognition criteria. So subsequent costs, we have talked about three items. Day-to-day servicing costs, these are in the nature of repair and maintenance. These have to be charged to the statement of profit and loss. Replacement are to be capitalized to the value of the asset if they meet the recognition criteria. Major inspection have to be treated just like a replacement, and they have to be capitalized with the carrying amount of the PP if they meet the recognition criteria. And then the carrying amount of the earlier part or the earlier inspection have to be de-recognized when you are recognizing the new mal. I'll give you an example. Let's say in an airplane, we estimated that the useful life of the interior, which is the seats, etc., is 8 years, and we are depreciating that seats, etc., over a useful life of 8 years. But after 6 years, we realized that now the seats have been worn out and we need to put in new seats, and let's throw out or dispose of the earlier one. So when we'll have the new seats in place, we'll capitalize the cost of these new seats to the cost of the airplane. But till this date, right, we have depreciated till 4 years, and 2 years of cost is still lying in the block of that particular aeroplane. We need to take it off. We need to de-recognize the carrying amount relating to the seats for the residual period of 2 years, right, when we are capitalizing the new seating or cost of the new seating arrangement. Then we'll talk about measurement of PPC. This measurement has to be done twice. One at the time of initial recognition, that is the first time you are capitalizing your item of PP, and second is after recognition, that is you are carrying on the PP at each balance sheet date. The initial recognition has to be done at cost, and the cost will have three components: the purchase cost, the directly attributable cost, and initial estimate of dismantling, removing and restoring the site, that we will talk about. And after initial recognition, right, you have capitalized the asset in the books of accounts. Then at each balance sheet date, you have an option either to follow the cost model or you can follow the revaluation model. First, we'll talk about the initial recognition at cost, and we'll look at the three components, which is purchase cost, directly attributable cost, and initial estimate of dismantling, removing and restoring the site. First, we'll talk about the purchase cost. Purchase cost is basically the purchase price of the asset, less any trade discount which we get from the vendor, add any non-refundable duties and taxes. Please remember that GST is a refundable duty. We get an input credit of GST. So GST will not be included in the cost of the fixed asset. Right? This is what we get as the purchase cost. Then directly attributable expenses means all those expenses which are necessary in bringing the asset to its location and condition, and bringing it to such a condition that now it is in a position as intended by the management for the use of the assets. So directly attributable cost means any cost directly attributable to bringing the asset to the location location and condition necessary for it to be capable of operating in the manner intended by the management. As the management was intending to use the asset, right, now that particular asset is in that position, till that time whatever directly attributable costs or necessary costs are incurred has to be considered as the cost of the item of PPE. Then we'll take an example of directly attributable costs. These are employee benefit expenses, means salary expenses, etc., labor charges, etc., in relation to the PPE. Cost of preparation of the site, maybe there's some machinery which needs to be put on a platform, etc. You need to prepare the site and then that can be installed. Initial delivery and handling charges, this is basically your transportation cost, insurance cost, loading, unloading cost in relation to the item of PPE. Installation and assembly cost, professional fee in relation to PPE, cost of trial run. See, what is trial run? That once you, let's say, install a plant and machinery, just to check whether that plant and machinery is operating in the manner intended or not, you do a trial run, right? So the cost of trial run has to be capitalized to the cost of the asset, but there will be some production which will be generated out of this trial run. Once that production is sold off, whatever revenue you generate, that will not be treated as sales, but that will be deducted from the cost of your trial run. So that is less sales value of item produced in the trial run. So please remember, trial run cost is to be capitalized to the cost of the item of PPE. Any revenue generated from selling the produce of the trial run has to be reduced from the cost of the trial run. And then initial estimate of dismantling, removing the item and restoring the site on which the asset is located. I'll give you a simple example. With the help of it, you will be able to understand. Let's say we take a new classroom facility, and in that new classroom facility we are installing 15 window ACs, right? So to install those 15 window ACs, we need to cut the wall at 15 places and install those ACs, right? When I informed that to the landlord, he told me that you are installing 15 window ACs, you are cutting various places on the wall. Once you leave the premises, once your lease period is over, you need to again put the bricks at the places where you have taken the bricks out and install the window AC. So let's say my lease period is 9 years. Once after the period of 9 years, I will remove these AC when I will vacate the place, right? So after removing the AC, I have to again put the bricks and get the wall in proper condition. This is the cost which I will incur after a period of 9 years. But this cost is being incurred by virtue of using this premises for a period of 9 years. So I have to estimate what cost I will incur in repairing the walls when I leave the premises after the period of 9 years, and recognize that cost to the cost of the PP at its present value. That we know there is a time value of money. For example, I will incur 1 lakh rupees at the end of 9 years to repair the wall. I have to discount it using a certain discount rate and recognize the present value of that to the cost of the item of PP. This is known as initial estimate of dismantling, removing the item and restoring the site. This normally comes into play in case of mining sites as well, right? When we get license from the government for mining at certain mines, right, we install our plant and machinery at that place. The government usually says that once your license is over, you need to restore that site, remove your machinery, etc. from that particular site. So that cost will be estimated and it will be discounted to its present value and it will be capitalized to the cost of the item of PPE. Then we'll talk about example of costs that are not the cost of item of PP. So you need to remember these items, that if this item comes into picture, you cannot consider them as cost of the item of PP. First, inauguration cost. So when you are opening a new facility, right, there's an inauguration which you do. You cannot consider it as cost of your PPE. Then cost of advertising and promotion. When you are, let's say, launching a new product, you incur certain costs in advertising and promotion. That is not to be included in the cost of the item of the PPE. Then your staff training cost. So when you are conducting your business at a newer location or maybe you are expanding, right, the cost which you are incurring, right, in training your staff, etc. in relation to this cannot be considered as the cost of the PPE. And those administrative and general overheads which do not have anything to do to bring the asset PPE to its present location and condition are not to be considered as the cost of the item of PPE. Capitalization of carrying amount of PPE ceases, right? So at what point you will stop capitalizing the cost incurred in relation to the PPE to the cost of the PPE and charge them off to the statement of profit and loss, right? It says that when the property, plant and equipment is at the location as in the condition that it can be used as intended by the management, that is the point you will stop capitalizing the cost to the item of the PPE. For example, if I buy an AC, right? The cost of the AC will be there, then the transportation charge from the vendor to my premises will be there, then the installation charge at the requisite place will be included in the cost of the AC. But any cost incurred after that, now the AC is in a position that it can be used as it was intended by me. Afterwards, if I am incurring any cost, it will not be considered for capitalizing in the cost of the PPE. Cost incurred in using or redeploying the item are not incurred, included in the carrying amount. So it's once the plant and machinery is installed, right? You have to have people to operate that machinery, etc. Those costs will not be considered in the cost of the item of PPE. Then there are certain other example of cost which will not be included in the carrying amount of the PPE. The first item says that your asset is ready for the intended use. Right? Now it is in a position that it can be used in the manner intended by the management, but you don't use that asset, or maybe you are using that asset at a lower capacity. During that period, if certain costs are incurred, right, that will not be capitalized in the cost of the item of PPE. Cost incurred while an item capable of being operating as intended by the management has yet to be brought into use or is operating as less than full capacity, you will not capitalize the cost in relation to this particular time. Initial operating losses, normally happen that in the initial period, right, there are certain losses which are incurred. These are not considered as cost of the item of PP. If you are relocating your, let's say, processes and you need to, let's say, relocate your machinery, etc., these will not be treated as the cost of the item of PP. Cost of relocating or reorganizing part or all of the operations of the enterprise. Then there might be certain cost which is getting incurred, or there are certain incomes which are getting generated, but these expenses and income have nothing to do with bringing the item of PPE to its present location and condition and making it capable of being used by as intended by the management. These expenses and these income will not be considered as part of the cost of the item of PPE. I'll give you an example. Maybe we buy a plot of land for the purpose of constructing our factory premises on that plot of land. So we have purchased this plot of land, but our construction of factory premises, the factory building, etc., will start after a period of 6 months. So during that period of 6 months, I created parking space in that land and I let out that parking space to various people who needed to park their car. So there will be certain cost which will be incurred and there will be revenue generated out of, let's say, letting out the parking space. These two activities are not necessary in any ways to bringing my factory premises in place or building or constructing factory building on that land. So this cost and this income will not be considered as part of the cost of the PP, and this have to be taken to the statement of profit and loss. Then cost of self-constructed asset, right? You need to determine the cost using the same principle as the cost you determine for an acquired asset. If there is similar asset which is made for sale, means let's say I am into construction of buildings and now I am constructing my own office building, right? The same principles which I use, or maybe I can give you another example would be better. Let's say I am into manufacturing of laptops and I want to, let's say, take certain laptops for my office use as well, right? So the laptop which I am manufacturing for sale will be considered as my inventory, but the laptop which I want to use for my business purpose will be considered as my PP. How will I consider, or how will I calculate the cost of that item of laptop? Right? It will be same based on the principles of accounting standard 2. How you calculate your cost of inventory, same way you will calculate the cost of PPE. And we know that we don't consider any internal profits in the cost of inventory, and any abnormal wastage of material, labor and overheads is also not considered as part of the cost of the inventory. So in case we are manufacturing the same item for sale and same item we are using for our business, the cost will be determined as per the principles of accounting standard 2. Then we'll talk about measurement of cost, right? How do you identify the cost of an item of PP? It says that cost is the cash price equivalent. Let us understand the concept of cash price equivalent. Let's say I am buying a laptop and I say that I will make the payment upfront. I'll pay the entire cost of the laptop upfront, right? They quote me a price of 50,000 rupees. If I tell them that I want to pay the cost of laptops in 12 installments, right? Then will they give it to me for 50,000? No, there will be time value of money involved, certain interest implications will come, and they tell me that if I pay it in 12 installment, I have to pay 52,000. So In the first case, when I am paying cash upfront, the cost becomes 50. In the second case, when I am saying that I will pay the cost of the laptop in 12 installments, right, my cost becomes 52,000, right? But this 52,000 is not the cash price equivalent. The cash price is 50,000. 2,000 is the amount of interest, right? So it says when you are talking about the cost of an item of PP, always consider the cash price equivalent as the price of the PP. If any interest element is included therein, you will not consider that interest element as the cost of the item of PPE. So if I am making a payment of 52,000 total to the vendor, right, and the cash price equivalent is 50,000, right, 2,000 will be considered as interest expense which will be charged to the statement of profit and loss, or if it's a qualifying asset, it will be dealt with as per accounting standard 16, but the cost of the PPE will be considered the cash price equivalent. Then there might be scenario wherein I am acquiring an item of fixed asset, but I am not making payment in cash, right? I am making a payment by giving up some other non-monetary asset, or partly it's like I am giving cash and partly I am giving some other non-monetary asset. In that case, how will we identify the cost of the item of PPE? It says that the cost should be identified at the fair value of asset acquired, right? It should be on the basis of fair value of the asset acquired. Maybe for example, let's say I am buying a new laptop, and in exchange I am giving the vendor, let's say, 3 old laptops, right? So there's a non-monetary asset coming in and a non-monetary asset going out. What will be the cost of the new laptop? It will be the fair value of the new laptop which I am acquired, but that will not be considered if the exchange transaction lacks commercial substance, or fair value of neither the asset received or the asset given can be measured reliably. So there are two options. I am taking a non-monetary asset, and in exchange I am making the payment by giving up another non-monetary asset. The first criteria says that look at the fair value of the PP which you are acquiring and capitalize that in the books of accounts. Alternatively, if the fair value of the asset which you are giving is more clearly evident, then you should capitalize at fair value of the asset given up. If neither is the case, then you should consider the cost as the carrying amount of the asset given up, right? So whatever assets you are giving up to acquire new asset, you should look at the carrying amount in your books of accounts of the asset which you are giving up, and that should be considered as the cost of the new PP that you have acquired. Another situation could be, right, this usually happens when a bucket of assets are purchased at a particular price. Let's say we are buying, let's say, plant machinery, land and building, office equipments, vehicles, etc., right, at a total consideration of 100 crore, right? We are paying lump sum consideration of 100 crore and we are acquiring so many assets, right? How will we attribute this 100 crore to plant and machinery, land and building, office equipment and vehicle? The standard says that look at the fair value of each of these assets and apportion this 100 crore in the ratio of fair value, right? You have to allocate this 100 crore on the basis of fair value of the assets which you have acquired, right? Consideration is to be apportioned to the various item on the basis of respective fair value on the date of acquisition. But if the fair value cannot be determined reliably, then the value are to be estimated on fair basis by a competent valuer. If the fair value cannot be determined, right, on a reasonable basis, then you need to deploy a competent valuer, and based on the valuation done by the competent valuer, you need to determine the value of the various assets which you have acquired by paying a lump sum consideration. Now we'll talk about measurement after recognition, right? Initial recognition we all know has to be done at cost. After the initial recognition, at each balance sheet date, right, we need to carry our fixed asset, right? There is an option, either you can follow the cost model or you can follow the revaluation model. If you choose the cost model, then you have capitalized it at cost, right? You will charge the depreciation, you will charge impairment loss, and then you will get the carrying amount of the item of PP, right? You may also follow a revaluation model. It says after initial recognition, an item of PP whose fair value can be measured reliably should be carried at revalued amount. How do you calculate the revalued amount? Right, it is the fair value of the asset on the date of revaluation, right? So at each balance sheet date, you have to look at the fair value, right? And that fair value should be considered as the carrying amount of the asset. So fair value of the asset on the date of revaluation less any subsequent accumulated depreciation and any subsequent accumulated impairment loss. So you will arrive at the fair value. From that fair value, based on the useful life of the asset, you will calculate the depreciation charge, and based on impairment analysis, you will charge impairment as well, and you will arrive at the carrying value of the amount of PP. Please remember that accounting standard 10 prohibits selective revaluation. It says that whenever you are following revaluation model, entire class of that particular asset should be revalued. So when I say entire class of that asset should be revalued, means let's say we have land and building, that is one class of asset. We have plant and machinery. We have computers, right? That's one class of this thing. We have vehicles, that one class of PP. We have, let's say, office equipment, that one class of PP, right? So you cannot do selective revaluation. That means that if you are following revaluation model for your land and building, right, all the land and building which the enterprise has to be under the revaluation model. For example, let's say you have 7 buildings, right? You want to do 3 at revaluation and you want to do 4 at cost model is not possible. If you are choosing revaluation model, all the assets under that particular class has to be done under revaluation model. Another example, if we are choosing revaluation model for plant and machinery, all the plant and machinery of the enterprise should be based on revaluation model. There cannot be a mixture of revaluation or cost model within a particular class of asset. Then determination of fair value. How, when you are following the revaluation model, you have to let's say carry your PPE at fair value. How will you calculate that fair value? How will you get that fair value? Determined on the basis of market evidence, right, by professionally qualified valuer. So you need to go to a valuer. That valuer will be professionally qualified to determine the fair value of your various items of asset. If market based evidence are not available, means your asset is unique, right? There is no active market for that particular asset. In that case, there are other methods like income approach or depreciated replacement cost approach, which could be used for the purpose of calculating the fair value of the asset. What is the frequency at which you should do revaluation? See, whenever you following revaluation model, you need to keep in mind that your asset should reflect the fair value of the asset at each balance sheet date. So what you need to see is whether there is any significant fluctuation in the fair value of your asset, or the fair value of the asset is relatively stable. If there is a significant fluctuation in the fair value of your asset, you need to do an annual revaluation. At each balance sheet date, you need to carry out a revaluation activity by deploying a certain competent valuer, and you need to determine the revalued amount of the asset. But if the fair value of your asset is relatively stable, it does not significantly fluctuate, in that case you have an option to do revaluation in an interval of 3 to 5 years. Then we'll talk about accounting treatment of revaluation. See, whenever there is a revaluation, the revaluation can be upward, the value of the asset could increase, the revaluation could be downward, that means the value of the asset could decrease. How do you do the accounting for this change in the value of the fixed asset? So when an item of PP is revalued, the carrying amount is adjusted to the revalued amount. So you need to bring the carrying amount of your PPE to the revalued amount. There are 2 methods in which you can do this adjustments in your books of accounts, right? I have taken 2 examples, right? I'll call it as method 1 and method 2. Look at these examples very carefully. We say that before revaluation, cost of the item of PPE was rupees 1000. The accumulated depreciation till date is 400, and the net book value of this item of PP is 600. Now this item has to be revalued at 1500. So item which has a carrying amount of 600, the fair value of this item is 1500. You need to take it at 1500. There are 2 ways in which you can do an adjustment. First of all, the net book value is 600 and the revalued amount is 1500. So therefore there is a gain, right? There is a revaluation gain to the extent of 900 which you need to recognize. How will you do the accounting for this? See, before your revaluation, the cost is 1000, accumulated depreciation is 400, and your net book value is 600. In the first method, what you will do, listen to this very carefully. In the first method, you will add the revalued amount to the cost, right? You will add the revalued amount to the cost. So now 1000 was the cost, 1500 is the revalued amount, right? PP after revaluation will become 2500, but your net book value has to be 1500, right? So if I want to make this 2500, 1500, right? I need to deduct 1000 amount of accumulated depreciation. Right now in the books of accounts we have 400. I want to make this 400 1000, so I'll charge additional depreciation. I will increase my accumulated depreciation to reach 1000 by crediting the accumulated depreciation account by 600. So see what treatment are we doing? We need to take the revalued amount to 1500. So I am saying PPE account debit, which is the cost component, right? We have increased it by 1500. We'll say to accumulated depreciation. Accumulated depreciation as a credit balance. If we need to increase our accumulated depreciation, we need to credit it, right? And to revaluation surplus 900, right? So this 1000 plus 1500 became 2500, 400 plus 600 became 1000, 2500 minus 1000 became 1500. Now this net book value of 600 has become 1500, and thereby we have recognized a revaluation gain of 900. This is the first method in which the adjustment has to be done. The second method, we are taking the same example, but the treatment will be little different. The cost before revaluation is 1000 and depreciation is 400. The net book value is 600, right? After revaluation, right, I will make the cost as 1500. I will not adjust the accumulated depreciation, and this will be the final book value. So what I need to do, I need to increase the cost of the PPE by 500. That's it. No other adjustment will be required, right? And thereby there will be a revaluation gain of 900, right? So here what I need to do is, I need to, the entry which I will pass is PPE account will be debited by 900 to revaluation reserve 900. See, I had 1000 in the cost column of PPE. Add 900 of revaluation gain, this becomes 1900. We have 400 of accumulated depreciation, so the net book value becomes at revalued amount of 1500. Right? So whatever is the revaluation gain, you will have to add it to the cost of the asset, or what is the revaluation loss, you have to directly deduct it from the cost of the asset. Then we'll talk about increase and decrease in revaluation. See, when we revalue the asset, the revaluation can be an upward revaluation, the revaluation can be a downward revaluation. If it's an upward revaluation, there's a gain, but this gain we cannot take it to the PL because this is an unrealized gain, right? It is just by changing the value of the asset to its fair value. So if there is a gain on revaluation, it should be taken to an account known as revaluation surplus, which is in the nature of capital reserve, and it will appear under the reserve and surplus head in the balance sheet. But if there is a decrease, if there is a loss, then you have to debit it to the statement of profit and loss. So initially when there is a revaluation gain, you will credit it to the revaluation surplus. Initially when there is a revaluation loss, right, initially means for the first time when you are doing this revaluation activity, it will be taken to the statement of profit and loss. But at various subsequent dates also, you will look at the fair value of the asset, and there could be a gain or there could be a loss. So when you are doing the subsequent adjustment, you need to keep in mind that what was the initial adjustment did you do. We'll take an example, and with the help of that example we'll understand about this adjustment. Let's say there was a machinery which has a value of 5 lakh. There's an upward revaluation and it is upward revalued at 6 lakhs. So the value of plant and machinery is increasing by 1 lakh. So for this we pass an entry, plant and machinery account debit to revaluation surplus 1 lakh. So 5 lakh was in the block. Now we have debited by 1 lakh. It has become 6 lakh, and 1 lakh of revaluation surplus has been recognized. So this is the first time when we are doing the revaluation activity. Then there's a subsequent downward revaluation, right? There's a subsequent downward revaluation. In there two cases which you have taken, case A and case B. Subsequently, there's a downward revaluation to 5,70,000. So see, my plant and machinery currently is appearing at 6 lakh, and now I want to bring it at 5,70,000. So there's a loss to the extent of 30,000, right? I need to reduce the value of plant and machinery by 30,000. So I will say plant and machinery account credit, and this loss of 30,000 will be debited to the revaluation reserve account, because we already have a credit balance of 1 lakh in this account. To the extent of this 1 lakh, we will always debit the revaluation reserve account. But in the another case We are saying that the downward revaluation is 4 lakh 80. So in the books, the plant and machinery is appearing at 6 lakh. And we need to bring it down to 4 lakh 80. In this case, there is a revaluation loss of 1 lakh 20. In this case, please note the entry, very important. We will debit revaluation surplus by 1 lakh. Why by 1 lakh? Because there is a maximum balance of 1 lakh which is available in this account. Right, to the extent of excess, we will have to debit the profit and loss account, and the value of plant and machinery will decrease by 1,20,000. Are you absolutely clear? So when you are initially increasing the value, you will credit it to the revaluation surplus. Subsequently, if there is a downward revaluation, to the extent there is a balance in revaluation surplus, debit the revaluation surplus. But if the reduction in the value of the asset is more than the balance in revaluation surplus, the excess will be debited to the statement of profit and loss. And in the same analogy, let's say the plant and machinery is at 5 lakh, we do an initial downward revaluation of 420, right? So there's a loss of 80,000. This loss will directly go to the statement of profit and loss. Our entry will be profit and loss account debit 80,000 to plant and machinery 80,000. Subsequently, right, after doing this downward revaluation, we have upward revaluation. Again, we have taken two cases, case A and case B. In the first case, we are taking it to 450. So 450 minus 420. In this case, there is a gain of 30,000. So we'll debit the plant and machinery by 30,000 and we'll credit the statement of profit and loss by 30,000 because we have recorded a loss of loss to the extent of 80,000 in relation to this asset. In the second case, right, we are taking this plant and machinery to 550. Currently, it is appearing in the books as 420. Right, here there is a gain of 130. Right, in this case, look at the treatment very carefully. To the extent of see, we need to increase the value of plant and machinery by 130. So we'll debit the plant and machinery account by 130. Right. To the extent of loss I had earlier recognized, I will credit my profit and loss account. Over and above whatever is the gain, that gain will go to my revaluation surplus account. So if there is an initial downward revaluation, debit your PL. Subsequently, if there is an upward revaluation, right, first you need to credit your profit and loss to the extent of the loss you had debited earlier, and over and above that loss, if there is a gain, you will take it to the revaluation reserve account. Please go through these two examples very carefully. Then we'll talk about bearer plan. See, this is a new inclusion in the Accounting Standard 12 revised scenario, which is PP. Let us understand what do we mean by a bearer plant. Bearer plant would essentially mean a plant, right? The purpose of let's say having that plant in place is to get fruits or the output out of that plant. I can give you an example, right? The best example could be, let's say, a mango tree, right? A mango tree is basically there for the purpose of cultivation of mangoes, right? Our intention is not to sell that mango tree. Our intention of having a mango tree is to get the fruit mango which is there and selling that fruit, right? So a bearer plant is such a plant which is held for the purpose of bearing some vegetable or fruit, right? I can give you another example. Let's say sugar cane. Sugar cane is also a plant, but that sugar cane, entire cane is extracted from the soil and sold off in the market. It cannot be treated as a bearer plant. So what is a bearer plant? Bearer plant is a plant that is used in production or supply of agricultural produce. So that is a plant which bears either fruits or vegetable. That is not a plant which is sold off as such in the market. It is expected to bear produce for more than period of 12 months. So it's not that the plant will bear and it will be finished off within a period of 12 months. That's a plant which will be used for a long period of time. And there's a very remote likelihood of being sold off as agricultural produce except for incidental scraps. Maybe this mango tree grows very old and now it has stopped bearing. So maybe I'll cut off this mango tree, I'll sell off the woods and I'll plant a new mango tree. That's incidental because of usage over a period of time. My intention was never that I will plant a mango tree and then I will sell that mango tree off, right? So following are the examples of items which are not bearer plant. Plant cultivated to be harvested, right? So for example, sugarcane. It's a plant which is cultivated so that it can be harvested and the sugarcane can be sold in the market. Plant cultivated to produce agricultural produce. when there is more than remote likelihood that the entity will also harvest and sell the plant, right? So there are certain cases where there is a produce from that plant, and that plant is also extracted and sold off in the market, or annual crop like rice, maize, etc., right? These are also not to be treated as bearer plant. So bearer plant is essentially a plant. The objective of owning that particular plant is that that plant will bear certain fruits or vegetables, etc., and that fruits or vegetables will be sold off in the market, but that particular plant will not be sold off, except for the fact when that useful life of that plant comes to an end, that plant may be sold off like a scrap. Accounting for bearer plant, it has to be done as you do accounting for a self-acquired or self-constructed item of PP. So essentially what will happen, I plant let's say there's a farm in which I plant mango trees, right? I will capitalize the cost till the time these mango trees start bearing fruit. Once these mango trees start bearing fruit, right, the cost which is incurred in maintaining these that particular farm will be charged to the statement of profit and loss. Then we'll talk about depreciation. We all know that depreciation is an expense that is charged off to the statement of profit and loss. Understand the concept. The expenditure which I am incurring after acquisition of a PP is normally known as a capital expenditure, right? Why do we call it as capital expenditure? Because it is an expenditure, but the benefit of this expenditure I will get over a long period of time. So let's say if I am buying a particular mobile phone, right, for rupees 1 lakh, and I intend to use that mobile phone for a period of 5 years, then 1 lakh divided by 5, 20,000 is the expense which I will charge off every year, right, as a depreciation, as allocating the cost of the asset as an expense, right? So depreciation is what? Depreciation is a systematic allocation of the depreciable amount of an asset over its useful life, right? So why do we call it as depreciable amount? I'll give you an example. Let's say I buy a phone for 1 lakh rupees and I will use it for 5 years. I said that I will depreciate 20,000 each year. I'll modify this example a little bit. Let's say I buy this particular plant. Right, I'll modify this example a little bit. Let's say I buy this particular I buy this particular phone for 1 lakh rupees. I believe that I will use it for 5 years, and after 5 years I will sell it off, let's say for 10,000, right? So my effective cost becomes 90,000, right? 1 lakh I have incurred, 10,000 I will get, 90,000 is what is my cost which I need to allocate over the period of 5 years. So this 90,000 is nothing but the depreciable amount. So depreciable amount is basically the cost minus the residual value, which is the depreciable amount which you need to apportion over its useful life. What is the residual value? Residual value is basically the amount which you expect to realize, right, once you dispose of that asset at the end of its useful life. What is useful life? Useful life is considered in two ways, in terms of period, number of years for which you could use the asset. There could be certain assets, right, which you cannot calculate the useful life in terms of period, right? The useful life of that asset could be the quantity that asset could produce, or number of hours for the asset could be used, right? So it will be number of production or other similar units for which the asset can be used, right? Residue value and useful life both are an estimate, right? I might buy a phone and I say I use it for 5 years. If that phone performs well, I may use it for 7 years. If it does not work well, I may sell that phone off after 2 years as well. Again, the residual value, I say that after 5 years I will realize 10,000 rupees. Maybe I will realize 12,000 rupees. Maybe I realize 5,000 rupees. So both these items are an estimate, right? So residual value and useful life and item of PP should be reviewed at each financial year end, and if the expectation differs from the previous estimate, previously I thought I'll use it for 5 years, or maybe I'll get 10,000 rupees, at each balance sheet date I have to review whether my initial estimate was correct or not, and if there is a change in my estimate, I need to change that estimate, and that change will be treated as change in accounting estimate as per accounting standard 5, right? Then commencement of depreciation. When will you start depreciating your asset? Simple, when the asset is ready for the use, right? Means when the asset is in the location and condition and in a position where it is capable of being used as intended by the management. Whether you use that asset or not, that does not matter. For example, let's say I buy an AC and I install that AC, but after installing it is ready for use. But if I don't use that AC at all for 2 years, will I not start depreciation depreciation on it? The answer is I have to charge depreciation, right? It should be ready for use. Whether I am using it or not, it does not matter. So depreciation is also charged on ideal asset as well. Depreciation on an asset begins when it is available for use, right? That is when it is in the location and condition necessary for it for capable of operating in the manner in which the management intends to use that asset. Depreciation ceases, right? When will you stop charging depreciation on an asset, right? When will you stop charging depreciation on an asset? Depreciation of an asset ceases as earlier of date the asset is retired from active use. So now we are not actively using that asset anymore. And very important, held for disposal. So you are not using the asset, it has been retired from active use, and also now it is your intention to sell this asset off, you want to dispose this asset off. The date the asset is derecognized. Derecognized means when you record something in the books of accounts, that is known as recognition. When you pass an entry in the books of accounts, it is known as recognition. Derecognized means when you take off that asset from your books of accounts, that is known as derecognition. Therefore, depreciation does not cease when asset becomes idle. So if you are not using the asset, that does not mean you will not charge depreciation. Or is retired from active use but not held for sale. You're not using that asset actively, but you also don't intend to dispose that asset off, right? If that is the fact, you still have to charge depreciation on that asset. Both the conditions should be met, that the asset is retired from active use and also it is your intention that you are wanting to dispose of that asset as well. Now depreciation method, right? It is the duty of the management to choose a proper method of charging depreciation on its PP, right? What should be the methodology of selecting this method? It says that your method of depreciation should reflect the consumption pattern of your asset, right? The manner in which you will get benefit from that asset, right? In that same particular pattern, you should charge depreciation on that particular asset. The depreciation method should reflect the pattern in which future economic benefits of the asset are expected to be consumed by the management. So what are the available methods? There's straight line method, there's diminishing balance method, and unit of production method, something like you would have studied at your foundation level, which is let's say production unit method or machine hour method or maybe depletion method, etc. Depreciation method, which is based on revenue generated by that asset, is not considered as appropriate, right? You should not charge depreciation based on your expectation of generation of revenue from that particular asset. Now, very important segment, component method of depreciation. Here we'll talk about two things. One, segregating the component, another is grouping the component. I had taken an example that an aeroplane will have three important components: airframe, engine, and the interiors. Right? This cumulatively would form a significant portion of the cost of the airplane. The useful life of the airframe will be, let's say the external body is 20 years, the engine is, let's say, 15 years, and the interiors is 5 years, right? So maybe an airplane costs 600 crore rupees. What you need to do is you need to allocate this 600 rupees between the airframe, between the engine and the interiors, and depreciate each of these components based on their respective useful life. That is known as segregating the component. You have airplane as a single unit, right? The cost of that single unit is 600 crore, but the significant component of the airplane have significantly different useful life. The external body has a useful life, for example, of 20 years. The engine has a useful life of 15 years, and the interiors 5 years. So you cannot depreciate entire 6 crore on the basis of either 20, 15 or 5. You need to allocate the cost between the three significant major components, and you need to depreciate each significant major component based on its respective useful life. Then grouping of component, I'll take an example. Let's say there is a plant and machinery. Plant and machinery has 4 parts, part A, B, C and D. Part A has a useful life of, let's say, 20 years. Part B also has a useful life of 20 years. Part C has a useful life of, let's say, 12 years, and Part D has a useful life of, let's say, 8 years, right? So in this case, component A and B should be grouped together, and depreciation on component A and B should be charged together, and C and D should be depreciated separately based on their respective useful life, right? So first situation, you were segregating, right? You were segregating different components and charging depreciation as per their respective useful life. In the second case, you see that there are certain significant components which have similar useful life or same useful life. For those components where there is a same or a similar useful life, you will club them together and charge depreciation on them together, and for those components which have a different useful life, you will charge as per their respective useful life. Review of the method. See, again, this method of depreciation depends upon the consumption pattern, your expectation of future economic benefits from the asset. If your consumption pattern of the asset changes, if your expectation of future economic benefit or the pattern of future economic benefits from that particular asset changes, you should also change your method of depreciation to reflect the current consumption pattern of that asset, and this change should be treated as change in accounting estimate and should be dealt with as per accounting standard 5. Then, see, there could be certain scenarios in which the cost of the asset or the value of the asset changes. Why does it change? Right, we have seen that you have to put in the estimated value of dismantling, removing and restoration of site. That estimate may change. There might be certain price adjustment with your vendor. There could be certain duties which would be levied on that asset, right? So there are several circumstances in which the value of your asset could change. How would you deal with that change? That change should either be added or reduced from the cost of your asset, but your asset could be carried at two different ways, right? You could choose a cost model or you could choose a revaluation model as well. So if you are choosing cost model, then any change in the liability should be added or deducted, means adjusted with the cost of the asset. But if you are choosing revaluation model, in that case, it is absolutely pertinent that your asset is appearing at its fair value in the balance sheet, right? So you do not do an adjustment with the value of the asset. Rather, that adjustment in the value of the liability, right, it alters either your revaluation surplus or it alters your PL balance when that adjustment is done. So important thing which you need to remember, when there is a change in the value of the asset because of various reasons, you need to first see which model are you following. If you are following the cost model, it's pretty simple, that if there is an increase in liability, you will add that amount to the value or the carrying amount of your asset. If there is a decrease in the liability, you will reduce the carrying amount of your asset. But if you are following revaluation model, you cannot do any change in relation to change in the liability of the asset with the value of your PP. Any adjustment which originates from the change in the value of the liability has to be necessarily done either with your revaluation surplus or with your statement of profit and loss. So it says that if there's a decrease in liability, it should be credited to revaluation surplus. If there's an increase in the liability, it should be debited to the statement of profit and loss. Higher, but in the previous occasion, there was a downward revaluation and it was debited to the PL, then to that extent you credit to the PL, and if you need to credit more, you will choose revaluation surplus. Same way, if there was revaluation surplus in the earlier extent, first you will debit the revaluation surplus. Any debit more than the balance in the revaluation surplus will be debited to the statement of profit and loss. Then retirement of an item of PP means now the item is not in active use, you want to dispose of that item of PP. The item of PP retired from active use and held for disposal should be stated. So earlier it was under your non-current asset. Please listen to this very carefully. Your PP is under non-current asset. When your non-current asset is held for sale, it comes under current assets and it is under other current assets category in your schedule 3 balance sheet, right? So this reclassification from non-current asset to current asset as fixed asset held for sale should be done at lower of the carrying amount, means the value at which that asset is appearing in your balance sheet, or the net realizable value of that. It's on the basis of conservatism, because now you don't want to use this item of PP. This PP is held for sale. So same way you value your inventory cost or NRV, whichever is lower, right? You use that same principle. You will see the carrying amount of that item of PP in your books of accounts. You will see the net realizable value. Whichever is the lower value, at that value you will reclassify from non-current asset PP to other current asset as non-current asset held for sale. Any write down in this regard is obviously recognized in the statement of profit and loss. Derecognition means you take off that asset from your books of accounts. The derecognition should be done either on disposal, you are selling off that asset, or maybe there are no future economic benefit from the expected use or disposal. You need to scrap that off, you need to throw that asset off. In this case, right, you derecognize the value from the books of accounts. Gain or loss is net disposal proceeds minus carrying amount, right? Whenever you're derecognizing also, any gain or loss will go to the statement of profit and loss. Another important point, we said that the definition of PP is asset held for use, then for rentals to others. So if you're holding an item of PP and you're giving it to rentals to other people, right? And after a certain number of years, that particular asset you are selling off, right? Maybe I have a fleet of car and I'm renting that fleet of car and earning rental income, right? Couple of cars in that fleet have become old and now I want to dispose of these cars. So I'm not using it for rentals. Now it is held for sale, right? So when it is held for sale, we have seen whenever an item of PP is held for sale, right, it will be treated as non-current asset held for sale under other current assets in the current asset category in our balance sheet. But if you are using an item of PP for rentals to others and then now you want to dispose of this item, it will not go under no other current assets, right? It will be treated as your inventory, right? Should be transferred to inventory at their carrying amount, and the sales proceed should be treated as revenue as per accounting standard 9. Please note this difference. And then disclosures, you need to state your measurement basis, whether you are doing the cost model or you are doing the revaluation model. There could be some class of asset which you will follow cost model. There could be some class of asset where you are following revaluation model. What method of depreciation you are using, what are your useful life or depreciation rate. You need to state your gross carrying amount and accumulated depreciation in the beginning and at the end of the year, and you need to do a reconciliation as what was the opening balance, what is the addition, what is the disposal, and what is the closing balance. This reconciliation needs to be shown for the cost element and for the accumulated depreciation element of the asset as well. So by this we are done with the revision of accounting standard 10. We'll move on to certain very important practical questions in relation to them, right? Let's read question number 1. It says Omega Limited contracted with a supplier to purchase machinery which is to be installed in one of its departments in 3 months' time. Special foundation were required for the machine which were to be prepared within its supply lead time, means which is to be constructed within 3 months. The cost of the site and laying the foundation is 140. So this 140 is the cost because it is necessary to install the machinery. These activities were supervised by a technician during the entire period of 3 months, who is employed for this purpose at 45,000 per month. So 45,000 into 3 months is the lead time. So 1,35,000 is incurred as salary to this technician. The machinery is purchased at 1,58,000. So this is basically a purchase price. And transportation cost, this will also be considered as cost of inventory directly, cost of PP directly attributable. In bringing the machinery to factory, an architect was appointed at a fee of 30. This is also considered as cost to supervise the machinery installation, right? You are required to ascertain the amount at which the machinery should be capitalized. So based on this, we have seen that all the items are such that which should be included in the cost of the inventory. So we say purchase price, cost of site preparation, technician salary, initial delivery cost, professional fee, and this becomes the cost of our item of PPE. Next question, question number 2. It says Hema Limited purchased a machinery on 1/4/2008 for 15 lakhs. So this is the cost. The company charged straight line method of depreciation on 15-year useful working life and residue value of 3 lakhs. So basically 15 lakh minus 3 lakh, 12 lakh divided by 15 is the amount of depreciation per year. At the beginning of the 4th year, means after charging depreciation till the 3rd year, the company, by way of systematic evaluation, revalued the machinery upward by 20% of the net book value. So whatever is the net book value at the end of the 3rd year, 20% of that was treated as upward revaluation and was added to the cost of the machinery and brought it to its revalued amount. and also re-estimated the useful life as 7 years. So now they have re-estimated that the useful life is not 15 years, but as of date it is 7 years, and the scrap value is nil. Earlier we considered that 3 lakh, now the scrap value is nil. The increase in net book value was credited directly to the revaluation reserve, obviously because this 3 lakh of 20% increase revaluation will go to the revaluation purpose. Depreciation on straight line basis later on was charged to statement of profit and loss. At the beginning of the 8th year, the company decided to dispose of the machinery and estimated the realizable value to be 2 lakh. You are required to ascertain the amount to be charged to profit and loss account at the beginning of the 8th year with reference to AS10. So they are saying that at the beginning of the 8th year or in the 8th year, when you are disposing of this item of PPE, right, what should be your amount that should be taken to your statement of profit and loss. Please listen to this very carefully. In this sum, initially it has been said that the useful life of the machine is 15 years. The machine has been used for, let's say, 3 years, and in the 4th year you do a revaluation activity, right, and you revalue the machinery upward by 20%, and you also re-estimate the useful life of the machine as 7 years. See, now there could be two aspects. First, we could assume that after 3rd year, the remaining useful life is 7 years, right? So till 3 years you have used it, you will use it for another 7 years, and effectively total useful life becomes 10 years. There could be another assumption as well, as that the total life of the asset is 7 years. You have already used it for 3 years. 7 minus 3, now the remaining useful life is 4 years. Right? So it's not clear from the question as to whether they are saying that the total useful life has become 7 years or the remaining useful life of this machine after using it till 3 years is 7 years. So we'll look at it from both the perspective. First, we will assume that the remaining life is 7 years, right? We have used till 3 years, and in the 4th year, we see that the remaining useful life of this machine is 7 years. It can be used for another 7 years. So, cost of the machinery initial 15 lakh. We have charged depreciation for first 3 years, which is 15 lakh minus 3 lakh residual value divided by 15 into 3. This is the net book value of the machinery at the end of the 3rd year, or we may call it as at the beginning of the 4th year. 20% revaluation increase, so 12 lakh 60,000 into 20%, this is the revaluation increase. This is the revalued amount of the machinery at the beginning of the 4th year. Now, from the 4th year, this machinery can be used for another 7 years. So we will say 15 lakh 12,000 divided by 7 into 4. Why into 4? Because in the 8th year I am disposing of this machinery. So I will charge depreciation for the 4th year, 5th year, 6th year and 7th year. So this 4 would mean 4th year, 5th year, 6th year and 7th year, right? For 4 years I am charging of the depreciation, which is 864, and WDV of the machine at the beginning of the 8th year becomes so much. When we'll sell off, we'll get 2 lakh rupees, and 4 lakh 48 lakh is considered as loss on sale. See, there is a upward revaluation of 252 and there's a loss of 248. So, 448. So, out of 448, to the extent of revaluation surplus, we will debit our revaluation surplus, and balance, which is 448 minus 252 of revaluation surplus, 196 will be taken to statement of profit and loss as a loss, right? Then, if we assume that the total useful life of the machinery is 7 years, 3 years we have used, right? The total life is 7 years, so now it can be used for remaining 4 years only, which is the 4th year, 5th year, 6th year, 7th year, and in the 8th year we are disposing of that machinery. In that case, we will say revalued amount at the beginning of the 4th year, that we have already calculated here, so same amount we will directly use, right? This is the revaluation amount at the beginning of the 4th year. Now depreciation for 4th to 7th year is basically 15 lakh 12,000 divided by 4 into 4, because 4 years is the remaining useful life and we are using it for 4 years. The entire things become depreciated. WDV becomes 0. 2 lakh rupees is the sales proceed, and this 2 lakh becomes profit on sale. Clear? Then question number 3, it says Versatile Limited purchased a machinery for 4,80,000 inclusive of GST of 40,000. See, this GST cannot be considered as cost because GST will get the input credit. The input credit is available for GST paid, so effectively it is 4,40,000 is our cost. The company incurred the following other expenses for installation. Cost of preparation of site for installation is so much. Here again in this sum we need to identify what will be the total cost. So this will be included in the cost. Total labor charges is 66,000. It says 200 out of 600 man hours worked were spent on the installation of this machinery. So here this 66,000 is cost of entire 600 hours. We need to allocate for 200 hours. Spare part consumed will be taken. Total salary of supervisor is so much. Time spent is 25% of total time. So out of this only 25% will be attributable to this particular asset. Administrative expenses so much. 1/10 relate to plant installation. So 1/10 of this will be treated as our cost. Test run and experimental production, we have seen that test run cost will be considered as the cost of the item of PPE. Consultation charges to architect for plant setup will be considered. Depreciation on asset used for installation. So there are certain assets which we have used in installing this particular item of PPE, right? So depreciation of this asset should be taken as cost of the item of this PPE. The machinery was ready for used on 1/15/15. But was used on 1st February 15. So it was ready on 15th of January, but we did not use it. We used it from 1st of February. Due to this delay, expense of 19,000 were incurred, right? Calculate the value of the plant to be capitalized. So we have seen that when the asset is ready to be used as intended by the management, but if it is not used or it is used below capacity, the cost incurred for that should not be considered as part of the cost of the PP. So this 19,000 should not be considered as the cost of the PPE, right? So let us look at the computation. Purchase price net of GST 440. Site preparation 2166 divided by 600 into 200. Spare parts. Allocable supervisor salary 24,000 into 25%. Allocable administrative expense 32,000 ka 110. Test run and experimental production expenses, consultation charges and depreciation of asset installed for use. This will become our cost of PP, and we'll say as per accounting standard 10, cost incurred while an item is capable of operating in the manner intended by the management, has yet to be brought into use or is not included in the carrying amount of PP, and therefore 1900 will not be included in the cost. So by this we are done with the revision of accounting standard 10. Right guys, so let us start on with the revision of accounting standard 11, the effect of changes in foreign exchange rate. As usual, first we'll cover up the contents of the standard and then we'll move on to certain very important practical questions. Basically AS 11, the effect of changes in foreign exchange rate, is applicable on those enterprise which in some ways have exposure to foreign currency transactions, or they are having some operations in some foreign country, or they are having some forward exchange contract. So this standard basically gives us guidance to deal with three particular items. One, for accounting for transaction in foreign currencies, translating financial statements of foreign operations, and for accounting for forward exchange contract. We'll cover things one by one, but before getting there, we'll first look at some very important definitions which will be useful while we are doing these three topics. First, let us understand what is reporting currency. Reporting currency is the currency in which we make our financial statement, right? The currency in which an enterprise prepares and presents its financial statement is its reporting currency. So if my enterprise is making its financial statement in Indian rupee is the reporting currency. If my enterprise is making its financial statement in US dollars, then US dollars is the reporting currency. The currency in which the financial statements are made is the reporting currency. Then exchange rate. Exchange rate is the ratio of exchange between two currencies. For example, let's say to get $1, if I need to pay 75 rupees, then the exchange ratio between the dollar and the rupee is known as the exchange rate. Then foreign currency. Foreign currency is any currency other than the reporting currency. For example, my company is making its financial statement in Indian rupees. Then other than Indian rupees, any currency from the perspective of my company will be a foreign currency. If my company is making its financial statement in US dollars, then any currency other than the US dollars will be treated as foreign currency. The foreign currency is a currency other than the reporting currency of the enterprise. Then we'll understand what is average rate. Average rate is basically the average of foreign exchange rate of a particular period of time. Then we'll understand what is closing rate. Closing rate is the exchange rate which is there on the balance sheet date. So India, we prepare financial statement on 31st of March, right? That is the year end date. So the exchange rate which is there on 31st March will be treated as the closing rate. But if you are preparing financial statement on 31st December, the rate on 31st December will be treated as your closing rate, right? So the exchange rate on the balance sheet date will be treated as the closing rate. Then we'll understand what is exchange difference. Exchange difference is the difference which is resulted from reporting the same number of units of a foreign currency at different exchange rates. For example, let's say I purchased certain goods on 23rd of March 2020, right? Maybe I have purchased goods worth $10,000 and on that day the exchange rate is 75 per dollar. Then, right, then this transaction in the Indian rupees will be 7,50,000. Then when I make my financial statement on 31st of March 2020, I have to restate this $10,000 at the closing rate, which is the rate on the balance sheet date. For example, let's say the rate on the balance sheet date is 77 per dollar, right? So now my liability in relation to purchase of these goods becomes 770. The difference, right, between these two will be treated as an exchange difference, right? The difference resulting from reporting the same number of units, right, reporting the same number of units of a foreign currency in the reporting currency at different exchange rates. So $10,000 have been reported once on the date of the transaction when the exchange rate was 75. Again, it has been restated at the year end, which is 31st of March. Right, and this exchange rate on that date is 77 per dollar. So difference between these two rates into the amount of foreign currency will be treated as my exchange difference. Then monetary item. Monetary item means money held, which we are talking about liquid cash. Either it could be cash in hand or the money which is lying in our bank account. And assets and liabilities to be received or settled in known or determinable amounts, right? Money held and assets and liabilities to be received or paid in fixed or determinable amount of money. So when we talk about money held, it is the cash in hand or the money which is lying in our bank account. When we say assets and liabilities to be received or paid in known or fixed or determinable amount of money, we are talking about those assets and those liabilities where we know for sure what is the amount of inflow and what is the amount of outflow. For example, our debtors, we know how much money exactly which we have to receive from our debtors. Our bills receivable, we know how much of amount which we are supposed to receive from our bills receivable. Similarly, if we talk about liabilities, loan taken, we know how much amount of loan has been taken and how much we need to repay. Similarly, creditors, expenses payable, we exactly know that how much is our liability towards these parties. So these will be treated as monetary item. Then we'll talk about non-monetary item. These are assets and liabilities which are not monetary item, right? Basically, in this category, there will be three items. One which is our fixed asset, other which is our investments in equity shares, and third which is stock. See, in case of PPE, which is our fixed asset, we don't know how much exactly these items will realize. When we'll actually go and sell it in the market, at that point of time, we'll get to know how much money will be realized. Similarly, in case of investments in equity shares, the prices of equity share changes continuously, and at the time of executing the transaction only we'll get to know what is the exact amount which it has fetched. Similarly, in case of stock, we can only estimate the NRV, but when it is actually sold, right, that will be the price which will be determined at that point of time. So these three will be treated as non-monetary item: PPE, investment in equity shares, and stock. Then we'll talk about the first topic, see, we said that this standard will give us guidance in relation to 3 topics: accounting for transaction in foreign currencies, then it will talk about translating financial statement of foreign operations, and then it will talk about forward exchange contract. We are starting with the first topic, which is accounting for transaction in foreign currencies. Let us first understand what do we mean by a transaction in foreign currency. Transaction in foreign currency is a transaction which is denominated in or which requires settlement in a foreign currency will be treated as a foreign currency transaction. When we say that a transaction is denominated in foreign currency, that means the principal value of the transaction is in foreign currency. Maybe we have purchased certain goods and the invoice is in USD, right? Then that transaction is denominated in foreign currency. Or maybe there is an asset or there is a liability which is there, right? In relation to that asset, the money which we will receive will be in foreign currency, or in relation to that liability, the money which we will pay will be denominated in foreign currency, right? So a foreign currency transaction is a transaction which is denominated in or requires settlement in foreign currency. And if we talk about example of these transactions, any transactions, right, which are denominated in foreign currency or maybe which require settlement in foreign currency will be treated here. Means when we purchase goods, when we sell goods, when we take loan in foreign currency, when we lend to somebody outside India, and that will be treated as foreign currency lending. When we become party to an unperformed forward exchange contract, what is forward exchange contract we'll understand a little later. Or any other asset or a liability which is to be received or is to be paid in foreign currency will be treated as a foreign currency transaction. Now we'll talk about the accounting aspect of it, that how do we account for transactions which are denominated in foreign currency. For example, let's say I make my financial statement in Indian rupees. I purchase certain goods worth $10,000, right? I cannot make an entry in my books of accounts in dollars. I have to convert that $10,000 into the Indian currency to enable me to make an entry into my accounting system. And primarily this standard will give us a guidance that how do we need to convert this foreign currency amount into the reporting currency and do the accounting in the books of accounts. So whenever we talk about these foreign currency transaction, there are two things which we primarily deal with. One, which is the initial recognition. Initial recognition would mean that first time when the transaction has taken place, right, we record it in the books of account. This is normally done on the date of the transaction, and then till the time the transaction is settled, we need to restate this transaction at each balance sheet date. So how this restatement of foreign currency transaction will be done in our financial statement. So first we will talk about initial recognition. That initial recognition means recording the transaction for the first time in our books of accounts, right? We will have to record obviously in our reporting currency, because if our reporting currency is Indian rupees, we cannot record a transaction in which is denominated in dollars in our books of accounts. Therefore, in the reporting currency, right, obviously we'll do accounting in our reporting currency. And how that will be computed? That will be computed as $10,000 into whatever is the exchange rate of INR and dollars on that date, right? So in the reporting currency, computed as foreign currency amount, which is $10,000, into the exchange rate at the date of the transaction, right? Whatever is the rate on the date of the transaction, we'll use that rate to convert the dollar into INR. But for practical convenience purpose, you can take an average rate, right? A rate which approximates the actual rate, that is the average rate for a week or a fortnight, etc. But this can be done only when there is no significant fluctuation in the exchange ratio between these two currencies. Otherwise, if there is a significant fluctuation, then the use of average rate is prohibited. Only when your foreign currency rates are very stable, right? Only in that circumstances you can use an average rate. Otherwise, you are supposed to use the exchange rate which is there on the date of the transaction. Then we will talk about reporting at subsequent balance sheet dates, right? So the treatment depends upon whether the foreign currency item is a monetary item or that foreign currency item is a non-monetary item. If your foreign currency transaction or the item is a monetary item, at each balance sheet date you need to restate them at the closing rate, right? You need to restate them at the closing rate, right? Rate at on the date of the balance sheet is the closing rate. You need to restate it at the closing rate. But if your foreign currency item is a non-monetary item which is carried at historical cost, normally we can talk about PP, right? Or which is carried at fair value. We know under AS 10 we have an option for PPE to be carried under revaluation option, and this revaluation is basically the fair value. So if it's a foreign currency non-monetary item carried at historical cost, you have to use the rate on the date of the transaction. So maybe I purchased my fixed asset 5 years back, right? Even if today at the balance sheet date when I have to convert that item, if it is in foreign currency, I will use the rate which I had purchased and the rate which was there 5 years back when I purchased that fixed asset. Similarly, in case of fair value, I need to use the rate, right, which was there when that revaluation activity was done. So in relation to non-monetary items, we don't restate these non-monetary items at each balance sheet date. We use the rate which was prevalent when those non-monetary items were first recognized in our books of accounts, right? So by this what we get to know that there will be a foreign currency difference, right, in case of monetary item. But please remember, very important, that in case of non-monetary items, right, there will be no foreign currency difference, because these these non-monetary items are not restated at different rate. They are carried in our balance sheet at the rate on the date of the transaction, right? Now, then it says that if there is a restriction on remittance, or maybe the closing rate which you are getting is not reliable, right? Basically the concept behind recording the assets and liabilities in the balance sheet is that they should reflect the amount receivable in case of the asset and the amount payable in case of the liabilities. So if the closing rate is unrealistic, right, it will not predict or it will not specify the receivable amount of the asset or the payable amount of the liabilities. In that case, the standard says you should record the asset and the liabilities at the value which you expect these items will be settled at the balance sheet date. Now, let us talk about the exchange differences, right? Basically, let us talk about the exchange differences, right? What are these exchange differences? The exchange difference is reporting the same number of units of foreign currency, right, at various different rates on different dates, right? That is the exchange difference, right? So, exchange difference on monetary item, we have already concluded that there will be no exchange difference on non-monetary item, because for non-monetary item, we use the rate on the date of the transaction or the rate on which, on the date on which the fair value are taken, right? So you're not changing the rate consistently, so there will be no foreign currency difference. So in case of monetary items, see, the normal treatment of exchange difference in case of monetary item is that you take the exchange difference, whether it's a profit or it's a loss, to your statement of profit and loss, right? But under AS 11, by virtue of para 46 and 46A, right, there is a separate treatment also specified which we'll look into, right? So exchange difference on monetary item, option under 46A not availed, that is you are following the normal treatment, right? It says that exchange difference on both, listen to this very carefully, exchange difference on both long term and short term foreign currency monetary items be recognized as income or expense in the statement of profit and loss, right? We have already discussed for non-monetary item there will be no exchange difference, right? In case of monetary item, be that monetary item be long term, be that monetary item be short term, the exchange difference will be taken to statement of profit and loss. But AS 11 provides with an option, right? Option under para 46A availed. First, remember very carefully that this option is available only for long-term foreign currency monetary item. That means if your monetary item is a short term, listen to this very carefully, if it is a short term monetary item, right, the only treatment is that the exchange difference should be taken to statement of profit and loss. Option under 46 and 46A is available only for long term foreign currency monetary item. So if you avail this option, it is available only for long term. If you don't avail this option, the normal treatment is that exchange difference on both long term and short term monetary item is to be taken to statement of profit and loss. For short term monetary item, it will always be statement of profit and loss, but if it is a long term foreign currency monetary item, please listen to this very carefully. If it is a long-term foreign currency monetary item, then you have an option either to go for a normal route, or you can choose to avail option under para 46 and para 46A. So option under 46A available, it is available only for long-term foreign currency monetary item, and it's a irrevocable option. Once you choose this route, you cannot go back to the normal route. Exchange difference arising on long-term monetary item if it is related to acquisition of depreciable capital asset. For example, you have taken a loan in foreign currency, and with the help of the loan in foreign currency, you purchase certain fixed asset which is of a depreciable nature. Need not that you need to import that fixed asset. Listen to this very carefully. I took a loan from US, right, and by using that loan, I purchased certain fixed asset. So in this case, I have taken a foreign currency long-term monetary item. Maybe the loan is for maybe 5 years, and with the help of this loan I have purchased certain depreciable fixed asset, right? So related to depreciable capital asset, example, loan taken for acquisition of plant and machinery, right? The normal treatment of exchange difference is that you will either debit it or credit it to the statement of profit and loss, but in this case the exchange difference is added or deducted from the cost of the asset and should be depreciated over the balance life of the asset. So whatever is the exchange in the normal route, if it's a loss, you will say profit and loss account debit to that particular liability. But if it's a long-term foreign currency monetary item, and if you are availing option under 46 or 46A, then your entry will be your fixed asset account debit to your long-term foreign currency loan account. And then that fixed asset will be depreciated over the remaining useful life. In other case, means it's a general purpose loan, the long-term monetary item is not relating to a depreciable capital asset. Then in that case, you need to accumulate in a foreign currency monetary translation difference account, which we normally call as FCMITDA account, and amortized to PL over the balance life of such asset or liability, right? So maybe you have taken a loan for 5 years, and if that loan is a general purpose loan, any exchange difference on that loan will be accumulated in FCMI TDA account, and it will be charged off to PL over the period of loan. So basically this option is to defer the PL charge or the PL credit. Under the normal route, any exchange difference on its inception will go to the statement of profit and loss, but in this case it will be deferred. First it will go to the value of the asset if that long-term monetary item is in relation to depreciable asset, or it will go to FCMI TDA account if it's for a general purpose asset, and based on the tenure of that asset, or maybe based on the tenure of that particular loan, it will be charged off to the PL. Now let us take certain example, right? But before example, let us talk about few things about this para 46 and 46A. To exercise 46 and 46A, an asset and liability should be designated as a foreign currency monetary item. It should be designated as a long-term foreign currency monetary item. And what is this long-term? That it has a term of 12 months or more from the date of its origination as an asset or liability. So it should have a tenure of 12 months or normally the same criteria which we use for non-current assets and non-current liabilities. Disclosure is to be made that you have exercise the option under 46 or 46A. Any contingent liability should be converted at the closing rate. Now let us look at certain examples under the normal scenario, right? First we'll look at certain example under the normal scenario, and then we'll take certain examples under 46, 46A as well. Let's say on 24th of September 2019, purchase 10 laptops at $5,000 per laptop from Dell Corporation US. The payment was made immediately, and the exchange rate on this particular date on which you have made a purchase is 75 per dollar. So it's pretty simple. You are purchasing an asset in and the amount is denominated in foreign currency and making immediate settlement. So on 24th of February 19, we will say laptop account debits to, we will say, bank account, because the settlement has been made immediately. We have purchased 10 laptops. Cost of one laptop is $5,000, and the exchange rate on this particular day is 75. So basically $50,000 into 75 This gives me 37,50,000 is the transaction. In this case, see, there is no exchange difference. Why is there no exchange difference? Because the transaction has taken place and has settled on the same day, right? We don't need to report the same number of units of foreign currency at two different rates. Let's take another example. On 24th February 2019, purchased 10 laptops at 5,000 per laptop from Dell Corp US. Payment was made on 24th March. So you are purchasing on February 24th and you are making the payment on 24th of March after a month. On 24th February the rate was 75 for a dollar, and on 24th March after 1 month the rate was 77 per dollar. Now let's see how this transaction needs to be recorded and what will be the treatment of foreign exchange. So on the date of the transaction, which is 24th of February 19, we will say laptop account debit, and we'll create a liability for Dell Corp US, which is basically 10 laptop into $5,000 per laptop into rupees 75 per dollar, which is the rate on the date of transaction. So this will come out to 37,50,000. This is 37,50,000. Then on 24th of March 19, we are making the settlement. So we'll say Dell Corp US account debit, right? We'll debit it by 37,50,000. Right, we'll say to bank, right? The amount which will go from our bank account will be 10 laptops into $5,000 per laptop into the exchange rate on the date of the payment, which is 77. So therefore we'll say $50,000 into 77, right? We'll have to make a payment of 38,50,000. So we had a liability initially recorded at 37,50,000, but we have made the payment, we have made the settlement for 38,50,000. So there is a loss. So we will say foreign exchange difference. This foreign exchange difference is 1 lakh, which is basically movement of $2 into $50,000. 1 lakh rupees is the foreign exchange loss, and this foreign exchange difference will be closed by transfer to profit and loss account. Let's move on to the next example. Let's say on 24th of February 19, purchased 10 laptop for $5,000, right, from Dell Corp. Payment was made on 24th of April. So it is in the next financial year that we are making the payment, because the purchase is made in financial year 18-19 and the payment is made in financial year 19-20. The exchange rate on the date of purchase was 75. The exchange rate on 31st of March is 76, and the exchange rate on the date of payment is 77.50. Now let us see how do we deal with this. And please remember, we are doing this treatment considering that we have chosen the normal route. We have not chosen the route available under 4646A. And here we don't have any long-term monetary item as well, right? Therefore, the 4646A is not available as well. So on the date of the transaction 24/2/19, we will say laptop account debit to Dell Corp US account, which is again 10 laptop into $5,000 per laptop into 75. So this will be 37,50,000. Then at the year end we need to restate the liability. Therefore we will say 31st March 19, right? The rate was 75 and it rose to 76. So our liability towards Dell Corporation has increased. So we will say foreign exchange difference account debit to Dell Corp US account, right? We have 10 laptops, per laptop is $5,000 and the exchange rate at the year end is 76. and we had initially recorded at 75. So 1 per dollar. So 50,000 is the loss which we are facing because of increase in the exchange rate. This will be closed by transfer to PL, right? Then on the date of settlement of the transaction, which is 24th of April 19, right, we will say Del Corp US account debit. See, the balance in the account of Del Corp US is 38 lakh, 37 lakh, 50,000 was initially credited, and then subsequently another 50,000 was credited in that account, right? So the total amount which is to be there in the Del Corp account is 38 lakhs. So we'll debit Del Corp account with 38 lakhs. Then we'll say to bank account, right? We are paying for 10 laptop. One laptop is $5,000 and the rate on the date of settlement is 77.50 per dollar. So we'll say 50,000 into 77.50, which is 38,75,000. So we'll say 38,75,000, and the difference will be foreign exchange difference account. This 75,000 will be debited to the foreign exchange difference, right? So this is how, and this will be closed by transfer to profit and loss account. So this is how normally we do accounting for our foreign currency transactions. Now we'll also have a look at the scenario when we avail this option under para 46 or 46A. Let us take an example, and with the help of this example we'll see how does that work, right? So let's take an example. Let's say loan taken on 1/4/2020, $50,000 for purchase of machinery on the same day, right? The loan is repayable after 5 years, and the useful life of machinery is, let's say, 10 years, right? Now let's say exchange rate on 1/4/2020 when the loan was taken, right, and the asset was taken, let's say the exchange rate was $1 was 75. Then on 31st March 2021, which is the year end, let's say $1 was 77. Now let us see how do we account for it, right? And we'll look at both the scenarios when 46 or 46A is not availed and when 46 or 46A is availed, right? So write both the scenarios. We'll say 46A not availed, here 46A availed. Please remember, had this loan been for less than a period of 12 months, right, option under 46A would not have been available because the long-term foreign currency monetary item, in that case only 46A is available. In this case, the long-term foreign currency monetary item, right, long-term foreign currency monetary item, this loan is the long-term foreign currency monetary item. If this loan was repayable after 6 months, the option under 46 and 46A would not have been available at all. We would have to go for the normal route only, right? Let us do the accounting under both the scenarios, right? This will clarify the entire scenario in front of you. So we'll say on 1/4/2020, we'll say bank account debit to foreign currency loan, because first the money will come into our account. So we'll say 50,000 into the rate is 75, so we will say 37,50,000 is the amount in INR terms which came to our bank account, right? When we are availing this, the first entry would remain the same, so I am doing the same entry. We will say bank account debit to foreign currency loan account, same $50,000 into 75 is the exchange rate. This will be 37,50,000. Please follow this example very carefully. Then on 1/4/2020, on the same date, we'll say machinery account debit to bank account. For the purpose of convenience, we could have also done a single entry saying machinery to foreign currency loan, right? And this machinery is also purchased on the same date at the same value, so 50,000 into 75, so 37,50,000. We will say machinery account debit to bank account 37,50,000. This is 1/4/2020. Now see, we have already seen that in case of foreign currency non-monetary item, please look at this very, very carefully for a total concept clarity. This loan is a foreign currency long-term monetary item. Please remember, this loan is a foreign currency long-term monetary item, whereas this machinery is a foreign currency non-monetary item. Absolutely clear. Machinery is PPE and this machinery is a non-monetary item. And do we restate machinery? No. Machinery, although it's purchased in foreign currency or with the help of foreign currency, right now we haven't said that we have imported this machinery, but had it been that this machinery is imported, still we would not restate it. We would use the rate of 75 to take it forward in each balance sheet date. Now, since this loan is a foreign currency monetary item, we are not availing the option in the first case. Look at this very carefully. So on 31st March 2021, right, the exchange rate has gone up to 77. So our liability, our payable for the loan has increased. So our entry will be foreign exchange difference account debit to foreign currency loan account. The loan is of $50,000, 77 minus 75, right? So 1 lakh rupees is my exchange loss, and this foreign exchange difference will be closed by transfer to profit and loss account. But in case we are availing the option, right, listen to this very carefully. In case we are availing the option under 46 or 46A, in that case on 31st March 2021, our entry will be machinery account debit to foreign currency loan account, and this $50,000 into 77 minus 75, which is the rate of initial recognition, 1 lakh rupees will be debited to the machinery account, right, and credited to the loan account. So if the option is availed, it will not go to the PL and it will go to the value of the asset. And had this loan be a general purpose loan, not for a depreciable asset, right, we will make an entry FCMI TDA account debit to foreign currency loan account. And now on 31st December 2021, we'll say depreciation to machinery account. And look at the value very carefully. We had capitalized it at 37.50 plus 1 lakh, which is this entry, divided by 10, which is the useful life of the machinery, right? So this is how the treatment will differ when the option under 4646A is taken and when the option under 4646A is not availed. To sum up, if you have a short-term monetary item, listen to this very carefully. For non-monetary item, no exchange difference. For non-monetary item, no exchange difference. If you have a long-term monetary item, right, then you have two options. Either to go for normal route where you will debit or credit your exchange gain or loss to PL, and you have another option for long-term monetary item, which is para 46 and 46A. If it is for depreciable item, right, you will add it or deduct it from the value of the principal asset for which that long-term monetary item is associated with. And if it is not for a depreciable asset, you will accumulate the difference in FCMI TDA account and amortize it over the balance life of the asset or the liability. Clear? Now, we'll talk about treatment of exchange difference on monetary item relating to net investment in non-integral foreign operation. We are yet to talk about non-integral foreign operation, but as a heads up, any exchange difference in case of a non-integral foreign operation, we don't take it to the statement of profit and loss. We accumulate it in an account called FCTR account, foreign currency translation reserve account, and when that operation is disposed or sold off, entire accumulation in FCTR account is debited or credited to the statement of profit and loss. So this says that if there is a monetary item, right, maybe there is a receivable, there is a loan in relation to a non-monetary foreign, non-integral foreign operation, any fluctuation on restatement, right, for these monetary items which are related to non-integral foreign operations, you will not take it to the statement of profit and loss, but you will take it to FCTR account. So normally any difference on monetary item is taken to statement of profit and loss, but in this case, if it is related to a non-integral foreign operation, instead of taking it to statement of profit and loss, you will accumulate it in the account which is foreign currency translation reserve account. Now let us come to translating financial statement of foreign operation. First, let us understand that where does this requirement come from. Let's say I am a company, let's say I am Reliance Industries Limited and I am operating from India. I have certain branch offices in Singapore, US, Dubai, Emirates, etc. So these branch are my part and parcel only. So when I am reporting my financial statements, right, I have to incorporate the number of these branches. But if my branch is in Singapore, if my branch is in US, they will prepare their financial statement in the local currency of their region, maybe Singapore dollar, maybe US dollar, etc. When they send their numbers to me, I am making my financial statement in INR. So I need to convert these financial statement of my foreign branch from the Singapore dollar to INR, from the USD to INR. So how that conversion needs to be done will basically be dealt with by this particular section. Let us understand first that what is a foreign operation. A foreign operation is either my subsidiary, my associate, my joint venture, my branch, which is operating, right, which is operating in a country other than the country of the reporting enterprise. So if I am the reporting enterprise, I am domiciled in India. If my subsidiary, my joint venture, my associate, my branch is operating outside India, they will be treated as my foreign operation, right? Foreign operation is a subsidiary, associate, joint venture, branch of the reporting enterprise, mean the enterprise which is making its financial statement, the activities of which are based or conducted in a country other than the country of the reporting enterprise. So I am the reporting enterprise, my country is India. If they are established and operating outside India, they will be treated as foreign operations. Now, these foreign operations are classified into two categories. One which is integral foreign operation, another which is non-integral foreign operation. What is an integral foreign operation? Integral foreign operation, as the word suggests, integral means it's a very important part of my operations. Non-integral, it is my operations, but it is not such an important part, or maybe it's not so much connected with me. So when we talk about integral foreign operation, right, we are talking about an operation which is just like an extension of the reporting enterprise's operation. For example, I am Reliance Industries Limited, I am domiciled in India, I make a subsidiary in US, and the entire duty of that subsidiary is that I will send goods manufactured in India to this subsidiary, and this subsidiary will sell goods in the local market. So it's just like having another office in US and that office operating on my behalf. Then maybe let's say I have a subsidiary in Dubai. The operation of that subsidiary is to procure raw material from Dubai, send it to India, and then I'll manufacture goods with the help of it. So it's just like an extension of the reporting enterprise, right? From legal perspective, I have set up a legal entity in those particular region. So let us understand. Integral foreign operation is a foreign operation, activities of which are integral part of the reporting enterprise, carries on business as if it's an extension, as if I have opened an office in another country. Changes in exchange rate between the reporting currency and the foreign currency has almost an immediate effect, right? It will obviously have an immediate effect, because if I have set up a subsidiary in US which is supposed to receive goods from me and sell in the local market, right, and remit the cash back to me, the fluctuation in the USD INR rate will immediately impact me, because the operations are so much connected and these are happening on a daily basis. But when we talk about a non-integral foreign operation, right, it's not integral, means it operates fairly independently. I do not have too much of intervention, right? It is my subsidiary, it is my associate, maybe it's my branch, but I don't have so much of direct connect with it. It is operating fairly independently. It is procuring its own goods, it is procuring its own loans, it is operating in its own market, and there is not too much exchange transactions between us on a daily basis, right? So non-integral foreign operations accumulate cash and other monetary item, incur expenses, generate income, and arrange borrowing, all substantially in its local currency. Changes in exchange rate have little or no direct effect on the present and future cash flows from the operations. Changes in exchange rate affect the reporting enterprise's net investment in non-integral foreign operation. Instead of having a daily accumulated effect, it will impact my net operations in net investment in the non-integral foreign operation. Now see, the basic purpose is that I have financial statement of my foreign operations. To make my financial statement, if it's my subsidiary or it's my associate, etc., I need to consolidate it with my financial statement, or if it's my branch, I need to include it in my financial statement. So how do I convert these foreign currency amounts into my local currency so that I can include it in my financial statement? So we'll talk about translation rule, right? What exchange rate should I apply to the various items in the trial balance of my foreign operations so that I can convert those foreign currency amounts to my local currency amount? So first let us talk about balance sheet items. We are talking about assets and liabilities, right? So if it is a monetary item, we will use closing rate, right? For integral and for non-integral, I need to use the closing rate, that is the rate on the balance sheet date, to convert all the monetary items. But if it's a non-monetary item, here there is a difference, and here there is the only difference there in conversion. If there is fixed asset and related depreciation expense, if it is an integral foreign operation, we will use the rate on the date of acquisition of the fixed asset, or in case of revaluation, the date on which the revaluation was made. See, the normal rule was that in case of non-monetary item, we use the rate on the date the transaction has taken place, and integral, we are considering that it is our extension, it belongs to us, it directly impacts us. So the same rule which I apply for myself, I will apply it for conversion of my integral foreign operation. But non-integral foreign operation, it does not have a daily nexus with me, so I will use closing rate, right, for non-monetary items as well. This is an exception, because we had learned that in case of non-monetary item, we need to use the rate on the date of the transaction. But if it's a non-integral foreign operation, right, it will affect my net investments in foreign operation, I'll use closing rate for these non-monetary items as well. For inventories, cost, we will take closing rate. For NRV also we will take closing rate. See, basically the thing says that it should be the rate on the date the transaction has taken place, the rate on which various purchases has taken place, but for the purpose of convenience we are taking closing rate in this case, and this applies for both integral and non-integral as well. For opening stock, we will take the opening rate in both the cases. For PL item, we'll take the rate on the date of the transaction, but to convert various transactions at the rate, using the rate on which those transaction takes place become impracticable. So for convenience, we take the average rate to convert the statement of profit and loss item. Now there'll be goods sent to branch by the head office. We don't need to convert, right? When the head office will send these goods to branch, the head office will record that entry in its local currency, use the amount which is given in the trial balance of the head office. Similarly, balance of head office in the book of branch. So branch will have, let's say I have a branch in US. So that branch will have head office accounts in a trial balance and the amount will be in USD. I don't need to convert this. I will look at the head office trial balance. I'll look at the branch account, and whatever balance is there in the branch account in the books of the head office, I will use that particular amount. Now see what will happen. What I am necessarily doing is I am converting the trial balance of my foreign operations into my local currency, which is INR, and I have converted certain items at closing rate, I have converted certain items at average rate, I have not converted certain items, and I have taken the amount which was appearing in the HO book. So since there is no consistency in converting various items, definitely the trial balance will not match. There will be a difference in the trial balance. In case of integral foreign operation, that the difference will be taken to statement of profit and loss as exchange translation gain or loss. But if it's a non-integral foreign operation, will not hit the PL. The difference will go to foreign currency translation reserve to be disclosed in the balance sheet under the head reserves and surplus. So there are two major differences, please note. In case of translation of fixed asset, in case of integral foreign operations, we will take the date on the rate on the date of the transaction, whereas for non-integral we will take the closing rate. In case when the trial balance will not tally, that difference in integral it will go to PL, in non-integral it will be accumulated in foreign currency translation difference. When that non-integral foreign operation will be disposed of, right? When maybe subsidiary is there, I sell off that subsidiary. Right? Whatever balance is there in the foreign currency translation reserve account, right, which I have taken and not taken to the PL and I have deferred, right, will be recognized as income or expense in the statement of profit and loss. So on ongoing basis, you will not hit the PL, you will accumulate the difference, and when that particular operation is sold off, that entire difference, be it a credit balance or a debit balance, will hit the statement of profit and loss. But if partial disposal is done, maybe I am holding, let's say, 50% in a particular thing, I sell 25%, remaining 25% is with me, right? In case of partial disposal, only proportionate share of the FCTR will be transferred to PL. So maybe there's a balance of 100 in my FCTR and I have sold 50% and 50% is still left with me. 50 will be transferred to PL and 50 will still remain in the FCTR account. Now we'll talk about change in classification. Initially a foreign operation was considered integral. Now we are considering it as non-integral. Or it could be a scenario, initially we were considering a foreign operation as a non-integral foreign operation, and now we are considering that foreign operation as an integral foreign operation. See the entire disconnect. Listen to this very carefully. When we did that exercise of conversion, we saw that there were two places where there was difference. First in case of fixed asset and another in case of how you deal with your difference in the trial balance. See, you are classifying your integral into non-integral. In case of integral, you used to use the for fixed asset the rate on the date of the transaction had taken place, that the historical rate. But non-integral you restated at the balance sheet date, right? So exchange difference arising on translation of non-monetary asset at the date of reclassification are accumulated in foreign currency translation reserve, right? So for example, your asset, your fixed asset was worth $10,000. You had purchased these when the rate was 60 and they were appearing in your balance sheet at 6 lakh. Now when you are reclassifying it as non-integral foreign operation, so you will have to convert this $10,000 into INR using the exchange rate on the date when the reclassification is done. So maybe the exchange rate on the date of reclassification was 75. So now these fixed asset will appear at 7,50,000 and this 1,50,000 of difference will go to foreign currency translation reserve, right? Foreign currency translation reserve. Similarly, when you are converting your non-integral to integral, see, in case of non-integral, you restate your fixed asset at the closing rate at each balance sheet. In case of integral, you don't restate, right? So they are saying that whatever value the fixed assets are appearing in the trial balance of non-integral operation, which is obviously the restated value, consider it as a historical cost and carry it forward in your balance sheet. And when you are converting your non-integral into integral, in case of non-integral, there will be a balance in foreign currency translation reserve. In case of integral, all the differences go to PL, so there is no foreign currency translation reserve. So you are saying that foreign currency translation reserve will not be taken to the PL. Even if you have reclassified non-integral into integral, it will remain in your balance sheet, right? So the translated amount of non-monetary item at the date of change are treated as historical cost for those items in the period the change and in the subsequent period as well. So whatever value the PP is appearing on the date of reclassification, that becomes its historical cost. Exchange differences that have been deferred in the foreign currency translation are not recognized as income or expense till the time the operation is disposed of. So once you have transferred it into FCTR, don't play with it. Only when the operation has been disposed of, you will take it to the statement of profit and loss. Now we'll talk about forward exchange contracts. See, there are two purpose for which you enter into a forward exchange contract. One which is for the purpose of hedge, another is the purpose for speculation. I'll give you an example. Let's say I purchased goods worth $10,000 on, let's say, 25th March 2020, when the dollar to INR rate was for $1.75. Creditor to be paid on 25th May 2020, right? So when I purchased, right, these goods, I will record purchase account debit to creditor, which is 10,000 into 75. Now I have to make the payment to the creditor on 25th of May 2020, which is after 2 months. I don't know what will be the exchange rate after 2 months, and if the exchange rate becomes too adverse, it may cause significant loss to me. So I am not too much an expert in these foreign currency rates, etc. So I need to protect myself from foreign currency fluctuation, right? See, on 25th of May, what I need to do? I need to purchase $10,000 from the bank and make a payment to my creditor. So on 25th of March 2020 itself, on the date I have made my purchase, I will go to my bank and I will tell the bank that, bank, I need to make a payment of $10,000 on 25th of May, which is 2 months from now. Right? But I want to make a contract today for purchase of these $10,000 from you. Tell me the rate at which I can buy these $10,000, right, on 25th of May and make the payment to my creditor. So the bank told me that you can buy these $10,000 at 78 per dollar, right? Today the rate is 75. The bank is telling me we will sell it to you at 78. We are expecting that the rupee dollar price will be adversely functioning and the exchange rate will increase, right? So I know that I will be making a loss of 3 per dollar, right? 3 per dollar, and into $10,000, my total loss of fluctuation is 30,000. So I tell the bank, okay bank, freeze the contract on 25th of May 2020. I will purchase $10,000 from you and I will pay you 7,80,000 at the rate of 78. So now I can have peaceful sleep. Now even if the exchange rate becomes 90, exchange rate becomes 82, exchange rate becomes 85. It's not my worry, because I have a right to buy these dollars at the rate of 78. So I am limiting my loss. What am I doing? I am limiting my loss. I know at the very inception that how much of exchange difference loss I have to bear. It could work reverse as well. Maybe the rate could become 72, right? So if had I not entered into this contract, I could have purchased the dollar at 72 and saved a lot of money. I buy it at 75 and then I could make the payment at 72, but then I need to be expert to make this prediction. So I am happy with a loss of 30,000 and I protect my position. This is basically known as a hedge. What is this known as? This is known as a hedge. Another purpose for which this same deal could be done is for speculation. For example, there is no purchase. I know that the USD dollar rate might be adverse, and to get the difference in the rate, to profit from the difference in the rate, I may enter into a forward exchange contract. This will be known as for the purpose of speculation, right? So what is a forward exchange contract? It is a contract, or it is an agreement to exchange two currencies, right, at a future date but at a specified rate. Because I am exchanging $10,000 with INR at a future date which is 25th of May 2020, but at a specified rate which is $1 is equal to 78. So foreign exchange contract means an agreement to exchange different currencies at a forward rate, and this forward rate is basically 78. For what is a forward rate? It is a specific exchange rate for exchange of two currencies at specified future date. In our example, the specified future date is 25th of May 2020. And then we have already seen what are the purpose for which the foreign currency forward exchange contract could be entered into. Forward exchange contract can be entered to establish the amount of reporting currency required or available at the settlement date of the transaction, which is for the purpose of hedge. We know that we need 7,80,000 rupees on 25th of May 2020 to make settlement to my creditor. That if I keep it open, it could be any amount. Intended for trading or speculation purpose to make profit out of fluctuation in foreign currency rates. Now let us talk about the treatment. See, today, when I entered into the transaction, when I purchased, the rate was 75. I made a contract to purchase $10,000 after 2 months, and the rate which was quoted to me was 78. So something which is worth 75 today, I am entering into the contract to purchase the same thing at 78. See, the alternative could be, listen to this very carefully. Today itself I could have purchased $10,000 and paid at the rate of 75, 7,50,000. But in that case, I need 7,50,000 today. Maybe the cash is not available. Maybe the cash will be available after these goods are sold, and that therefore 2 months of credit, right? And therefore I book a forward contract. So this 3 which I am paying extra, see the difference between 75 and 78 is 3 rupees per dollar, right? This is known as my forward premium. What is this known as? This is known as forward premium. I am paying this 3 extra and not executing and buying the dollars today, right? And trying to buy it at a future date. So it says the premium or the discount arising at the inception of the forward contract should be amortized as an expense or income over the life of the contract. So the life of the contract is 2 months. I am paying 30,000 extra. So 2 months, 30,000. Right, 1 month, a certain number of days are in current financial year, certain number of days are in next financial year. So I will break this 30,000 into number of days in the current financial year and number of days in the next financial year and record the expense. Exchange difference on such forward contract is also to be recognized in the statement of profit and loss. If I cancel this contract or if I renew this contract, right, any income or expense should also be recognized in the statement of profit and loss. But in case I am doing it for speculation, please remember, premium or discount on the forward exchange contract is not recognized separately. I just have to do a mark to market for these contracts when I have taken it for speculation. Means I will look at the rate at which I have entered the contract. I will look at the rate at different point of time, at the balance sheet date, at the time of settlement, and the difference profit and loss will only be recorded. The gain or loss on such forward exchange contract is recognized in the statement of profit and loss. If you make a gain, it will go to PL. If you make a loss, it will go to PL. Exchange gain or loss on such forward contract is computed as forward exchange rate at the reporting date for the remaining maturity less forwarded contracted exchange rate. For example, let's say on 31st March the rate is 77 and the rate at which I have contracted is 75. So the difference 2 will be either the gain or loss which I need to record in the statement of profit and loss. And in these cases I will ignore the premium or the discount element. Disclosures, you need to disclose what is the amount of exchange difference that you have recorded in your financial statement, how much amount you have accumulated in your FCTR account, and you need to also show a walk that what was the opening balance in FCTR, how much additions have been made, what has been utilized if you have disposed of your foreign operations, and what is the closing balance. When reporting currency is different from the currency of the country, maybe in India all of us make financial statement in INR, but in India if I am making my financial statement in USD, my reporting currency becomes USD because it's the currency in which financial statement are made. I need to disclose the reason why I am using a different currency than the currency of the country in which I am domiciled. Any reason for change in the reporting currency? I was using INR, now I have shifted to some other currency, then what's the reason for the change? If I am reclassifying my significant foreign operation from IFO to NIFO or from NIFO to IFO, I need to say what is the nature of change, which is IFO to NIFO or NIFO to IFO, reason that I have made the change, what is the impact of the change, and what is the impact on the statement of profit and loss. By this we are done with the entire revision of accounting standard 11. We'll move on to certain practical questions. Let's come to question number 1. It says Opportunity Limited purchase an equipment costing rupees 24 lakh on 1/4/15 and the same was fully financed by foreign currency loan payable in 4 annual equal installments. So it's a 4-year loan. We say that it is long term foreign currency monetary item. Exchange rate of $1 was 60 and 62 on 1/4 and 31st of March 16, which is the year end. The first installment was paid on 31st March 16. Entire difference in foreign exchange has been capitalized. You are required to state how this transaction is to be accounted for. So, see, here we have taken a foreign currency loan, and with the help of this foreign currency loan, we have purchased a depreciable fixed asset, which is my equipment. So, here I have two options, either to go for a normal route. If I take the normal route, the entire exchange difference will go to the statement of profit and loss. Here I have an option to adopt para 46 or para 46A. If I adopt this para 46, 46A, right, the exchange difference in relation to the loan, which is long-term foreign currency monetary item, right, the exchange difference will be added or deducted to the cost of the asset, and it will be depreciated over the remaining useful life of the asset. So, AS11, exchange difference arising on reporting monetary item at rate different from those at which they were initially recorded during the period should be recognized as an income or an expense in the period in which they arise. We normally, when we answer the questions on accounting standard, first we state the text from the accounting standard, then our analysis of the case, and then the conclusion. Then it says that enterprise has an option to deal with such exchange difference by para 46, 46A, exchange difference on long-term foreign currency monetary item, right, insofar as they relate to acquisition of depreciable asset, can be added or deducted from the cost of the asset and should be depreciated among the useful life. So since they have capitalized, they have done correct because they have adopted the option under 46A. So repayment of the loan is for $40,000, $10,000 have been repaid and $30,000 have been recasted. So this is the total amount. Initial recognition was done at 24 lakh. If you multiply 40,000 into 60, you will get 24 lakh. There is this exchange loss of $1 lakh, Right, it says if the company exercises option, then this exchange of 1 lakh should be added to the cost and amortized over the useful life. Alternatively, if the option under para is not exercised, then the exchange difference should be taken to statement of profit and loss. So what we are saying is what the enterprise has done is correct, but if it does not want to avail this option, then it has to take it to the statement of profit and loss. Then question number 2. Goods purchased on 1st of January 19, $15,000 worth of goods, and the exchange rate is 75 on that date. At the year end date, the exchange rate is 74. Date of actual payment, the exchange rate is 73. So here the exchange rate is falling. So it is beneficial for us because our liability towards the creditor is decreasing. You are required to ascertain the loss or gain to be recognized in the financial statement. So we will state the paragraph from the standard which you can read. See, on 1/1 the exchange rate is 75, so this is the value at which is recorded. On 31st March it is 74, so this is the restated amount, so there is a gain to the extent of 15,000. And then now the opening balance is the closing balance of the previous year. We did a settlement at 73, so much money went out, so again there is a gain of 15,000 rupees. Question number 3. Rao Limited purchased plant for $1 lakh on 1st February 16, payable after 3 months. So 1st February the purchase has been done and it is payable after 3 months, means March, April, May. It is payable on 1st of May. Company entered into a forward contract for 3 months at the rate 49.15. So see, this is not for hedge. This is to establish the currency which is payable, right? Because there is an underlying transaction in this case. So it entered into a 3-month forward contract which it got at 49.15. Exchange rate per dollar on 1st of Feb, which is the date of the transaction, is 48. So the difference between 48.85 and 49.15, which is 30 paisa, is the forward premium which the enterprise has paid to protect or hedge itself. How will you recognize the profit or loss on that contract? So we'll state the text from the standard. We will say that the forward rate is 49, the spot rate is 48.85. So this is your forward premium per dollar. There is $1 lakh and 30 paisa per dollar. So 30,000 rupees is your total forward premium. In financial year 15-16, right, we have Feb and we have March. In financial year 16-17, we have April, because on 1st of May the settlement has to be done. So this 30,000 will be apportioned between financial year 15-16 and 16-17. 2 months will be for financial year 15-16 and 1 month will be for financial year 16-17. So 20,000 in 15-16 and 10,000 in 16-17. Then question number 4. Mr. A bought a forward contract for 3 months for USD 1 lakh on 1st December at $1 is equal to 47.10 when the exchange rate was 47.02, right? So it has purchased a forward contract. It has a right to buy 1 USD at 47.10 when the spot rate is 47.02. On 31st December, when he closed his book, the exchange rate was 47.15. So see, the exchange rate increased. On 31st January, he decided to sell the contract at 47.18. See, he has a right to buy dollar at 47.10. So he will buy dollar at 47.10 and he can sell the dollar at 47.18. So 8 paisa per dollar he is making a gain. Show how the profit on the contract will be recognized. See, here there is no underlying transaction, right? He is doing just for speculation because there is nothing being said that he has entered into the transaction, and to cover that transaction he is entering into this contract. So it is for speculation. In case of speculation, we don't calculate the premium or discount. We just see the difference between the rate on which the contract is entered and the settlement date or the restatement date and recognize the profit and loss. So here what we will say, that we sold this contract at 47.18 and we entered this contract at 47.10, right? The difference is 8 paisa per dollar into 1,08,000 rupees. The above gain should be taken into statement of profit and loss. And if you want, you can also do it financial year wise. 31st December, right, 31st December, they are saying the rate was 47.15 and it has purchased it for 47.10. So 5 paisa of gain would be recognized on 31st December, and then 47.15 and the rate at which he has settled the contract is 47.18. So remaining 3 paisa will be in next financial year. If we add these two, this will be 8 paisa into 8,000. They haven't asked us to do financial year treatment, so the total gain on the contract is 8 paisa, which is $1 lakh into 8 paisa, 8,000, and the entire thing will be taken to statement of profit and loss. Then there's some question which is normal. This question is very important. Look at it. This question might come and it's very easy to attempt. Classify into monetary and non-monetary. Share capital will be treated as non-monetary. Trade receivable will be treated as monetary. Investment into equity shares is non-monetary. Fixed asset is basically non-monetary. Absolutely clear by this. So by this we are done with revision of accounting standard 11. I hope it would have enabled you to have a deep understanding of the standard and will help you in your exams. Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with the revision. Right guys, let us start on with revision of accounting standard 12, accounting for government grants. First we'll cover the contents of the standard and then we'll discuss some very important practical questions. So let's begin. Accounting standard 12, accounting for government grants. Basically these government grants are help or assistance which is provided by the government. This assistance can be in form of cash or can be in form of kind, means some non-monetary assets may be provided, but this is provided to an enterprise basically for either the past or the future compliance of certain conditions. So whenever we talk about grant, we think about a gratuitous act, that something is given free of cost, but here the government is providing assistance to the enterprise, but this is not free of cost. The enterprise is supposed to comply with certain terms and conditions. Either it has complied in the past or it has to comply in future, and by virtue of complying with these certain terms and conditions, the government will provide a subsidy or a grant. So government grant has been defined as government grants are assistance by the government in cash or in kind. Maybe some land is given or maybe a plant and machinery is given, whatever the case may be, to an enterprise for past or future compliance of certain conditions. So how it normally works is, let's say the government want to develop a certain backward area, create employment opportunity, utilize the land pool which is available there. The government will come out with an incentive scheme that whosoever sets up their factory or undertaking in that particular area may get certain money as an incentive in terms of, let's say, setting up of their factory, or may get certain tax concessions, or maybe their let's say employee cost will be reimbursed. So that can be formed in various ways, but it is an help or an assistance which is given by the government to a business for complying with certain terms and conditions. Let us see the recognition criteria for government grants. Government grants are recognized when these two conditions are satisfied. First, that there is a reasonable assurance that the enterprise will comply with the conditions attached to them, because it's not gratuitous. It's not just that we're just giving you assistance. You have to comply with certain terms and conditions and become eligible to get the government grant, and such benefits are earned by the enterprise, and it is reasonably certain that the ultimate collection will be made. So practically how it works is that, let's say the government comes up with an industrial development scheme whereby it provides a pool of incentive to a business house for complying with certain terms and conditions. For example, let's say if you set up your business undertaking in this particular area, whatever cost you incur, will reimburse 30% of the cost that you have incurred. So maybe then a company sets up its factory there, maybe it incurs 50 crore rupees of cost. So what the company will have to do? The company will have to set up its undertaking there, submit the required documents and proof to the government department that it has complied with all the conditions which are set forth in the grant. The government will verify those documents and then approve the grant. So moment that grant is approved, it may take certain number of years for actual disbursement of money to come to the business, but once the government approves the grant, that is the point of time, right, when the recognition of government grant is made in the books of accounts. So government grants are recognized where there is reasonable assurance that the terms and conditions will be complied, the benefits have been earned, and there is a reasonable certainty that the ultimate collection will be made, and the reasonable certainty of ultimate collection will normally arise when the grant has been approved by the government. Mere receipt of the grant is not necessarily a conclusive evidence that the grant has been earned, in terms of maybe there might be a scenario that the grant has been provided by the government and the enterprise will have to comply with certain conditions in future. But just the fact that the grant has been received does not mean or does not provide the basis for recognition of grant as an income, because if the terms and conditions are not satisfied in future, the government may require the enterprise to refund that grant to the government. Now we'll talk about the accounting treatment of government grant. There is two school of thought. One school of thought says that you should follow the capital approach and you should treat the government grant as part of the shareholders fund. Normally we credit it to the capital reserve account. Another school of thought says that you should follow income approach. The government grant received should be treated as your income and should be credited to your statement of profit and loss as and when the benefits are received on an accrual basis. Now what should be the treatment, whether you should follow capital approach or whether you should follow income approach, depends upon the nature of the government grant. So if the nature of the government grant is of a promoter's contribution, means the grant has been provided based on the volume of investments which you are making. For example, let's say the government says that if you set up a factory in this particular area, whatever cost you will incur, we will reimburse 50% of that cost. So the government is operating like an entrepreneur, like a promoter, along with the person who is setting up the factory, and the government is reimbursing a part of the cost which is incurring setup of the factory. These grants will normally be treated as a promoter's contribution, and if the grant is in the nature of promoter's contribution, you should follow capital approach. For other grants, right, for other grants you should follow the income approach. So for grants which are similar to the promoter's contribution, you should credit it to the shareholders fund. Where do we credit it in the shareholders fund? We take it to the capital reserve. For other grants, you should follow income approach and recognize the grant on an accrual basis over the period to match the related expenses. Now, there are two circumstances under which the receipt of government grant is treated as extraordinary item. Normally, the receipt of government grant is not an extraordinary item, but only under these two scenarios, the receipt of government grant will be treated as an extraordinary item. One, when it is received as an immediate financial support, maybe that particular industry or that particular undertaking is going through financial hardship, and to bail that entity out, the government has provided some grant for immediate financial relief, or it is as a compensation for expenses or losses incurred by that enterprise in the previous accounting period, right? So in this case, right, there are no terms and conditions it had to comply, right? It has been given to survive that particular enterprise, and therefore these will be treated as extraordinary items. Now we'll talk about the treatment of various kinds of government grants which an enterprise receive. Normally we can let's say cover it in certain categories. The government grant could be of a non-monetary asset, it could be for a specific fixed asset, it could be in the nature of revenue, or it could be in the nature of promoter's contribution. We'll look at treatment of each one of them. Non-monetary government grant. Non-monetary government grants would mean that the government is not providing support in terms of cash disbursement, but it is providing certain asset to the enterprise. Maybe it is providing land, maybe it is providing plant and machinery, etc. So grant in form of non-monetary assets such as land or other resources. It could be two scenarios. Either the land is given to you at concessional price, maybe the cost of the land or the price of fair value of the land in a particular area is 10 crore. The government is providing you this land for 5 crore. This is treated as providing non-monetary asset as a concessional rate. Another thing could be it is given free of cost. It says that you set up your factory here, we'll give you, let's say, land free of cost. So if the non-monetary asset is given at concessional rate, the rate at which you have received it should be accounted as the cost of the asset. So if I buy it from the market, I would get it for 10 crore, but the government is giving me at concessional rate at 5 crore. So I should pass an entry land account debit 5 crore to government grant account, or let's say land account debit 5 crore to cash or bank account 5 crore, because 5 crore was a benefit and 5 crore was the actual cost which I had incurred in acquiring that land. If the land is given free of cost just for the purpose of identification in your books of accounts, you should record this land at some nominal value. Now what is this nominal value? It depends upon the size of your balance sheet. It could be 1 rupee, 10 rupee, 100 rupees, just denoting a value so that this asset can be identified in your books of account. Now presentation of government grant in relation to specific fixed asset. There are two approaches which could be followed, right? We look at the treatment of the two approaches. In method 1, the amount of grant received is reduced from the cost of the asset, right? And if the amount of grant covers the entire value of the asset will be shown as nominal value. We'll do it with the help of an example. In method 2, we'll see whether this grant relating to specific fixed asset is in relation to a depreciable asset or is it in relation to a non-depreciable asset. If it is in relation to depreciable asset, we will treat the government grant as a deferred income and we'll credit the amount of grant in the same proportion in which we debit the depreciation expense in relation to that asset in the statement of profit and loss. But if the grant is in relation to non-depreciable asset, we'll straight away take this government grant into capital reserve. So two approach: one, you let's say deduct the amount of grant from the value of the asset and depreciate the remaining value over the useful life of the asset. If the amount of grant covers the entire value of the asset, record the asset at some nominal value. Second approach, you see whether it's in relation to depreciable or non-depreciable. If it is in relation to depreciable asset, treat the amount of grant as a deferred income and credit some proportion from the deferred income to the statement of profit and loss in the same proportion in which you are charging depreciation on the asset in relation to which you have received this grant. If it is in relation to non-depreciable asset, you straight away take the amount of grant to capital reserve. We'll do it with the help of an example. Method 1, we will reduce the amount from the amount of the fixed asset. X Limited purchased a machinery for 5 lakh which has a useful life of 5 years. The government provided a grant of rupees 2 lakh. So when we purchase the plant machinery, we'll say machinery account debit to bank 5 lakh. When we receive the government grant, we'll say bank account debit to machinery account 2 lakh. So by this now the machinery is appearing in the books of accounts at 3 lakh. Now we'll provide depreciation on this amount of 3 lakh, 5 lakh minus 2 lakh, 3 lakh divided by useful life 5 years. We'll charge depreciation 60,000 per year. If we are following method 2 under the same circumstances, X Limited purchased a machinery on this date for 5 lakh which has a useful life of 5 years and government provides us as a grant of rupees 2 lakh. Now this is a depreciable asset. We'll treat this 2 lakh as a deferred income, right? So we'll say machinery account debit to bank 5 lakh. Bank account debit to deferred government grant account rupees 2 lakh. Now we'll depreciate this asset over a period of 5 years. Therefore 5 lakh divided by 5, 1 lakh will be the depreciation charge on this asset. Now this 2 lakh has to be credited to the statement of PL over the useful life of the asset. So 2 lakh divided by 5, 40,000 will be credited to the PL over a period of 5 years. Now see the net PL charge in the first method, the depreciation will be the PL charge. The net PL charge under the first method was rupees 60,000. In the second case also, the depreciation is the PL debit, whereas government grant is PL credit. Debit 1 lakh and credit 40,000. Net PL hit is 60,000 in this case as well. So under both the method, the amount of depreciation or the amount of charge to the PL remains the same. Just the method of presentation differs. In the first case, we reduce the value or the amount of government grant from the value of the asset. And the second case, we are treating the amount of government grant as a deferred income. Then presentation of government grant in relation to revenue. If it is in relation to revenue, credit the amount to the statement of profit and loss. Either you can show it separately or you can merge it under other income. Another option is deduct the amount in reporting relevant expense. For example, the grant is in relation to employee cost, right? Whatever employee cost we are incurring during the year, 20% of that cost is reimbursed to us in form of government grant. So it says you may net off that particular grant with the amount of your expense, but this approach is not considered appropriate because it will conceal impact of two items. My salary expenses will be understated and the amount of grant which I have received will not be reflected in the financial statement. So it is better that you show your salary expense at full value, and on the credit side you show the amount of grant which has been received. Now presentation of government grant which is in the nature of promoters contribution, this should be treated under the capital approach, and it should be taken under the to the capital reserve. You will do bank account debit to capital reserve. Now we will talk about refund of government grant. See, the government grant is not gratuitous. You have to comply with certain terms and conditions, and then only you become eligible to get the government grant. Even after getting the government grant, if you are non-compliant of certain terms and conditions which are associated with the government grant, the government may require you to refund that particular grant. So government grant are refundable because certain conditions are not complied, right? This will be treated as an extraordinary item, because normally it is believed that the enterprise will recognize government grant only when there is reasonable certainty that you will comply with the terms and conditions. The government grant is, let's say, earned, and there is no doubt about the ultimate collectability. But you let's say receive the government grant, subsequently you non-compliant with certain terms and conditions, you will need to treat this refund as an extraordinary item. Now we will see how do we treat with the refund of the government grant. So refund of government grant in relation to revenue means which has been recorded under the income approach. So if there is a deferred credit, if there is a deferred credit which is there in our balance sheet in relation to the grant which has become refundable, first you will debit the unamortized amount in the deferred credit, means such an amount, right, which is balance in the deferred credit account which you have not credited the PL till the date of the refund. If the amount of refund exceeds the unamortized deferred credit, then charge the excess to the statement of PL. We'll look at it with the help of an example, right? Let's say, or maybe complete the another scenario and we'll look at it both together. Where no deferred credit exists, right, you need to charge the refund immediately to the statement of profit and loss. So two scenario, if there's a deferred credit to the extent of balance there in the deferred credit, right, you reverse that credit, you will have to debit the deferred credit in relation to the government grant. If the refund is over and above the balance in the deferred government grant account, you need to debit the PL. And if there is no deferred credit in your books, very simple treatment, let's say debit the grant to the refund of government grant to the statement of PL. Let us look at it with the help of an example, it will be clear. X Limited has purchased a machinery on 1/4/2017 for rupees 5 lakh, which had a useful life of 5 years. Government had provided a grant of rupees 2 lakh, which had been treated as deferred income, right? You have treated this amount of 2 lakh as a deferred income. On 1/4/19, when the balance in deferred government grant account was 1,20,000, so on 1/4/19 the balance is 1,20,000, the grant become refundable due to non-compliance of the condition, and the amount of refund in first case is 1 lakh, in second case is 2 lakh. So if there is a deferred credit, you have to reverse that deferred credit. The balance in deferred credit is 120, whereas in the first case refund is only 1 lakh, so your entry will be deferred government grant debit 1 lakh to bank account 1 lakh. Balance 20,000 will be credited to the PL as per the proportion of depreciation on the asset. In the second case, the refund is 2 lakh. The balance in the deferred grant account is only 1,20,000, whereas the amount of refund is entire amount of 2 lakh. In that case, we will debit the deferred grant account with the amount of 1,20,000, which is the extent of balance in that. We paid back 2 lakhs, so the difference amount will go to the statement of profit and loss. Now we'll talk about refund of government grant in relation to specific fixed asset. So we have already discussed that when we receive the government grant in relation to specific fixed asset, there are two treatment we need to do. First, either we can reduce the amount of grant that we have received from the book value of the asset, or the second treatment is that if it is a depreciable asset, we'll treat it as a deferred income, and if it is a non-depreciable asset, we'll credit it to the capital reserve. So if you have reduced, if you have taken the first method, if you have reduced the amount of grant from the book value of the asset, when you are doing the refund, you have to increase the book value of the asset. So increase the book value of the asset, and depreciation on the revised book value is provided prospectively over the residual life of the asset. If you have taken it to capital reserve, you reduce the capital reserve, you will debit the capital reserve and you will credit the bank account. And if it is deferred income, we have already seen the treatment. Deferred income will be debited, bank bank will be credited. But if the refund is more than the amount of deferred credit, then you have to debit the statement of profit and loss. Then refund of government grant in relation to promoters' contribution. When the grant was received, it was taken to capital reserve. When the grant will be refunded, it will be debited to the capital reserve. You have to reduce the capital reserve account. Now, what disclosures do we need to make? We need to disclose the accounting policy in relation to government grant and the method of presentation of government grant in the financial statement, the nature and the amount of government grant recognized in the financial statement, including grants which are of non-monetary assets, either given as concessional cost or if they are given at free of cost. So, by this we are done with the contents of the accounting standard. Now we'll look at the practical exercise. I have covered certain very important questions, so please concentrate and let's go through this. Question number 1. A Limited purchased the machinery for rupees 40 lakh. The useful life of this machinery is 4 years and the residual value of the machinery is 8 lakh. Government grant received against this machinery is 16 lakh. So this is basically a depreciable asset, and in relation to this depreciable asset, which is machinery, I have received a government grant of rupees 16 lakh. Here I have two options to deal with it. Either I can reduce this 16 lakh from the book value of the asset, which is the first method, or I can treat this 16 lakh as a deferred income, which is the second approach. So the journal entry to be passed at the time of refund of grant in the third year, right? The grant is becoming refundable in the third year, and the value of the fixed asset at the end, right? If the grant is credited to the fixed asset, so if the grant when it is received, it is credited to fixed asset, when it is refunded, you will debit the fixed asset account. So if let's say 16 lakh rupees is refunded, right? If the entire grant of 16 lakh rupees is refunded, at the time of refund, under the first method, my entry will be fixed asset account debit to bank account, right? My entry will be machinery account debit to bank account 16 lakh because the entire amount has been refunded, right? You know that we need to first state the particular para from the accounting standard and then we need to deal with the case. So we'll say as per accounting standard 12, accounting for government grant, the amount refundable in respect of government grant related to specific fixed asset is recorded by first option increasing the book value of the asset, or by reducing the capital reserve, or the balance in deferred income as appropriate. Originally what treatment you do, you need to choose based on that. By the amount refundable, where the book value of the asset is increased, depreciation on revised book value is provided prospectively over the remaining useful life of the asset. A government grant that become refundable, very important, is to be treated as an extraordinary item. So in the first case, right, when the grant was received, you made an entry bank account debit to machinery account. When it is refundable, you will make an entry machinery account to bank. In this case, the receipt of government grant is credited to the asset account. Therefore, asset account should be debited when the amount of grant is refunded, and the revised book value should be depreciated prospectively over the remaining useful life of the asset. So here you will have to debit the asset account and credit the bank account. Let us look at the value of the asset. See, when the machinery was purchased, the cost of the machinery was 40 lakh. We credited the amount of grant to the value of the machinery. So 16 lakh which was received, we credited it, and the net value of the asset, right, in our books was 24 lakh. We provided depreciation for 2 years. 24 lakh is the book value, 8 lakh is the residual value, and divided by 4 is the useful life into 2 years, which we have already depreciated. So 8 lakh depreciation already provided by us. Book value at the beginning of the third year is 16 lakh. We made a refund of government grant of 16 lakh. So we added this 16 lakh to the value of the asset. So revised book value at the end of the third year will become 32. Now it says the book value has to be depreciated prospectively over the remaining useful life. Out of 4 years, 2 years already gone. So now this 32 lakh has to be depreciated over the period of remaining 2 years. So depreciation will be 32 lakh, which is the book value, minus 8 lakh rupees, which is the residual value, divided by 2, which is the remaining useful life. So 12 lakh will be the amount of depreciation, and the carrying amount of the asset will be 20 lakh in the first case. Now the second case says that the grant is credited to deferred grant account, right? So you did not adjust with the value of the asset, right? You took this 16 lakh to your deferred grant account, and in the same manner you provided depreciation. You credited some portion from the deferred grant account to the PL. So we'll see how do we deal with this. See, first we'll look at the balance in the deferred grant. Amount which was credited to the deferred grant is rupees 16 lakh, because 16 lakh worth of grant we had received, right? This is for 4 years. The useful life of the asset is 4 years. So 16 lakh divided by 4 into 2, right? We would have credited 8 lakh rupees to the PL, and at the end of the second year, there is a balance of 8 lakh rupees in the deferred grant account. So this balance we need to debit. So we'll say deferred grant account debit 8 lakh. But since our refund is 16 lakh, right, we need to debit PL by the remaining amount of 8 lakh. And we look at the value of the machinery. The value of the machinery is 40 lakh. We did not credit the grant, so we'll provide depreciation 40 lakh minus residual value 8 lakh divided by 4 into 2. 16 lakh is the depreciation provided in the asset, on the asset for 2 years. So book value becomes 24. Right, third year depreciation will be on 20, let's say 40 lakh minus 8 divided by 4, 8 lakh, and this will be the carrying amount at the end of the third year. In this case, there is no impact on the asset because we did not adjust the value of the grant on the asset. We treated the grant separately. We treated the grant as a deferred income. So here the asset accounting will not be impacted. Only when you are refunding the government grant, you need to debit the deferred grant account, and over and above the balance in the deferred grant account, the amount will be debited to the statement of profit and loss. Let's go on to the second question. Santosh Limited has received a grant of rupees 8 crore from the government for setting up factory in the backward area. So since Santosh Limited has set up factory in the backward area, it has received grant of rupees 8 crore. So this grant looks as in the nature of promoter's contribution, which is provided by the government based on the investment made by Santosh Limited in the backward area. Out of this grant, the company distributed 2 crore as dividend. Also, Santosh Limited received land free of cost from the state government, but it has not recorded it at all in the books of accounts as no money has been spent. So, two things. First, it has received 8 crore, out of which it has spent 2 crore as way of dividend. You cannot give dividend out of this because the government grant has to be used for the purpose. So, it is for the purpose of setting up a factory. So, this 8 crore is to compensate your capital cost. So, it should be used for that purpose itself. Second, the state government has given land free of cost. It is not recorded it at all in the books of accounts, but AS12 require us that if a non-monetary asset is received free of cost, that should be recorded at nominal value. So the Santosh Limited should have recorded this as nominal value. In light of AS12, examine whether the treatment is correct or not. Right? So both the treatment are not correct. So we'll say as per AS12, government grants available to the enterprise are considered for inclusion in the accounts. This is the recognition criteria where there is reasonable assurance that the enterprise will comply with the condition attached to them, where the benefits have been earned by the enterprise and there is reasonable certainty that the ultimate collection will be made. Mere receipt of the grant is not necessarily a conclusive evidence that the conditions will be complied. Then it says where the government grant is in the nature of promoter's contribution, they are given with reference to total investment in an undertaking or by way of contribution towards its total capital outlay, and no refund is ordinarily expected in respect thereof. The grant is to be treated as capital reserve because it is in the nature of promoter's contribution, which can neither be distributed as dividend nor can be considered as deferred income. So giving this as dividend is incorrect. In the given case, Santosh Limited has received a grant of 8 crore from the government for specific purpose of setting up factory in the backup area. When government grant is received for specific purpose, it should be used for that purpose. If it is not used for such specific purpose, it will result in non-compliance with condition of the grant and may lead to claim of refund of the grant by the government. In light of the above, giving of dividend of rupees 2 crore would lead to non-compliance of the condition and may result in appropriate action being taken by the government. In the second case, when non-monetary grant is received, right, in form of non-monetary asset given at free of cost, the same should be recorded in the books at nominal value. Based on the above facts, Santosh Limited should record the receipt of the land at free of cost at nominal value, which should be 1, 10, 100. Based on the size of the balance sheet, it should record it at an appropriate value. Now we'll go to sum number 3. Top and Top Limited has set up business in a designated backward area which entitles the company to receive from Government of India a subsidy of 20% of the cost of investment. So again, this looks in the nature of promoter's contribution because it is given based on the total investment which the company has made in setting up its business. Having fulfilled all the conditions under the scheme, the company on its investment of 50 crore in capital assets received 20%, means 10 crore of the crore from the government in January 17. which is accounting year 16-17, the company wants to treat the receipt of need to treat the receipt as an item of revenue and thereby reduce the losses on reduce the loss is on profit and loss account for the year ended 31st March 7. Is this treatment correct? Obviously no, because this grant is in the nature of promoter's contribution, which is being given based on the total outlay or investment in the undertaking. So it should be treated as in the nature of promoter's contribution, and it should be credited to the capital reserve. It should not go to the income. So this is what we have stated here. In the we have noted the text from the standard. In the given case, Top Limited has received government grant of rupees 10 crore based on total cost of investment made by it in setting up business in designated backward area. Therefore, the grant received by Top Limited is in the nature of promoter's contribution and should be treated as capital reserve. In light of the above, it is inappropriate on part of the company to treat this as an item of revenue and take it to the statement of profit and loss. Then we look at question number 4. How would you treat the following in the accounts in accordance with AS 12 government grants? Rupees 35 lakh received from local authority for providing medical facility to the employees. Rupees 100 lakh received as subsidy from central government for setting up unit in notified backward area. So in the first case, this 35 lakh is to compensate certain expense which the company will incur, because it is for providing medical facility to the employee. So the company is incurring certain expenses in providing medical facility, and the government is reimbursing that cost or the portion of the cost to the company. So this particular grant is in the nature of revenue. In the second case, 100 lakh rupees is received as subsidy for setting up of unit. So it is based on the investment made by the enterprise in setting up its unit. So this second item is in the nature of promoter's contribution and it should be taken to the capital reserve. So we have quoted the text of the standard, then we'll say 1. In the given case, rupees 35 lakh received from local authority for providing medical facilities to the employee is a grant received in the nature of revenue grant, because it is to compensate certain expense which the company is incurring. It should be presented as a credit in the statement of profit and loss, either separately or under the general header other income. Alternatively, 35 lakh may be deducted in reporting the related expense, but this is not the most preferable treatment because it will suppress two different events. Second, in the given case, subsidy received from the central government for setting up a unit in backward area is neither in relation to specific fixed assets nor in relation to revenue. It is given based on the cost of investment in setting up the unit in notified backward area. Thus, rupees 100 lakh should be credited to capital reserve because it is a grant in the nature of promoter's contribution. So by this we are done with our revision on accounting standard 12. Let us start on with revision of accounting standard 13, accounting for investments. First we'll quickly cover up the concept covered in the standard, and then we'll move on to some very important practical questions, right? So let us start on with the revision. First of all, accounting for investment, let us understand what do we mean by investments. Investments have been defined as asset held for earning income. So the purpose of holding this asset is earning income, and you will earn income by way of dividend, by way of interest, and by way of rentals. When we say dividend, we refer to equity shares or preference shares. If we say interest, it could be some investment in bonds or debentures, etc. And rentals, maybe we have taken a property and we have given that property on rent. For capital appreciation, so the purpose of holding this asset is to have appreciation in the capital or the amount which you have invested on the asset. For example, if you buy equity shares of Reliance Industries for 1000 rupees, the primary objective is that after a certain period of time, when the price increases maybe to 1500, 1800, we'll sell off those equity shares. Or maybe we have made investment into gold, investment into silver with the perspective of capital appreciation in future. And for other benefits to the investing enterprise, there could be a scenario that one enterprise wants control over the other enterprise for strategic reasons, and that is why this investment has been made. So investments are asset held for earning income by way of dividend, interest, and rentals, for capital appreciation or for other benefits to the investing enterprise. Asset held as stock in trade will not be considered as investment. Now when we talk about classification of investment, the classification of investment would largely depend upon the nature of the investment, whether it's a short-term investment or it's a long-term investment, or it majorly depends upon the intention of the management, whether the management intends to hold it for a short period of time or the intention of the management is to hold it for a long period of time. So investment is largely classified into two categories. One is current investment, other is long-term investment. Current investments have been defined as that by nature they are readily realizable, so they are liquid. Whenever the enterprise wants to sell it, the enterprise can dispose of and realize the cash, and intended to be held for not more than 1 year. So the intention of the management at the time of acquisition of the investment is to hold it maximum for a period of 1 year. If we talk about long-term investments, they have been defined as investments which do not qualify as current investment will be treated as long-term investments. So maybe these are not readily realizable, or maybe they are held for a period of longer than a period of 1 year. Now we'll talk about the valuation norm. If we talk about current investment, current investments have to be valued at lower of cost or fair value. Fair value is generally the market value of the investment. So this again is on the basis of prudence and conservatism, where if we see that the market value of the investment is less than our cost, there is a probable loss which we may face in future, and therefore we'll recognize that loss upfront. So current investments have to be valued at lower of cost and fair value. And when you are comparing the cost and fair value, it is not that we have to compare the cost of all the investment in aggregate and fair value of all the investments in aggregate. We have to make this comparison on an investment and investment base. For example, I am holding shares of Reliance Industries, of Tisco, of Infosys. So I have to compare individually the cost and fair value of Reliance, individually the cost and fair value of Tisco, individually the cost and fair value of Infosys, and then arrive at the lower of the two. The comparison cannot be done on a totality basis. Any gain or loss on such comparison has to be taken to statement of profit and loss. Then we talk about the valuation norm for the long-term investment. Long-term investments are usually held for a long period of time, and it is believed that short-term fluctuation in the price of the investment does not impact the investment. Therefore, long-term investments are usually carried at cost. But if there is other than temporary decline, right? If there is other than temporary decline in the value of the investment, then we will reduce the investment to its fair value or the realizable value, and we will record that particular loss to the statement of profit and loss. So we normally say that if these investments are, there is an impairment or there is a loss of a permanent nature, right, other than temporary nature, then we need to make a provision for diminution in the value of investment. Usually these investments are carried at cost. Then we'll talk about cost of the investment. The cost of investment is the purchase price plus certain acquisition charges which are incurred while you are buying the investment. For example, if you are buying equity shares, we may have to pay certain brokerages, duties, etc. while acquiring it. So the cost of the investment is the purchase price plus the acquisition charges. Acquisition charges would normally be brokerage fees and duties. Now there could be a scenario that we are acquiring an investment, but the consideration for that acquisition is not paid in cash. The consideration may be paid by issuing other shares or securities, or the consideration may be paid by issuing some other asset. For example, I am buying shares of Reliance Industries, and for buying the shares of Reliance Industries, I am paying the person by let's say my investment or my holding in shares of Infosys. Or maybe there could be other way, I am buying shares of Reliance Industries, but I am paying the purchase consideration by transferring my land and building to the person who is selling me these shares. So let us look at this scenario. Investment acquired or partly acquired by issue of shares or securities. The acquisition cost of the investment will be the fair value of securities issued. So if I am buying the shares of Reliance Industries and in consideration I am giving the shares of Infosys, the acquisition cost of shares in Reliance Industries for me will be the fair value of the shares of Infosys which I have transferred. In exchange of another asset, look at the fair value of the asset which you have given up. Or you can also look at the fair value of the investment which you have acquired if the fair value of that investment is more clearly evident. Why is this? Because there could be a scenario, maybe I am giving up an asset, the fair value of that asset is not clearly evident, but generally it could be a scenario that the investment which I am acquiring, the fair value of that investment would be more clear. So therefore it says that if you are exchanging an asset and getting an investment, look at the fair value of the asset which you are giving up. You can also look at the fair value of the investment acquired if that fair value is more evident. Then we'll talk about treatment of interest, dividend and rental. We have seen that the main purpose of holding these investments is to earn income by way of dividend, interest and rental. So how do you deal with it? These are incomes, right? These are incomes and these have to be taken to the statement of profit and loss. But there is an exception. There could be an income which could represent recovery of past cost, right? This is a scenario in case of pre-acquisition dividend. When we get pre-acquisition dividend from a company in which we are holding equity shares, we normally treat that pre-acquisition dividend as a credit to our cost of investment, and we do not take this pre-acquisition dividend to the statement of profit and loss. We'll look at it with the help of an example. Let's say we purchase 1000 shares of Reliance Industries on 5th of June 2021. So the financial year is 21-22. Record date for dividend for 2021. See, this is our current year and this is the previous year, is 15 June 2021. So I have purchased shares on 5th of June. The record date for payment of dividend is 15th of June, right? And this dividend is obviously for the previous year. I received this dividend on 28th of June 2020, right? This will be treated as pre-acquisition dividend because dividend is from the profits of financial year 2021, but I became a shareholder in the financial year 21-22. By virtue of holding these shares on the record date, I have received this dividend. This will be treated as pre-acquisition dividend, and this division should be credited to the cost of the investment, right? So we will basically reduce the cost of the investment to the extent of the dividend which I have received. Now we'll talk about the right shares. See, right shares, we know that any further issue of shares have to be first offered to the existing shareholders of the company, right? So when the company comes up with right issue of shares, the company will give the existing shareholder an opportunity or an option to subscribe to the new shares. The shareholder, right, at its discretion has a right either to buy these shares, or the shareholders may also share his right entitlement in the market. So it says when right shares are offered, the shareholder can buy or subscribe to the right shares. So if I am buying or subscribing to the right shares, I am originally holding the shares of the company. By virtue of this existing holding, the company is giving me right shares. So when I am buying these right shares, the cost of these right shares will be added to the cost of my original holding. The cost of this right share is added to the carrying value of the existing investment. The other option, if I don't want to buy the right shares, then the other option is to renounce the right entitlement, right? I will sell these right entitlement to somebody else who may be willing to buy the right shares of the company, and the sales proceeds of these right entitlement is normally taken to the statement of profit and loss. But there is an exception. If this investment is acquired on cum right basis and immediately after the investment becomes X right and the X right price is lower than the cost of acquisition, then in that case the renunciation proceeds should go ahead and reduce the cost of my investment to its market price. Interesting scenario. We'll have a look at it with the help of an example. Let's say Reliance Industries Limited announced right issue of 1 share for every 2 share held on 1st of June 2020, and the price at which it is offering shares to the existing shareholder is 1800 per share. The record date for right issue is 8th June 2020. This means that whosoever is holding these shares of Reliance Industries Limited on 8th of June 2020 will be eligible to get the right shares, and the right shares will be offered as 1 share for every 2 shares held. Based on this, we purchased 1000 equity shares of Reliance Industries on 7th June 2020. See, the price or the market price which will be prevailing in the market between 1st June 2020 and 8th June 2020 will be known as the come right price. Why it will be known as come right price? Because more people will be interested in buying these shares. The demand for the shares of Reliance Industries Limited will be high during this period, because by virtue of buying these shares in this period and holding it till the record date, which is 8th of June, right, the holder of the share will be entitled to get right shares, and normally right shares are issued to the existing shareholders at a discount to the market price. So since the demand for the shares will be more, the price of the Reliance shares will increase and they will trade at a premium, and this price will be treated as come right price. So we have acquired 1000 shares of Reliance on 7/6/2020, which is between the announcement date and the record date. So the price at which we are buying it is known as a come right price. So we bought it at 1900 per share to be eligible to get the right shares. Subsequently, we purchased 80% of the right entitled to us, and the balance right entitlements were sold at the rate, you can write, let's say 70 per share. So 80% of right shares we purchased and 20% of the entitlement we sold to somebody else who wanted to buy these shares. Now we'll see how to deal with it. Number of right entitlement, we had 1000 shares. For every 2 share we'll get 1 share, therefore 500 right entitlements I will get. We purchased 80%, right, therefore 500 entitlement into 80% into 1800, which is the price at which the right shares are offered, so 7,20,000. Our entry will be investment in equity shares of Reliance Industries to banks. So we have purchased this share and we accumulated the cost in the investment ledger. Sold the right entitlement, so out of 500, 20% has been sold and we are selling it at the price of 70. So we have received rupees 7,000 by selling these right entitlement. Now what we need to see, that since we have purchased in the come right period, had it been that we are holding these shares even before the right issue was announced, we don't need to do this treatment, right? Directly the renunciation proceeds will go to the statement of profit and loss. This treatment we have to do only because we have purchased the shares in the come right period. We have purchased it at a come right price. So we need to be careful. We need to look at it that once this share becomes X right, means on 9th of June when the price opens in the share market, we'll have to have a look at that price. So the X right price on 9th June, right, 2020, in case 1 it is 1950, in case 2 it is 1895. Please do it as 1895. In case 3, it is 1880. So in case 1, we can see that the X right price after the record date of right issue is 1950 is greater than the come right price of 1900 at which we had purchased these shares. Therefore, entire thing is to be taken to PL, because this treatment of crediting to the cost of the investment will come only when the come right price is greater than the X right price. Here the X right price is greater than the price at which we purchase, so we don't need to do any additional treatment. In the second case, the X right price after the record date is 1895. It is less than the come right price at which we had purchased the shares of 1900. So the notional loss, why notional loss? Because we haven't sold this off as yet. In future the price may increase. This is just to take a decision on the fact that whether we take the entire renunciation proceeds to the PL or the renunciation proceeds should be credited to the cost of the investment. So in this case, our notional loss is 5,000, 1,000 shares we had purchased. We had purchased at 1900. Now the X right price is 1895. There's a notional loss of 5,000. So we'll say bank account debit, because total we have received 7,000 by selling the rights, right? Investment we will credit by 5,000 to the extent of notional loss, and balance 2,000 will be credited to the statement of profit and loss. In the third case, the X right price is 1880, which is obviously less than our come right price of 1900 at which we had purchased the shares of Reliance to get entitled to buy the right shares. So here the loss is 20,000. The notional loss is 20,000. In this case, entire renunciation proceeds will be credited to the cost of the investment. Please remember that this treatment will come only when the shares were purchased during the come right period, and immediately after the record date of the right issue, the X right price is lower than the come right price at which we had purchased the shares, right? Otherwise, always the renunciation proceeds will go to the statement of profit and loss. Then we'll talk about disposal of investment. Disposal of investment is basically the difference between the net sales proceeds of the investment less the carrying amount of the investments in our book, and this carrying amount will be calculated on the basis of average method. The difference, profit and loss, will be taken to the statement of profit and loss. Then we'll talk about reclassification of investment. We have seen that we classify investment as current and as long term. Current investments are valued at cost or fair value, whichever is lower. Long-term investments are usually carried at cost, but if there is other than temporary decline in the value of the investment, then we recognize a provision for diminution to bring it down to its fair value. So if we are classifying, means earlier we had classified the investment, when we acquired that investment we classified it as long term. Now we have changed our intention of holding it, and now we want to classify as current. Or it could be vice versa, that initially when we acquired the investment we classified it as current investment, and afterwards we are changing our intention, we want to hold it for a long period of time, and we are classifying it to long term investment. Please remember, when we are reclassifying from long term to current, the rule for long term is that it should be carried at cost, but if there is other than temporary diminution, then we need to recognize a provision and the value of that investment will reduce. So the transfer will be made at lower of cost or carrying amount. Carrying amount might be lower if we have recognized a provision, only if there is other than temporary decline in the value. So this reclassification will be done at cost or carrying amount, whichever is lower at the date of transfer. If we are transferring current investment to a long-term investment, the rule for valuation of current investment is cost of fair value, whichever is lower. Same treatment will prevail. The transfer will be made at lower of cost or fair value, whichever is lower on the date of the transfer. Then we'll also talk about investment property. See, normally when we talk about land and building, we straight away think about PPE AS 10. AS 10 says that PPE is an asset which is held for use in the business, and it is intended to be held for a period of more than 12 months. But investment property is an investment in land and building not intended to be occupied substantially for use by or in the operations of the investing enterprise. So the intention of holding a land and building as a PPE is using it in the business. Here we are holding land and building, but the intention is not to use it in our business, but to hold it for maybe capital appreciation purpose or maybe for earning rental purpose. Therefore, it is to be treated as investment property. So what is an investment property? It is an investment in land and building which is not intended to be occupied substantially for use by or in the operations of the enterprise. How do you deal with this investment property? It says that you deal it with the cost model which you have learned in accounting standard 10, property, plant and equipment. Then we'll talk about certain disclosures which we need to make. We need to disclose the accounting policy for determining the carrying amount. So if it's a current investment, cost of fair value, whichever is lower. If it's a long-term investment, usually carried at cost. And if there is a reduction because of other than temporary decline in the investment, we'll record a provision. Then we'll have to show how much of interest, dividend, rentals we have recorded in PL. If there's a disposal of investment, what is the profit and loss on disposal? If there is a change in the carrying amount of investment, we need to disclose in the PL. If there are certain significant restrictions on the right of ownership, realized liability of the investment, remittance of the sales proceeds or the income related to the investment, we need to disclose it in the notes to account. We need to state the total amount of quoted and unquoted investment. Quoted investments means those investments the price of which is available in the stock exchange is quoted investment. Unquoted investments are usually those investments which are not listed on any recognized stock exchange. And if we are holding quoted investment, we need to tell the total market value. We need to also disclose the total market value of our quoted investments, and whatever other disclosures are required by Schedule 3 of the Companies Act, that also needs to be dealt with. So now we are done with the concept portion of the standard. We'll start with the practical exercise. Let's come to question number 1. It says an unquoted long-term investment is carried in the books at cost of rupees 2 lakh. The published accounts of the unlisted company which are received by us on May 2017 showed that the company was incurring cash losses with decline in market share, and the long-term investment may not fetch more than 20,000. So our normal rule is that long-term investment should be carried at cost. But if there is other than temporary decline in the value of the investment, we will have to provide for that loss. So here the company is incurring cash losses, right? The market share is reducing. So it could be an indicator of the fact that there is other than temporary decline in the value of the investment, and we may need to let's say recognize a provision for diminution in the investment to the extent of 1,80,000, which is the difference between 2 lakh and 20,000. We bought it for 2 lakh, our cost is 2 lakh. But currently if we go and sell this investment, it may not sell for more than 20,000. So there is an impairment or there is a loss to the extent, or a probable loss to the extent of 1,80,000. How will you deal with this in preparation of financial statement of R Limited for the year ended 2017? So we'll have to provide for this loss. So whenever we write an answer for accounting standard, first we'll quote the relevant paras from the accounting standard, then we'll say our analysis of the case, and finally the conclusion paragraph, right? So I'll read it for you. As per accounting standard 13, right? Long-term investments are usually carried at cost. However, where there is a decline other than temporary in the value of the long-term investment, the carrying amount is reduced to recognize the decline. Such reduction in carrying amount is charged to the statement of profit and loss. Then the standard says that the indicator of other than long-term decline in the value of investment can be obtained with respect to market value of the investments, the performance or the results, the asset, the expected cash flows from the investment, right? So we are saying in the given case, R Limited holds an unquoted long-term investments which is carried in the books at cost. The published account of the unlisted company shows that the company is incurring cash losses with decline in market share, and the long-term investment may not fetch more than 20,000. The fact that the company is incurring cash losses and there is a reduction in the market share is an indicator of other than temporary, right? It's an indicator of other than temporary decline in the value of the investment. In this situation, the company should recognize a diminution in the value of the investment to the tune of 1,80,000 and the reduction in the carrying amount of and reduce the carrying amount of the investment to 20,000. The reduction of 1,80,000 should be charged to the statement of profit and loss. Clear? Next, question number 2. X Limited on 1st of January 17 had made an investment of 600 lakh in equity shares of Y Limited, of which 50% is made under long-term category and rest under temporary investment, means these are treated as current investment. The realizable value of all such investments on 31st March became 200 lakh as Y Limited lost a case of copyright. From the given market condition, it appears that reduction in the value is not temporary. So it is a reduction which is of an other than temporary nature. How will you recognize the reduction in the financial statement for 31st March 17? So here what is happening, total investments which have been made is 600 lakh, 50% is current and 50% is long current. So 300 is current and 300 is long term. Now, the rule for current investments is cost of fair value, whichever is lower. So for current investment, the cost is 300 lakh. Total investment is 200, of which 100 lakh will be under current category and 100 will be under long term category. So 300 and 100, therefore 100 is the value at which the current portion of the investment will be carried on. Long term investment, we know that it is usually carried at cost, but here we can see that the decline is of other than temporary nature, so the long term portion should also be reduced, right? Reduce, and a diminution in the value of investment should be recognized. So total value of the investment at which it will appear in the balance sheet will be 200 lakh, 100 lakh will be in the current category, and the another 100 lakh will be under the long term category. So you can read through this, everything has been explained. We'll go to question number 3. Measures Innovative Garment Manufacturing Company Limited invested in shares of another company on 1st October 16 at a cost of 2,50,000. It also earlier purchased gold for 4 lakh and silver for 2 lakh on March 14. The market value of all these on 31st March 17, which is the current period, right, is shares 225. We purchased it for 250 in October 16 and in 17 it is 225. So there is a reduction. For gold 4 lakh it has become 6 lakh, silver 2 lakh it has become 3 lakh 50. So other two investments there is no worry because the fair value is greater. For shares the value has reduced. We purchased it in October 16 and we are 31st March 17, a 6 month of holding. Let's see whether they have told about their intention of holding it for what period. How above investment should be shown in the books of measures innovative for the year ended 31st March 17 as per the provision of accounting standard 13. So what we could say is that for shares they haven't told us whether they intend to hold it for a period of up to 1 year or more than that. So we may say that if this investment is to be treated as current investment in shares, then we'll apply the rule cost of fair value whichever is lower, and it should be valued at 2,25,000 and 25,000 of loss should be recorded in the statement of profit and loss. But if we are considering this investment in shares as a long-term investments and there is no indicator or there is no fact stated that this is other than temporary decline, so this shares investment in shares will continue to be carried at 2,50,000 in the financial statement. Gold and silver have been purchased in 2014 and now we are in 2017, so it is apparent that the investment in gold and silver is for a long-term basis and also there is no decline in the value of that investment, so these should be carried at cost. So we have stated, we have drafted the answer. You can read through the answer. We have discussed the facts. Let's go to question number 4. ABC Limited wants to reclassify its investment, right? So it is reclassification. We have already discussed from long-term to current. Cost or carrying amount, whichever is lower on the date of the transfer. From current to long term. For current, we will say see cost or fair value, whichever is lower at the date of transfer. So ABC Limited wants to reclassify its investment in accordance with AS 13, decide and state the amount of transfer based on the information. A portion of current investment purchased for 20 lakh to be reclassified as long-term investment as the company decides to retain them. The fair value, the market value on the balance sheet date is 25. So the cost is 20, fair value is 25. Our rule is cost of fair value, whichever is lower. So the reclassification has to be made at 20 lakhs. Clear about this? We'll compare the cost and fair value, whichever is lower will be the value at which the transfer shall be made. Another provision for current investments purchased. Another portion of current investment purchased for 15 lakh is to be reclassified as long term. The market value of these investments is only 6.5 lakh. So cost or fair value, whichever is lower. So in this case, reclass has to be made at 6.5 lakh because the fair value is lower. In the third case, certain long-term investments no longer considered for holding purpose to be reclassified as current. So long-term to current, so it will be cost or carrying amount, whichever is lower. The original cost is 18 lakh but had been written down to 12 lakh. So it might be there was some other than temporary decline in the value of the investment and they have bought this investment down to 12 lakh, right? To recognize other than temporary decline. So here the cost is 18, the carrying amount in the books is 12. So cost or carrying amount, whichever is lower. So here the reclass has to be made at 12 lakh, right? So we have drafted it. In the first case, we have said that the transfer should be made at 20 lakh. In the second case, we have said that the transfer should be made at 6.5 lakh. And in the third case, we have said that the transfer should be made at 12 lakh based on lower of the two comparable amounts, right? So by this we are done with the revision of accounting standard 13. Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with this. Right guys, so let us start on with the revision of accounting standard 16, borrowing costs. First we'll cover up the contents of the standard and then we'll move on to certain very important practical questions from the exam perspective. When we say borrowing cost, in the most simple sense, it would mean the expense which we incur in relation to the loans which we take. So borrowing costs are interest and other costs which are incurred by an enterprise in relation to borrowing of funds. All of us know about interest, and we also know that the interest expense is charged to PL, but this standard will suggest another treatment wherein under certain circumstances we can accumulate the interest expense or the borrowing cost with the cost of certain assets. So let us look at the definition of borrowing cost. Borrowing costs are interest and other costs incurred by an enterprise in relation to borrowing of funds. Borrowing cost may also include interest and commitment charges. Interest, all of us know, which is on time proportion basis, right? It is at a certain rate which is pre-agreed between the borrower and the lender. What are commitment charges? Let's say if I go to a bank or a financial institution and I tell them that I want a loan of rupees 100 crore. Out of this 100 crore, during the year I utilize only 60 crore. So I have blocked their borrowing or lending capacity to the extent of 40 crore because I will pay interest only on the amount which I have utilized of 60 crore. But this 40 crore they have blocked for me, I may withdraw it whenever I want. So if I am not utilizing this 40 crore, the bank will ask for certain penal charges or commitment charges which I need to pay. Then amortization of discount or premium in relation to borrowing. Let's say we are issuing debentures for a period of 5 years, and if these debentures are issued at discount, this discount is an expense to the company which it needs to charge up to the PL over a period of 5 years. Maybe our debentures are to be redeemed at a premium, so this extra which the company is paying, right, is also treated as borrowing cost, and it has to be amortized over the period of the debenture. Amortization of ancillary costs in relation to borrowing. So when we are doing borrowing, right, there are certain expenses which are incurred in relation to arrangement of fund. Maybe we need to submit our project report, we need to make financial statement in the way the lender wants it. So these costs which are incurred in relation to arrangement of funds will also be treated as borrowing costs. Finance charges in relation to a finance lease will also be treated as borrowing cost. And para 4E, which is very important, exchange difference arising on foreign currency borrowings to the extent it is regarded as an adjustment to interest cost. Let us understand this para 4E with the help of an example. See, when I want to borrow certain funds, I will have an option either to borrow it from India at a rate which is offered to me in India, or I may do a foreign currency borrowings as well, and normally it is seen that the foreign currency borrowing, the interest rate is lower as compared to the Indian rate. Let's take an example. Let's say I want to borrow 73 lakh rupees. I have an option to borrow it from India, let's say at an interest rate of 11%, or I can borrow this same 73 lakh rupees from US in a USD loan, and I will have to pay interest at the rate 6%. So if I am taking a foreign currency rate loan, the interest will be paid at 6%. If I am taking the same loan, same amount in India, I have to pay 11%. So there's a difference of 5%, which definitely a business would like to save. But if I am taking a foreign currency loan, I am also exposing myself to foreign currency fluctuation, and I may incur certain losses if there is an adverse movement in the exchange rate of Indian currency vis-a-vis the USD. So therefore this saving which I am doing in interest, right, the difference which is the amount of interest which I would have paid had I taken an Indian currency loan at the rate prevalent in India, and the interest which I actually pay on the foreign currency loan is the saving which I am doing in the interest expense. And for doing this saving, I am taking a risk. I am exposing myself to foreign currency fluctuation. So foreign currency fluctuation to the extent of this amount of interest I have saved will be treated as interest expense and will not be regarded as exchange difference under accounting standard 11. Let us look at it with the help of an example. Let's say X Limited takes a USD loan of $10,000. Sorry, make it as $1 lakh. X Limited takes a USD loan of $1 lakh on 14X1 at an interest rate of 6% payable annually. Same loan in INR, which is our local currency, could be taken at 11% per annum. So there's a difference of 5% which the company want to save. The exchange rate on 14X1 is 73, and the exchange rate at the year end, which is 31st March X2, is 78. So when I take this loan on 11X1, I am taking $1 lakh and the exchange rate is 73, so I will get 73 lakh rupees in my account. At the end of the year, I have to pay interest at the rate 6%. So $1 lakh into 6%, and I'll convert it at the year-end rate of 78. I need to pay an interest expense of 4,68,000. Now, there is a difference in the exchange rate. I'll calculate foreign currency fluctuation. I had taken a loan and my liability was recorded at 73. Now at the year end, the exchange rate is 78. So there's a loss to the extent of 5 rupees per dollar, which is 78 minus 73. So total exchange difference is $1 lakh into the closing rate and the rate at which I had taken the loan. The 5 lakh rupees is my exchange difference, less considered interest expense as per above para 4E, which is the interest expense had the loan been taken in INR minus actual interest expense on USD loan. We all know that the actual interest expense on USD loan is 468. Had I taken this same amount of 73 lakhs in India, I would have paid interest at the rate 11%. So 73 lakhs into 11% minus 4,68,000 is the amount I tried to save by taking this loan. So I saved 3,35,000, whereas the exchange loss happened to be 5 lakh rupees. So to the extent of this particular savings, this will be treated as an interest expense, and balance amount will be treated as my foreign currency fluctuation. So the actual foreign currency fluctuation of 5 lakh will be divided into two portions. One portion will be treated as interest expense, another portion will be treated as foreign currency fluctuation. The interest expense will be 335 and balance 165 will be considered as my foreign currency fluctuation. So when I will make my profit and loss account, right, when I will make my profit and loss account, I will say actual interest which I have paid is 468. To interest expense, this is as per para 4E, which is 335, and I will say to exchange loss, which is 165. This is basically breaking my foreign exchange loss into two segments. One portion which is the savings which I have tried to make, right, in interest by taking a foreign currency loan, and the next portion over and above will be treated as my foreign currency fluctuation. Then we all know that what is the treatment of borrowing cost. Generally, we know that the interest expense or these expenses will be charged to PL. But I have already told you that this standard will give us another treatment, that in certain circumstances we can capitalize the borrowing cost with the cost of certain assets. So let us look at the treatment. Borrowing cost which is directly attributable to acquisition, construction or production of a qualifying asset should be capitalized as part of the cost of the asset. Other borrowing cost should be recognized as an expense in the statement of profit and loss. So any borrowing cost which is directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized or should be added to the cost of that asset. Let us understand what do we mean by a qualifying asset. Qualifying asset has been defined as an asset which necessarily takes a substantial period of time to get ready for its intended use. So we are referring to PPE, or sale, so we are referring to inventory. So qualifying asset is an asset which necessarily takes a substantial period of time to get ready for its intended use, referring to PPE, or sale, referring to inventory. And what is this substantial period of time? This substantial period is generally treated as 12 months unless a shorter or a longer period can be justified. Then it is said that these items will never be treated as qualifying asset. Inventories which are routinely manufactured on a repetitive basis of a short period of time, and the assets which are ready for use or sale. For example, let's say we are constructing a factory building, and this factory building will take 3 years to be constructed and become ready for use. So since it is taking substantial period of time, interest expense which is incurred in making this building, right, will be treated as, let's say, borrowing cost which is related to a qualifying asset. This building will be treated as a qualifying asset because it is taking substantial period of time to get ready for its intended use. But if there's a ready factory building, right, it's ready for use, I buy that particular building, right, it will not be treated as a qualifying asset because at the time of its acquisition, it is ready for use. It is not going to take a substantial period of time to get ready, right? So same asset, building, if I am constructing it and it is taking a substantial period of time, it is a qualifying asset. Building which is ready for occupation, ready for use will not be treated, and if I am buying it, it will not be treated as a qualifying asset. Then what is directly attributable expense? Directly attributable expense is so direct that if you are not making the qualifying asset, that expense will also not be made. Therefore, that borrowing cost which is directly attributable to the acquisition, construction or production will be treated as borrowing cost which is eligible for capitalization. Now we'll talk about recognition of borrowing cost. Borrowing costs are capitalized when these two conditions are satisfied. First, it is probable that the future economic benefits from that asset will flow to the enterprise and the cost can be measured reliably. Borrowing cost eligible for capitalization. See, when you are making a qualifying asset, right, you could either take a specific loan to construct that asset, or you could have a pool of loans which are there, and some portion out of that pool of loan could be used for the construction of qualifying assets. For example, we are making a factory building, and for the very purpose of making this factory building, we take a loan of 10 crore rupees. So this will be treated as specific borrowing. Let's say we are making a building, right? We will incur 10 crore rupees to build this particular building. We have loans to the extent of 25 crores which are taken for various purposes, and then from that pool, we withdrew 10 lakh rupees, or we utilize 10 crore rupees for the construction of this building. That will be treated as general borrowing. So, specific borrowings, when funds are borrowed specifically to obtain a qualifying asset, it will be treated as specific borrowing. General borrowing, funds borrowed generally and used for the purpose of construction or acquisition or production of a qualifying asset. Now, what is the amount of borrowing cost that is to be capitalized? Since this specific borrowing is directly attributable or directly related to the qualifying asset, the entire amount of interest expense which we pay on this borrowing should be capitalized with the cost of the asset. Actual borrowing cost incurred on specific borrowing, less income on temporary investment. For example, we have taken a loan of 10 crore rupees to make this factory building. Initially, we have to spend 6 crore rupees. The remaining 4 crore rupees have to be paid after, let's say, 6 months. So for that interim period, we invest this 4 crore rupees and earn some interest out of it. So we need to calculate interest on entire 10 crore less the amount of income which we earn by temporarily investing this residual amount of 4 crore, right? The balance amount will be treated as the amount of borrowing cost which needs to be capitalized. But in relation to general borrowing, maybe we have 5 loans all taken at different rate, all having a different amount of borrowing. In that case, we need to calculate a capitalization rate. What is this capitalization rate? This capitalization rate is the weighted average rate of all the borrowings with the enterprises taken other than the specific borrowing. The amount of expenditure incurred on the qualifying asset into this capitalization rate will give us the amount to be capitalized in relation to this general borrowing. How do we calculate the capitalization rate? Total interest expense excluding interest on specific borrowing divided by total borrowing excluding the specific borrowing. So here, while we are doing the capitalization rate, always remember we will exclude the specific borrowing while doing this computation. Amount to be capitalized will be the amount of expenditure on qualifying asset into the capitalization rate. Under practical examples, under practical sums, we have covered a sum, so don't worry, we'll look at the practical solving purpose as well. Commencement of capitalization. When will you start capitalizing this borrowing cost to the cost of the asset? When all the following conditions are met, right, you will start the commencement of capitalization of your borrowing cost. First, your expenditure on the qualifying asset is being incurred. Second, the borrowing cost has been incurred, and third, the activity necessary to prepare the asset, right, for its use or sale is in progress. When all these 3 conditions are satisfied, your borrowing cost can be capitalized with the cost of your asset. So we'll take an example. Let's say we took a loan for this particular asset on 11x1. Our financial year is January to December of rupees 10 lakh at 10%. Expenditure on qualifying asset is incurred on 16x1, right, for which period borrowing cost should be capitalized. Obviously, it says that all the 3 conditions is satisfied. Expenditure on the borrowing, on the qualifying asset is incurred, expenditure is incurred on this date, whereas the borrowing cost is incurred from this date. So, from 1st of January till 31st of May, there was no work or expenditure incurred on qualifying asset. So, the period for which the borrowing cost should be capitalized is is from 1st of June X1 to 31st December X1. Prior to that, whatever borrowing cost which we are incurring will be charged off to PL. Another example, let's say construction is started from 1st of January, but we have taken loan from 1st of July. So the borrowing cost is getting incurred from 1st of July. So the period for which capitalization will take place is 1/7 to 31st December. Because in this case, prior to 1st of July, there is no borrowing cost which is being incurred. Now we'll talk about suspension of capitalization. See, we are making a qualifying asset. We are eligible to capitalize the borrowing cost to the cost of the qualifying asset. Now, there could be a scenario where for a temporary period, the work is halted, right? Which leads to no work being done on the qualifying asset. Therefore, for that particular period, you will not capitalize the borrowing cost to the cost of the asset, but you will charge off this borrowing cost to the statement of profit and loss. The best example could be when there was a lockdown in relation to this COVID-19 scenario. All the establishments were closed and there was no work being carried out. For this period of 2 months when the lockdown was there, the borrowing cost cannot be capitalized because it was the cost of holding a partially completed asset, right? There was no work which was actually done on that asset. So capitalization of borrowing cost should be suspended, that is the expense should be charged to statement of PL during the extended period in which active development is interrupted. Another example could be we are let's say constructing a qualifying asset. There's a labor unrest, there's a strike in the factory, right? The strike continues for 4 months. So for this 4 months period also, we will not capitalize the borrowing cost. We'll have to charge this borrowing cost to the statement of profit and loss. Borrowing cost incurred during the period of interruption is considered as cost of holding partially completed asset and do not qualify as capitalization. Capitalization of borrowing cost is normally not suspended when substantial technical and administrative work is done. So actually no physical work is carried out on the qualifying asset, but maybe certain designing, drawing, layout, etc. work is done, right? So the work is being done, therefore you should not suspend capitalization. During temporary delays, which is necessary part of getting the asset ready for its use. I could give you an example. Let's say when construction of building is there, you do casting of the first floor, then you do the casting of the second floor, then you do the casting of the third floor. These casting take, let's say, 20 days to solidify, right? You need to stop the work for 20 days so that this casting could actually become concrete, and then you do the next floor. So there are temporary delays, but this temporary delay is part of the work. It has to be stopped if the asset has to be constructed. So during this interval period, the borrowing cost will continue to be capitalized. You will not suspend the capitalization of borrowing cost. Then cessation of capitalization. Cessation would mean stop. When will you stop capitalizing the borrowing cost to the cost of your asset, and you will start charging off these borrowing costs to your statement of profit and loss. First, when the asset is substantially complete. So more or less, right, largely all the work related to the asset is complete. Now the asset is almost ready to use. So further borrowing costs which you are incurring, right, that should be charged to the statement of profit and loss. The asset is completed in part. This is a very important scenario. When the asset is complete in part and the completed part can be used, right? Listen to this very carefully. When the asset is completed in part and the completed part can be used while the construction activity in relation to the other part is in progress, you should stop capitalization relating to the part which is complete. So I could give you an example. Let's say we are making a residential complex, right? Look at this very carefully. The first building in this residential complex is done. The second building is in progress. The third building is in progress, right? If we can use this first building, if this first building is ready for occupation and people can start living there, in that case, borrowing cost in relation to building number 1 should stop being capitalized and should be charged to the statement of profit and loss. But the another example could be, look at this very carefully. Let's say we are making certain plant and machinery. The plant and machinery has, let's say this is the one component of plant and machinery. This is the second component of plant and machinery. This is the third component, and this is the fourth component of the plant and machinery. Let's say this first component is ready. The work is on second, third and fourth component. Should we stop capitalization of borrowing costs on the first component? Answer is no. Why? Because on an independent basis, component 1 cannot be used. It is to be synced with all the other components and then it could be used. So on an isolation, if it cannot be used, you should continue to capitalize the borrowing cost. So let us look at it. Assets substantially complete. Capitalization of borrowing costs will cease when substantially all the activities necessary to prepare the qualifying asset is complete. Asset is completed in part when activities relating to a part of asset is substantially complete. Capitalization in relation to completed part should stop if the completed part is capable of being used while the construction on the other parts continues. So the main deciding factor is whether the completed part can be used independently or not. If it can be used independently, stop capitalizing the borrowing cost, charge it to the PL. But if the completed part cannot be used independently, then you should continue capitalizing the borrowing cost. We'll talk about disclosure. You need to disclose the accounting policy in relation to your borrowing cost, and you should state what is the amount of borrowing cost that has been capitalized. So now let us look at the practical exercise. Let's come to sum number 1. It says X Limited began construction of a new building on 1st January 2016. It obtained rupees 1 lakh special loan to finance the construction of the building on 1st Jan itself. So this is specific borrowing. Interest expense in relation to the specific borrowing should be capitalized at the rate at which the borrowings have been taken at an interest rate of 10%. The company's other outstanding 2 non-specific loan, they have taken loan of 5 lakh and 9 lakh. One is taken at 11%, another is taken at 13%. The expenditure that were made on the building project, January, April, July, December, various amounts have been incurred, right? So what has happened is in January, the specific loan was taken. So out of this 2 lakh, 1 lakh would have been spent from the specific loan and another 1 lakh would have been spent from the general or non-specific loan. Building was completed on 31st December, so it took period of 12 months. Following the principle of AS 16, borrowing costs calculate the amount of interest to be capitalized and pass journal entry for capitalizing the cost and the borrowing cost in relation to the building. So see, the total expenditure which we have incurred is January 2 lakh, 1 lakh from specific borrowing and another 1 lakh from general borrowing, and then July, April, July and December total expenditure we have incurred is 10 lakh 20,000, right? This interest will be calculated from January to December, April to December, 9 months, July to December, 6 months. For the month of December it is 1 month. For general borrowing, we need to calculate the capitalization rate, and capitalization rate is the weighted average rate of non-specific borrowing. We should not include specific borrowing in that. So 5 lakh rupees of loan was taken by 11%, 9 lakh rupees of loan was taken at 13%, divided by 5 and 9. So this is your weighted average rate, which will be treated as a capitalization rate. So for amounts used from general borrowing, we'll multiply it with the capitalization rate, and total amount of 74,189 should be capitalized as your borrowing cost. Now journal entry 10 lakh 20,000 plus this borrowing cost 10 lakh 94,189, building account debit to bank account. Then we'll move on to the next question. It says Raj and company has taken a loan of USD 20,000 at the beginning of the financial year for specific project at an interest rate of 6% per annum payable annually. So this is in relation to para 4E. On the day of taking the loan, the exchange rate between the currencies were rupees 48 for a dollar. The exchange rate at the closing of the financial year was 50 for a dollar. Corresponding amount could have been borrowed by the company in Indian rupee at interest rate of 11%. Had he taken the same amount of loan in India, he would have paid interest at the rate of 11%. Since he has taken it from US, he is paying an interest of 6%. But by taking this loan from US, he has exposed himself to foreign currency fluctuation. We've already seen that the time at which he has taken the loan, the exchange rate was 48. But right now, at the end of the year, the exchange rate will become 50. So there's a loss of 2 per dollar. Determine the treatment of borrowing cost in the books of accounts. So first we'll state the related para from the standard. Borrowing cost includes exchange differences arising from foreign currency borrowing to the extent they are regarded in the exchange of interest cost. Therefore, exchange difference to the exchange of difference between interest on local currency borrowing and interest on foreign currency borrowing is to be treated as your borrowing cost. So let's look at the solution. Total loan which was taken was $20,000. The time at which the loan was taken was 48 per dollar. So 9,60,000 is the total amount of loan which we have taken in INR terms. The difference between interest on local currency and foreign currency, had we taken this 9,60,000 of loan in India, we would have paid interest at the rate 11%. So we would have paid a total interest of 1,05,600. But actually we took this loan in USD, so on 20,000 USD we paid interest at the rate 6% and the closing rate is 50. So we actually paid an interest of 60,000. So we made a savings in interest of 45,600 by taking this USD loan. But our foreign currency fluctuation is 40,000. So this entire foreign currency fluctuation is getting consumed by way of savings in interest. In this case, the amount of exchange difference is 40,000, which is less than the difference in the interest on local currency and foreign currency of so much, and the entire amount of 40,000 should be treated as borrowing cost. Nothing should be treated as your foreign currency fluctuation. Listen to this very carefully. Had this foreign currency fluctuation be 70,000, right? I'm just giving you an example. Then in that case, we would have broken this into two parts. 45,600 would have been considered as interest and the balance amount should have been considered as foreign currency difference. But in this case, the exchange difference is less than the savings in interest. So the entire fluctuation will be treated as an interest expense. So total borrowing cost is 60,000 of actual and 40,000 as per para 4E. Total interest expense will become 1 lakh. Absolutely clear about this? Then sum number 3, it says Vittel Limited borrowed an amount of 150 crore on 1st of April 19 for construction of a boiler plant at the rate 10% per annum. So 150 crore worth of loan has been taken on 1st of April 19 where the interest rate is 10%, and this is specifically for the purpose of construction of a boiler plant. The plant is expected to be completed in 4 years, therefore it's a qualifying asset because it is taking substantial period of time to get ready for its intended use. The weighted average cost of capital is 13%. The accountant of Vittel Limited capitalized 19.50 crores for the accounting year 31st March 20, which is the year end. Due to surplus funds out of 150 crore, an income of 1.5 crore was earned and credited to the profit and loss account. Comment on the above treatment. See, there are two things which we need to note. This is a specific loan which has been taken, and in case of specific loan, we don't use the weighted average rate or the capitalization rate. Interest on specific loan is always computed at the rate at which that loan has been taken. Here what the accountant has done is, he has on 150 crore, he has applied the weighted average rate which is 13% and he has computed 19.50. But actually this is wrong. On this 150 crore, you should apply 10% and the interest expense should be 15 crore. The second mistake which he has done is that out of this 150 crore of specific borrowing, certain funds were temporarily invested and there was an income of 1.5 crore. We do not take this to the statement of profit and loss. We have already seen that if there is any temporarily, let's say, income which is generated, right, we will reduce this, right, we will reduce this from your expense. So what we have to do is 15 crore is your actual expense on the specific borrowing, and 1.5 crore is your income, so 13.5 crore is the amount to be capitalized. So let us look at it. Right, so we'll say actual interest for 1920, 10% of 150, 15 crore should be the actual interest, less income on temporary investment or specific borrowing, 1.5 crore, and 13.5 crore should be the amount capitalized. Please go through this text because here I have mentioned that what is the treatment or what is the relevant para of the accounting standard which will be applicable in this case. So by this we are done with very important practical questions on accounting standard as well as the revision. If you like this revision video, please give a feedback by commenting and liking the video. Do share it with your friends and please subscribe to our channel and let your friends know as well. Thank you so much and all the best.